Hi, and welcome to the CRIISP Venture Investment Summit. One day, 20 investors, 8 sectors. Normally, this type of event would take months to be able to bring together. For us, the reason we brought it together in such record time is because we wanted to provide you, the investor, with an opportunity to hear directly from some of Australia's most experienced and leading investors, actually investors from around the globe, as to what they're looking at, how they're looking at things, and also what they see as the opportunities in the marketplace. Now, to kick off, I'd like to say a big thank you to our sponsors, to our shareholders, and also to our partners, to Investec, BMYG Group, and also CS Associates. We strongly appreciate the support. You've been phenomenal in helping us spread our message and helping us do what we do, which is actually bringing visibility to an ecosystem which we're incredibly passionate about. To Enserata, NZTE, PwC, and Think Markets, a big thank you for your support and contribution to Wholesale Investor and everything that we aim to do. Now, to give you some perspective as to why we are the ones to bring you the CRIISP Venture Investment Summit, is that Wholesale Investor has been bringing together high net worth investors and emerging growth companies now for over 11 years. We have been doing this successfully throughout Australia, Singapore, and also the UK. And as this situation was unfolding, we immediately knew that what we wanted to do was we wanted to take a streamlined approach into how we actually provide information to investors in this space. More than that, we wanted to add value. We wanted to be part of the solution. And in part of that solution, we wanted to provide you with access to some of the leaders and some of the most innovative thinkers that we get access to in our day-to-day life. Because for me, it was really fortunate that I could actually ask these people questions about how they're thinking about things, how they're looking at things, what are they investing in, how they're now doing their due diligence, etc. Right? Those are the questions that a lot of other investors are asking. So if we could provide this platform like we are, that was the ambition for it. Now, for me, when I think about this, people always ask us the why, and that was really summarized just then. Because what drives us is how do we create opportunities. That is the core vision of Wholesale Investor, is about creating opportunities for tomorrow. And this is a part of that. We have been part of building this ecosystem now for the last 11 years, right? And when we see these situations unfold, we understand that it can have a negative impact. But really what we also understand is in crisis, there is also considerable opportunity. And now the marketplace is seeing that with companies like Zoom, Marley Spoon, really taking advantage of these, and also Atomo Diagnostics, one of our old clients, Vision Flex, which is a telehealth company that's really benefiting from this situation. There is absolutely winners in this environment, and that's why we want to help you understand what other investors are looking at. Now, the 4 main areas that we've thought about as far as how we can get access to, I suppose, dive into the brains of the investors that we're speaking with. The first one is thesis. What are they currently thinking? What are the questions they're asking themselves? What is their investment thesis as they're actually approaching this marketplace? What was it beforehand? What is it now? And how do they see this going forward? Next is how are they supporting their existing investee companies? Most investment groups, they'll have some companies that are finding this environment quite challenging, and they'll have other companies which are becoming star performers. So how do they separate their support of the two? How are they getting behind the ones that are currently challenging? Are they helping them raise capital? Are they introducing them to other trade partners? Are they helping them with information as far as what they can get access to through the government and so forth? Next one is how are they investing? How are they actually looking at opportunities? How are they discovering and doing DD in an environment where they actually cannot sit down one-on-one with a potential company? And how do they plan to do it going forward over the next sort of 2 to 3 months as those restrictions start to relax a little bit? And then finally, what does the future hold? How are they thinking about the future? What do they think will be the performers over the next sort of 6, 12 months? But more importantly, what do they think will be the fundamental changes that will take place in our ecosystem over the next 3 to 5 years? And how can you as an investor benefit from that? The speakers and panelists that we've assembled are incredible. I cannot say enough about how they've supported this event, how quickly they've got behind it. If you can understand, to put together a conference, right, of 20 speakers, it would normally take at least 3 to 5 months to be able to pull that off, right? So we've done this in a very short time frame, and it's because this is the ecosystem that we operate in. They are passionate, they are sharing, and they want to see the ecosystem itself succeed. So thank you very much for every speaker that's got involved. And it said, what's incredible is we've got the panelists range from covering from technology, healthcare, blockchain, advanced tech, funds management, and also covering the angel investment perspective as well. So the objective for us is how can we give you that broad spectrum of information. The panel sessions, I said we'll be covering it, but it's really sort of being able to give you the opportunity to have a deep dive with some of the speakers to understand how they're thinking about things going forward. Said this is a unique time and information is king as part of it. And more than that, the actions in which you'll actually take from the actual conference itself. So whilst it goes for a day, the idea is that this information is to the benefit of the entire ecosystem and can help you grow and prosper at a time that is obviously particularly challenging. Now, for us with this event, obviously the way we grow is by other people sharing what we do. We put on this as a gift for the ecosystem. So I encourage you to share this link, the video link for this event, with other people in your network, whether they be founders or investors. Share this link with them. Connect with the actual presenters. We've got in the actual stream, you've got the ability to ask questions throughout the presentations, and then the speakers will be on to be able to answer it at the end of their presentations. And then also they've got chat going through the live stream throughout the day. So we want to make this as engaging as possible. And obviously our team will also be having discussions with people that ask questions and helping facilitate that as well. And then the last one is engage, right? So as I mentioned, ask as many questions as you want. This day is for you. This entire event is for the ecosystem, and we want you to extract as much value as possible. These are my details. I welcome you to add me on LinkedIn. I will be doing a presentation talking about what we see as the vision and the future of capital raising. And it's not just because of this environment. This is what we've been seeing coming for a long time, because the way in which money gets raised and the way in which you invest into companies, we are seeing what that transformation looks like, and we want to give you our perspective on that. Enjoy the Venture Investment Summit. As I've mentioned a few times now, we want you to get as much value as possible. Please share the link with your networks, and we look forward to hearing your feedback. Thank you.
Our first opening session is Venture Capital. I would like to welcome Bevin Shields, Investment Director and Head of Investor Relations at Bailador. Bevin has over 15 years of experience in mergers and acquisitions, capital markets, and corporate development, with a focus on assisting early-stage businesses grow, either organically or by acquisition. Bevin was previously a head of mergers and acquisitions, capital markets, and investor relations at Catapult, an ASX-listed sports technology company. During this time, Bevin led numerous cross-border acquisitions and raised over $170 million in funding. The purpose of Bailador is to partner with founders and establish board representation to empower its portfolio companies to succeed and drive rapid growth on a global scale.
Well, welcome everyone. Thanks for joining this presentation on Bailador Technology Investments. My name is Bevin Shields and I'm a part of the investment team at Bailador. So as a quick introduction for those who don't know Bailador, we are a venture capital fund investing exclusively in the information technology sector. We focus on high growth, private technology companies and invest at what is typically known as the expansion stage of the company's journey. Broadly speaking, the expansion stage companies are ones that have moved well beyond the startup phase and are now looking to unlock significant growth and become a global player within the market. We believe this stage is most attractive from a risk return perspective, as there is still strong potential to capture significant growth, but also to invest at a more modest entry price versus later stage investments. But we realise it can be somewhat challenging for Australian investors to get access to this asset class. Whilst in the US, the technology sector makes up over 23% of the S&P 500. By contrast, the technology sector in Australia, it only makes up about 3% of the ASX 200. And peeling back the onion a little further on that, you quickly find that the majority of this exposure is really dominated by the larger ASX-listed technology companies, which are already trading at pretty premium multiples by historic standards. And this is a key reason why we listed Bailador on the ASX, as it means investors of all types can get access to a portfolio of expansion stage private technology company investments via an ASX traded share. So one of the questions we're often asked by founders and investors alike is how we support our investee companies. Firstly, it's worth mentioning that we run a concentrated portfolio of just 10 investments. We've deliberately structured the fund this way as we believe delivering enhanced returns in this asset class is really best achieved with a long-term partnership which provides both the capital and the operating support necessary for these businesses to succeed. This means we're quite hands-on with our businesses. Through the diligencing phase, we typically work with the founders to establish a 3-year plan, which really helps us define and agree what the capital and operating priorities are for the business. We typically have 1 or even 2 Bailador team members on the board to help build out the governance and leadership model. But importantly, we really like to get our hands dirty across many other important areas of the business, such as strategy, business development, corporate development, capital raisings, just to name a few. We also work hand in hand with our founders on the exit strategy, which usually takes the form of either an IPO or a trade sale. And it's these realizations or partial realizations that ultimately generate returns for our investors. So the reason we're able to offer this level of support, it really comes down to the Bailador team. So Bailador was founded by David Kirk and Paul Wilson, who I'm sure many of you have already heard about. Both have tremendous track records of delivering strong returns in the technology sector, but it's their deep experience and diverse range of experiences as both leaders and investors in companies of this sector, which really provides such tremendous value to businesses of this stage that we're investing in. This is also complemented by the rest of the team who have a diverse range of financial and operating experiences, and together enable Bailador to really offer this level of support to its portfolio companies. There's no doubt our model has allowed us to go a lot deeper with management teams as they address the current crisis. Broadly speaking, our work has been split into about 2 key phases. The first being the initial response, where a lot of time has been spent with management teams working through the volumes of new information coming through as a crisis unfolded, areas such as modelling and reforecasting and budgeting, capital management, and also working through all the government incentives. And that's also the complexity is added by the fact that we have global operations. So it's also about understanding what's happening in other key markets like the US and Europe. But we're now well and truly into the second phase, which is much more about positioning for the recovery cycle. A lot of work has already gone into understanding how the markets we operate in are evolving and our relative strengths and weaknesses. We feel it's important to always be looking at the glass half full scenario with a view that it's during these times where the significant opportunities tend to go to those looking in the right places. We're often asked whether we're still looking at new opportunities given we've got a concentrated portfolio. And the short answer is yes. Some investors might be aware that in January we sold down a minority portion of our investment in SiteMinder. So after paying a cash distribution to our investors, we're now seeking to redeploy the remaining capital to 1 or 2 additional companies. In terms of what we look for in companies, we basically invest in private businesses which are born in Australia and New Zealand and are still run by the founder or the founding team. The reason we focus on these businesses is we feel that we have a much better chance to diligence these companies and really get to know the people involved, which is such a crucial element to ensuring a successful partnership over the long term. A general rule of thumb is that these businesses have typically been going for about 2 to 6 years and have at least $5 million or more of revenue. In fact, in our portfolio today, nearly all our companies have over $10 million of revenue. The reason we pick this as a guide is usually it means that the businesses firstly already have a proven business model and a proven product market fit. Secondly, there's a clear demand for the product, which is demonstrated by a rapidly growing customer base already in the possibly hundreds or even thousands of customers. Importantly, underpinning this growth is a pricing model and strong unit economics that clearly demonstrate the business can continue to grow efficiently. On top of this, the business has almost always started to address international customers, having identified a large global addressable market. And management have obviously proven themselves to scale up to this point. In terms of what we look for in founders, really we're looking for high integrity people who have a passion for their product and a genuine intelligence around how their product solves an existing problem or fills an existing gap. Most importantly, we find more success with founders who are already aware of the gaps within their business and have a willingness to be surrounded by A-graders to solve that. Our belief is you should always hire people smarter than yourself. But that's not to say we're the smarter ones. Rather, it's about the willingness to work together to get these people on board and to help unlock the next stage of growth. And finally, we look for good communicators, those who can tell us about the ins and outs of their business as we rely heavily upon this day to day. Within the IT sector, we are most interested in SaaS models and marketplace models. SaaS business models make up close to 80% of our portfolio today. The reason we like them so much is they scale very efficiently, they have very measurable metrics and have the ability to address global markets. Marketplace businesses also show very compelling and similar characteristics. And the macro trends for SaaS are really strong. It comes as no surprise to us that, that SaaS has been the dominant source of software revenue growth in the last decade or so. Australia and New Zealand have already produced notable success stories, including Atlassian, Xero, WiseTech and Altium, to name a few. But we really feel that this is the tip of the iceberg in terms of emerging Australian SaaS companies. We have a number of exciting SaaS investments in our portfolio, as shown in the bubble. These businesses serve a really wide range of industries where technology is becoming an ever-increasing part of the everyday function. And although this chart obviously predates the coronavirus world, one of the major advantages of technology companies is they tend to have an inherent flexibility and adaptability to change. And we're seeing this within our own portfolio, which means for us, it's more about focusing on the unique opportunities that are out there or we think might be emerging. But we don't profess to be experts in economic forecasting. However, we do think the crisis will be a net positive for the technology sector. And overall, we believe dependency on technology is only increasing during this new chapter globally. Another question we've been asked is which areas within technology we think which companies we think are going to be star performers. So we've already seen a number of interesting developments as a result of the lockdown phase, the crisis, where working from home and restrictions on normal movement have resulted in a real spike in demand for areas such as remote working and online shopping, home delivery and home entertainment, to name a few areas. The question for us is really to what degree these significant changes will form part of a longer term shift in our habits, or alternatively as part of a forced change to the way we go about our daily lives. And look, we're already seeing some emerging stars, which I'll touch on as well, and how they relate to Bailador's portfolio. Firstly, in consumer video, most notably Netflix and Hulu and other video streaming services, they've enjoyed an enormous increase to their subscriber base. But really, for us, it's the demand for content, which has never been greater, that we are most interested in. And content these days must also be global to enhance the scalability of these platforms. So another potential beneficiary is the translation platforms that give you subtitled or voice translated content. One of our portfolio companies, Stroker Translations, has been making some big moves in this space, which we're really excited about. Secondly, it's working from home. So clearly all the remote working products and platforms are enjoying huge success and increases in demand. Already there are clear signs that remote working could become a more permanent fixture within our working lives. But equally important is ensuring that online security of remote working, to preserve project workflow and data and documents. And one of our portfolio companies, DocsCorp, works exclusively in this category. And thirdly, but not last by any means, is online spending. Most notably, groups like Amazon and Shopify, to name a couple, have been big beneficiaries of the stay-at-home phase of the crisis. And this has no doubt provided the catalyst for waves of new online shoppers to emerge and really embrace the online model. We have an online retailer in Brossa, which is one of only a handful of local online furniture platforms, which is an area we think is massively underserved in the market. But equally as important to us is the ability for these new online demand channels to be effectively tapped by the sellers. As the new wave of demand for the product comes online. And we've got a number of portfolio companies focused precisely on this, including the likes of SiteMinder, our biggest investment, Lendi, which is focused on the property market, and Resdi. And we think these businesses should really benefit as demand continues to build well into the recovery phase. And finally, with all the increased online activity, we're really seeing a marked increase in the demand for data and databasing. So there's been a number of databasing businesses which have been performing strongly. And in our portfolio, we've got one which is called Instacluster that is focused purely on databasing, open source databasing, that is. So overall, in the current environment, we think the best opportunities will really go to the businesses with proven management teams and backed by strong balance sheets. Are well capitalised with cash to deploy and therefore aren't really reliant on investors to survive. Our portfolio of businesses are predominantly subscription based and therefore relatively shielded from much of the risks that we're seeing at present. So we're really looking down the track into the future now. So that's really it from me. I hope it was a helpful session for those who are watching. Thanks again for your time, and please don't hesitate to ask a question now, or alternatively contact me with any questions offline if you're a founder or an investor who wants to learn just a little bit more about Bailador. Thanks.
Thank you, Bevin. Our next speaker is Rajeev Gupta, partner at Alium Capital. Rajeev has 20 years of experience analyzing, investing, and building technology companies. Rajeev began his investment career at Goldman Sachs, where he worked for almost a decade in the investment group in Hong Kong, Singapore, and New York, with a focus on investing in listed and unlisted technology companies. Alium Capital focuses on emerging technologies and innovative companies, covering the spectrum from Series A to Z, fundraising, as well as investing in large liquid stocks and themes. Alium has backed companies such as Nitro, Koala, Zoox, Health Engine, HappyCo, Sustainer, FaceMe, HeyU, Academy Z, Spriggy, to name a few.
My name is Rajeev Gupta. I'm one of the founders and partners at Alium Capital. What I want to do today is talk about several issues that are at front and center of everyone's mind when we think about investing, how we support them, some of the companies that we're seeing today and how we should respond to them. I also want to share some data points on what some of our companies are doing in this COVID-19 environment and how they're preparing for the recovery. Given that we have around 50 private companies, there's several elements that we have learned during this recent 6 to 8 week period. And I want to share some of the investor tips which may be useful to you. And then I want to wrap up with what some of our best founders look like and what a successful potential investment criteria might be when we recover out of COVID-19. In terms of a general overview, who are we? Alium Capital is not a venture capital firm, nor is it a strict private equity firm. We sit somewhere in between, and we're a $300 million crossover investment fund. So we invest in both public and private assets. Our ultimate goal is to invest in private assets that can list on the Australian Stock Exchange at some point. We've had recent success with Atomo Diagnostics, which listed only 2 weeks ago in this COVID-19 experience. We also had last year Aerometrics, Damstra, and Nitro, all multi-$100 million companies plus that listed on the stock exchange. Our thesis is technology on the ASX is still only around 10% of the total index. If you look in the US, that number is in excess of 50%. In this COVID-19 world and this world of work from home, technology will become a more important part of our lives, and we feel that more companies listing on the ASX provides a great opportunity for retail and institutional investors to provide capital and grow with them over time. We do also in the public equity space focus on some placements, blocks, recapitalizations, and that is to become more familiar with the public markets and to find great value at great prices and then to generate a return. As a fund, we are constantly focused on liquidity. That is an important part, which is why we invest in private to get that liquidity coming when they become public assets. To give you a bit of a subset of the Alium portfolio, here on the right-hand side, I've got some assets that we are invested in. There's a breadth of enterprise SaaS, insurance, food tech, marketplaces, and some of the brands that you may have heard of, the likes of Koala, Academy XI, which is online education, Nitro, which listed last year, which is a document management productivity company, and Atomo I mentioned recently, which is a rapid diagnostic testing company, which did very well when it listed. So what is our focus today? Alium has always been and will continue to be a business focused on investing in technology, whether that is for enterprise technology or whether it is in the consumer technology space. That is where we play. Most of our businesses have been in existence for greater than 3 years. And when we invest in them, they are already at a point where they have traction and they're validated. That's reflected in almost 50% of our portfolio holding profitable companies. And some of these companies are very profitable. And in identifying these assets, what we're looking for is the execution traction they have, the product that they've built, the teams that they've assembled. And then we try and negotiate very respectfully of arriving at an investment in those companies at the right price. So we are a valuation sensitive investor. In the last couple of weeks, I'd say since the end of the first week of March, we've spoken to all of our companies. We speak to them multiple times during the week. And we've been helping them with financial austerity and planning. Several of them need help with funding, what they should be doing. And part of that is initially to cut cost and then plan to get the highest return on what you have in terms of cash and staff. We've also been helping them with some strategies around staff whereby you are cutting salaries. JobKeeper has been beneficial, but coming up with a plan around ESOP to compensate for maybe some lost value that some of the staff members have. We are still speaking with businesses that are new, that are wanting to raise capital. Just this week alone, we've had 9 Zoom calls with new companies that are trying to raise capital. So whilst people may think it's impossible, companies won't want to, there's always a great opportunity to be meeting new businesses, learning about them, and then ideally investing in them. Logically, you will think that most people want healthcare in this environment or productivity, and no one will want to touch travel or hospitality related businesses because that's what we see as being, not we as a fund, but we as a community see as being problematic, but maybe that is where the opportunity is. So always be open-minded, which is what we are. In terms of how we've helped our companies and to elaborate on it a little bit more, 15 of our companies, in fact, had record revenue in the last 6 weeks because there is an online bias and the market's gravitated towards them. We are very forthright and open to making sure that we talk to our companies. We're visible with them. We're talking to the founders. We're talking to the board. We're talking to staff if they want to speak to someone that's non-internal, but also has a vested interest in the business. And we tell all of our founders and CEOs, focus on two things. Focus on your staff first. Make sure they're looked after, make sure they're remunerated, make sure they're being productive. And then importantly, look after your customers. There's an element of customer service that must take place to ensure that your customers that use your product or service can continue to use it in this environment. We have found that many of our companies have successfully cut cost, and JobKeeper was an important part of the catalyst there. So whilst for some businesses demand has weakened, they have generally cut costs by an equivalent amount. Therefore, they're negating the negative impact to their business. And that leads to them wanting to be financially sound. Everyone wants to get through this. We all will as a community. And we need to ensure that the businesses plan to come back stronger and leaner out of COVID-19. In terms of new investment opportunities, we're always looking to deploy capital and assist companies and founders. We are supporting some of our existing portfolio companies. I would say from a context standpoint, in the last 1 year, we have been less active than previously. We've only added 3 new companies to our some 50 portfolio of companies that we have. That's because we thought valuations have been far too stretched and some of the businesses were just far too novel, for want of a better way of putting it. I do believe within the next 6 months, we will see some very attractively priced companies and deals. And a lot of those were probably very expensive last year. And just a subset of that, one of the companies that we held a call with this week, they were trying to raise money at a valuation close to $75 million in the industrial enterprise SaaS space recently. And then when we spoke to them, the valuation had come down by 50%. Business had not, but they were concerned that there would not be any capital providers, and they took the front foot approach and did cut their valuation, which looked expensive when they came the first time around, but was looking a lot more attractive now. So we're doing some due diligence on that. I do strongly feel that coming out of COVID-19, this whole growth that we have been used to for the last couple of years will change to profitable growth. I'd rather see companies grow at a lower pace, but it must be much more profitable and a very clear path towards that. Some of the themes, as Warren Buffett says, you should always buy good assets at good prices, and he's always greedy when others are fearful, as we know. I do feel that healthcare innovation will be an important part of new companies trying to raise capital with new business models in the next 12 to 24 months. Smart manufacturing, which Amazon deploys and employs, will become important as well. And then obviously remote workforce productivity, collaboration is a significant theme. Telecommunication companies have come to the fore, platforms that are built on it that win, such as Zoom. I do think VR and AR, which has been talked about for many years, may also end up being much more important on a 12 to 24 month view as well. So those are some of the key segments that will tap productivity, less human touch, and enhance efficiency. Some best practices that we deploy, as I said earlier, stay in touch with your investments. We talk to them frequently. We've set up WhatsApp and Slack channels with most of our founders, CEOs, boards, and management companies. Be there to listen and assist whenever you can. We've made introductions to our accountant. There are bankers that we've introduced some of our companies to as well that need advice around M&A or raising capital. And if you're in touch with people that are in the political space or people that have domain experience in certain verticals or at big companies, facilitate a dialogue. We recently set up a call between a company that we have in enterprise SaaS in Melbourne with an individual at a very large multi-billion-dollar US software company that we know who runs their Asian product. And we hooked both of them up to have a conversation and ended up being quite fruitful. So introducing those thought leaders is very useful to your companies. Be proactive. Investment criteria. This has been something that we've always focused on. I think it's amplified now. Path to profit I've mentioned. Sustainable margins. Just growth is great, but margins are what we invest in to get a return. We focus on asset light, human light businesses. We do spend a lot of time understanding technical capability of the team to ensure that they can build a product, and then you have great people in marketing and sales that can sell it and generate revenue. Low cost is a criteria that I think becomes more important out of this. You don't want to underpay your staff, but you must be aligned with them, whereby don't pay just in cash, get alignment with stock and ESOP. And for a business like ours that focuses and hopes that companies will become public assets, that ends up being a driver of finding great people who believe in the journey, believe in the story, and will be remunerated on a medium to longer term basis. Founder glint, this is something that is critical for us in all of our investment decisions. That one person or two founders or single CEO that lead a business, they can't just have a single skill. They must understand finance, sales, product and technical, and also understand raising money with stakeholders. That capital management part is key. Some of our best founders are extremely transparent. They tell you the good and the bad. We found in the past when we're doing DD on some companies, some founders are just not so transparent, which is not so great. Articulating vision is something that, you know, our investors expect for us to be supporting. Businesses such as Koala, which is one of our larger portfolio assets in e-commerce, you know, their management team is able to articulate what they want, how they're going to do it, and what they'll build as a march towards being $1 billion asset. Ability to inspire and hire people is important. And then that single founder or the founders of the team at the top, they must want to win and they must institute change, because that's how they dominate. With that in mind, I again thank Wholesale Investor and CRIISP. Thank you so much.
Thank you, Rajeev. The next speaker I would like to introduce is Anthony Millet, partner of Antler Australia. Anthony is an experienced entrepreneur and CEO who has co-founded, scaled, and sold market-leading businesses globally in the financial services and e-commerce retail sectors. Prior to joining Antler, Anthony was the co-founder and CEO of BrickX, where he successfully launched the business, led it through $9 million in Series A funding from high-profile VCs, including Westpac's Rain Venture and NAB Ventures, and scaled BrickX to over 12,000 investors.
Hi, I'm Anthony Millet, partner of Antler Australia. We are a $40 million VC fund that has a talent-led investment thesis. We bring phenomenal individuals together into our programs, help them find co-founding teams, coalesce around their ideas and the best ideas in the program, and back these people extremely early as their first institutional investor, and take them on that journey to build highly valuable global businesses. I'm going to talk to you a little bit about our response to COVID-19. I'll also and share some of those learnings. Talk a little bit about some of the examples where our companies within our portfolio have pivoted or looked to deepen relationships with customers by being more supportive and seeing opportunities there. Bring you up to date on our recent round of investments and what we look for in our investments, and also tell you a little bit about our COVID-19 initiative, looking to invest in businesses that are helping solve that problem and be the companies that we think will be highly valuable in the future around that theme, and then share some information on how you can get in touch with us. So we first recognized in early Feb that it was clear that the impact of COVID-19 was going to be beyond just something that was limited to China. And the first thing that we set in place was sit down with all of our portfolio companies. At that time, we had 13 portfolio companies, and we explained that it was likely to be a very tricky road ahead for them. We looked at each of the businesses individually, the business sectors that they operated in, to try and predict the impact, look at their cash runway and other other considerations. We leveraged great material that other VCs put out there, and it was great to see the VC community really come together to help kind of share learnings there, and also looked at what the impact might have been in previous economic disasters such as the GFC to kind of help the companies pave their way forward. Fortunately, most of our businesses have models which were temporarily impacted rather than kind of business killers, and so a lot of them have looked at how they can go into a slower pace in terms of business development and sales, whilst also mitigating their cost bases. We then also accelerated the development of our internal tech platform. This is a platform that we use for helping founders get to know each other, come together, share information on each other. Platform that they use for sharing information on their businesses, that they use to navigate our program locally and globally. Also, the platform that we use for our investment committee was built for this accelerated build because of this occasion. And then also the platform that's used for our programs here in Australia and also around the world. And we held our first digital investment committee at the beginning of the end of March, and that went extremely well with great engagement from the VC community. And ever since, we've been running our program in a purely digital fashion, which has actually had no impairment or impact negatively. In fact, we actually find that it's having many, many positive effects. A number of our companies, as I mentioned, pivoted to look at how they could take advantage of the COVID opportunity that presented for them, and that was either through looking at new business lines or new ways of generating revenue, or generally being very, very supportive to their existing customers and ensuring that they deepen those relationships in these more challenging times. So we have a Verge, which is a cybersecurity business and is offering free cyber readiness assessments to existing clients and to new clients. And we've read a lot about the fact that as a result of COVID-19, there have been a lot more cyber attacks and people looking to take advantage and criminals looking to take advantage of that. And that's been really well received. Scouter is a business that we've got that connects hiring teams and top talent with some of the world's fastest companies, and they've been particularly active in helping place those who've lost jobs as a result of the current situation. And then Upcover is our portfolio company that is providing insurance to the gig economy, and they've been providing additional support to those workers in terms of more information in supporting them through this process, as well as petitioning the government to help support those on temporary visas that have found themselves in a bit of a tricky situation. So it's really great to see some of our portfolio take advantage of the situation, or perhaps make it less worse. And this action has been taken globally by all the Antler companies around the world. We've now got close to 200 companies in our portfolio across our offices around the world. We operate in 6 continents. In terms of the numbers of people that apply to come into our program, I mentioned at the start that we are a talent investor where we bring phenomenal individuals into our program, and they may look anything like serial entrepreneurs to people out of university research departments to lead engineers or former CTOs, domain experts out of industry. We bring all of these people together and help them form really strong co-founding teams. And what we've actually seen as a consequence of COVID-19 is our business model and the opportunity for individuals and the opportunity for Antler has got even stronger. And that's really been driven by a couple of themes. One is the availability of talent. We've now found a lot of phenomenal people reconsidering their options, considering if they feel purposeful in their current roles in light of the global health scare that we've seen. Unfortunately, we've seen a number of people being made redundant or feel now incredibly insecure in their roles and thinking, well, now's the time for me to back myself to go and build a business. So the availability of talent has really exploded. And what is quite interesting is also the opportunity to go and build a business has really presented itself. And if we look back to the last time we saw kind of wider dislocation of the markets, we can look back to the GFC and look at those businesses that were funded in the wake of the GFC. And you'll recognize all of these businesses here on the screen. I always love seeing this page, especially with regards to Airbnb and Uber, because it's somewhat sobering and exciting to remember that these businesses at one point were just a couple of people and had to go and raise their seed funding round. And you look at how much they've raised and obviously how much those companies are worth. And we're seeing huge amounts of opportunity and similarity in what we're seeing now, in that existing businesses, existing corporates, existing industries have and will continue to shed jobs. They'll be focused on their core. Innovation budgets will severely slow down, and they'll be quite insular and inwards looking, which leaves a lot of opportunity for those, the most ambitious people, to go and build businesses right now to truly disrupt industries where there may have been more resistance before. So we're incredibly excited for the opportunity that exists here right now. In terms of is Antler investing, or are we still investing? We absolutely are still investing. We actually doubled the size of our portfolio in April. For our program, founders weeks working with each other, and also working with the Antler team, are over 150 investors, local VCs, and our advisors. And those 80 people ultimately formed 28 teams, and we actually decided to invest in 13 of those businesses through April. So we're thrilled to have doubled the size of our portfolio to 26 now. And we were also thrilled to have, even in light of the crisis that was going on, and a lot of VCs spending a lot of time with their portfolios trying to understand the impact on it, we were still joined by partners from all of these fantastic Australian VC firms to help us make those decisions and vote on the businesses that Antler should ultimately invest in. So it was really great engagement from all of these partners. And so what are we looking for at the moment? This hasn't really changed. This is consistent with what we were looking at previously and what we'll continue to look at. Although of course adapted for the current market and what we think the future looks like in a post-COVID-19 world. But the first thing that we look for are the team. We're helping the teams come together in the Antler environment, and we're really looking for that team that has great complementary skills, great team product fit, and also the right levels of ambition, courageousness, determination, grit and resilience in building something that's a truly global opportunity. We're also looking for a product that's got a clear differentiation. And as I mentioned earlier, we think the opportunity to go and disrupt markets right now is extremely exciting. And obviously with Antler being around and other VCs being around to give that early stage funding, there's probably never been a better time to go and build a new venture. And we're also looking for those businesses that have got highly scalable business models. And from an Antler perspective, the kinds of businesses and opportunities that we look at are those that we believe that within 5 years, with the right combination of product, market, and team, can get to over $100 million in revenue. And that really does attest back to the quality of the founders that are coming into Antler, and not just those first-time founders, but those serial entrepreneurs also. I mentioned earlier that as a response to COVID-19, Antler actually launched an initiative, and we went out to find a number of businesses, whether they be existing businesses or businesses that could quickly be spun up, that were looking to help solve or mitigate the existing situation, provide medical equipment to assist with the COVID-19 pandemic, looking at tools around remote health and digital tools, etc. And that can also spread into things like mental health, etc. And we were looking to invest $500,000 in up to 5 opportunities globally. And we were blown away that over a 2-week period, we had over 1,600 applications across 90 countries, which is truly phenomenal. One shows that Antler's reach around the world, and the fact that we've been able to activate those global networks to really drive that level of interest. But also too, it's great to see that in spite of the current situation, the amount of ambition amongst entrepreneurs around the world and who are determined to really make a big difference. We're currently going through those applications right now. A number of investment committees have been scheduled to make those investment decisions. And actually, as a result of this campaign and the phenomenal response that we've seen, we've actually decided to extend the 2-week deadline that we'd set in place and actually keep this as a rolling campaign for as long as we see great applications. So we've actually decided to up the number of teams that we will invest in globally. I was really excited to be able to share that update with you all now. A few things coming up. If you'd like to learn more about Antler or apply to come into the next program, you can go to our website at antler.co. There's program details there around the Sydney program, which is launching on June the 15th, and we are still taking applications to come in at this stage. Thanks very much for listening, and be really happy to take any questions that you might have.
Please welcome Steve Torso. Steve is the co-founder and managing director of Wholesale Investor, Australia-Asia's leading private investment platform with over 29,300 high net worth investors, fund managers, family offices and industry participants. Knowledge gained through Wholesale Investor led to the development of CRIISP, Capital Raising Intelligent Investment Secondary Platform, an end-to-end SaaS platform for capital raising, secondary sales and direct investment.
Thanks for the introduction, Marta. The conversation I want to talk about, obviously, my name's Steve Torso. I'm the founder and managing director of Wholesale Investor. And in this talk, I want to talk about what we see as the vision for the future of capital raising and also the future of venture investment. And if you look at the circumstances that are taking place right now, this has obviously brought this forward. And to give you a bit of history, Wholesale Investor, we are now been Australasia's leading platform for some time now. And effectively what we do is we take high growth companies or innovative companies and we introduce them to high net worth investors. And we matchmake them via our either online platform on the Wholesale Investor site or on CRIISP, or we do that at typically our live events. But of course, now we do it through our virtual showcases. In that time, we've been able to build up a database of just over 29,300, and they're mostly focused across Australia, Singapore, and also the UK. The topic of this talk is how do we take that ecosystem and help the entire ecosystem save time, save money, and improve efficiency in their deal making. And that's the way we've thought about it. If you want to understand the DNA of our company, I first want to help you understand what our vision is. Our vision is really simple: creating opportunities for tomorrow. Every email we send, every action we make, this presentation, this entire investment summit, all the events we've run before, everything that we do as a company is about creating an opportunity that doesn't exist. We absolutely love that effectively the companies we work with, the opportunity that we get to help for them to create, say, whether it be a capital raising opportunity, a strategic partner opportunity, a trade opportunity, it's irrelevant for us because it's really about creating something which doesn't exist. And that's what I think is beautiful about our ecosystem. From a mission standpoint, we're always asking ourselves, how can we utilize technology, platforms, and partners to introduce high net worth investors with emerging growth companies as well? That's always been the core of Wholesale Investor, and that's also been the foundation for CRIISP, our capital raising software. It stands for Capital Raising Intelligent Investment Secondary Platform. Now, the final part to this is also really important, is how can we break down the borders between ecosystem? How can we create cross-border collaboration? If you notice, we've done work with governments like the Flanders government out of Belgium, the NZTE, the New Zealand government, the Kotra, the Korean government. We've done work with the Israeli government. We've done work with DIT. We've done work with Austrade. Because we realize the role and the power of the ecosystem is there is no borders to doing opportunities, right? It's really about how do you get that company in the UK to mix with the investor that's in Australia that could potentially have relevant opportunities in Hong Kong or Singapore? How do we create that from an ecosystem perspective? And that is what fundamentally drives us at our core at Wholesale Investor. Now, when we're dealing with investors always say the same thing: introduce me to the good deals. The challenge is, of course, everyone's got their own perspective on what a good deal is and what a good deal isn't. When we deal with companies, they always say, Steve, we want you to introduce us to the good investors. Now, the challenge is we can introduce people to great investors, but they may not be interested in the company. So then it really becomes about how do you create that relevancy? Now, what's been really interesting, if you look at capital raising as a journey, most capital raising, if you look at capital raising 1.0, it's sort of really reliant on personal networks. And that's pretty much, it's not unsurprising that the majority of capital is still raised in this mechanism where it's sort of going through networks of people reaching out to other networks and then hoping to find a relevant potential investor for a company, right? And it's still pretty much driven that way. The only thing that actually changed is that people added email and Excel spreadsheet to actually using that. And the reality is for most founders, they really see capital raising as a bit of a dark art. And from a corporate finance perspective or an advisor's perspective, they typically charge that 6 to 8% fee for that introduction, for that deal structuring, and for the process of actually raising capital. To me, that's capital raising 1.0. 2.0 recognizes the power of the internet and looks to leverage off things like Dropbox, Google Drive, and obviously still factoring in Excel spreadsheet. It's actually amazing. Investment banks still using Excel spreadsheet as part of their actual deal making. From the platform perspective, what happened is obviously companies recognize the ability for utilizing the internet, but they're still trying to charge like a personalized one-to-one service that we sort of highlighted in capital raising 1.0. Now, from you as an investor perspective, we've tried to understand what are the different frustrations of the ecosystem. Now, obviously, from an investor perspective, time it takes to receive information. There's typically no streamlined approach. You're getting deals from all sorts of different sources. Some are on email, people are saying to you on LinkedIn. You've got other people, that are obviously introducing it one-to-one. Sometimes founders can be over communicative and a little bit too talkative. So instead of a 30-minute meeting, it suddenly goes for 3 hours. Then all of a sudden, if you are an investor, then it's the receiving of the ongoing communications, because often that can actually drop off. And then the other part from an investor is the one that people don't think about is if you're not interested in opportunity, but you still like it, still like the person that you're dealing with or whatever, you want to introduce them to somewhere, but you may not have anywhere to introduce them. So for me, when we've looked at this, we've realized that actual capital raising is really built on legacy systems, right? So there's no investor analytics, there's the lack of investor connectivity. Companies are using typically isolated solutions. It's mostly manual processes, often still going through, companies are still spending thousands of dollars on basic things related to sort of company secretary aspects and so forth. And it's a fragmented ecosystem. Everyone's focusing on their own, on their sort of their own area. So to me, and the way we envision what the future of capital raising looks like, it should look like the successful tech companies that it's actually been investing into in all these years. And if you think about it, what we see is that the future of capital raising is really subscription-based deal making, where it does use investor analytics, where it does utilize AI for matchmaking, where it does provide that frictionless engagement, where transactions can be efficient from start to finish, where investment banking tools can actually be digital, right? And allow for growth companies to be able to get access to what they normally wouldn't be able to with an investment bank, be able to use those digital tools online related to sort of investment banking. But the real power is, I believe, that software will lead to the ability to use analytics to create more relevance and more efficient matchmaking between investors, but also it can provide the role in actually standardizing the way in which things are done. So from a company's focus, we've always educated companies on how can you get ready? How can you stay ready? How can you always be raising, right? You may not be always taking money into your bank account, but at least always be in that process and be always basically transaction ready. And then the last one is most important for founders. How can we help founders get to the fastest yes or no possible so that no one is wasting time? From the investor's perspective, the way we've thought about things is that how can we give you increased access to opportunities? How can we help create deal relevancy? How can we help streamline and standardize your own processes for when you're looking to invest into a company? And then how can we help set companies up so that you can actually get a speed to a decision? So the way we've thought about this is, as I mentioned, via CRIISP, right? It's our capital raising intelligent investment secondary platform. The way we've built it is to be, number one, obviously software driven, ecosystem enabled, because everything we do is about, I said, bringing together ecosystems to be an end-to-end solution for the companies so that they can utilize it from start to finish, right? There, obviously engagement with investors is important, that can be done on the platform, that we can utilize data to effectively utilize data to effectively matchmake, and then take in the power of machine learning so that can be improved over time. And then effectively using analytics to understand the real potential in a deal rather than actually going blind into a capital raising as what most companies do, right? So effectively the end result is improved efficiency, faster decisions, and streamlined processes for everyone, right? Now, the digital investment banking tools that I was talking about, right? The ability to integrate with SME debt, the ability to actually syndicate deals on an online platform, book builds, Matt said the investor matchmaking component, and also even secondary sales. That's for us the vision of what we actually see. Because if you can do that from end to end, from the time you're a startup through to the time you exit, if you can take care of that capability online, you're transforming the potential of a company because it's building its own profile over time. And it's actually utilizing that data to effectively either matchmake, continuously attracting people to the actual business, right? So that when companies go into capital raise, it's not just this one hit, consumes a whole bunch of time, and then they're trying to figure out whether it's going to go ahead or not go ahead. It's just a consistent process that's really efficient and not as consuming as much time for the companies. So when we've actually thought about how we provide the access to opportunities, we've utilized the GIC standard to doing this. And you can see in this simple example how the ability to highlight healthcare, the ability to highlight biotech is really quite simple. For us, obviously, there's a lot of events. There can be an event-focused aspect to it. So we can actually either search for the company or they can drop down and there's an event that can be related to that. For the deal relevancy part, we've highlighted the key areas that investors like to look at as a starting point. In the future, we'll add more inputs to this so that we can be a lot more razor focused in the actual targeting. But this provides a really basic mechanism as far as how investors think about their opportunity. So for example, what stage they're thinking about investing, what locations they're looking at opportunities, what sectors are of interest for them, and then also typically the minimum and maximum investment. So what we will add over time is more natural language mechanisms on the sectors, like for example, AI, robotics, for example. Now for the deal relevancy, the way we've set this up is that, for example, I use the example of total blood profile in here. You can see that when I hover over total blood profile, it turns around and it highlights to me that I've got a preference match of that company with 80%. So the idea is for me to let the platform provide efficiency for you in helping you understand why a deal could actually be relevant to you. Now, if I see a deal that's relevant 80%, I want to actually understand it a little bit more. So I want to understand why it's actually a match. And in this, you can see the areas that it's actually matching with my preferences that I've already highlighted. Then if I want to take that further, you can see the way we've structured the information down the left-hand side of the screen is it perfectly caters with the way in which an investor wants to actually receive their information, right? So that overview, the overview tab then provides a high-level information for you as an investor as to help you understand why you could actually be interested in this opportunity before you request access to the deal room. In that overview, as I said, the idea is it's investor-friendly, it's streamlined, and it's standardized. So in the cues that we provide to companies, we're helping them standardize the way in which they're actually communicating with you as an investor, because often when they go to capital, they don't know the right structure in which they should be providing their information. This for them standardizes that. Now, this is a tool that we've set up for companies. Now, this is my actual deal room. So you can see if you went into my deal room, you can actually see a whole bunch of questions. And the frequently asked questions, what that means is that you don't have to ask all the questions that other investors have asked before you, right? And what you won't know is that what it does is it auto sorts them in such a way that the questions that get clicked on the most move to the top. So that way you can get an idea as far as what is the most common and popular questions being asked by investors. But once again, it's helping become more efficient in answering the questions you're most likely to have about a business. The next step is when you go to fill out a share application. It's frustrating if you've got to fill out an online one. It's frustrating typically when you're filling out online or offline ones, right? So the idea from us is if you can just put the information in once, effectively you just simply click on a tab and then it goes through the application process for you. It pre-fills it auto-fills the share applications, and that when it gets submitted, it just gets stored online. It's completely secure and it's simplified, and you've got access to it at any time to either provide to your accountants. From the company's perspective, we'll be looking to integrate that with a digital registry, so that process is completely seamless. So if companies actually have 10, 20, 30 investors coming onto their register in a year, they'll literally be saving tens of thousands they would have been spending on that process, because it's completely online and integrated. From the company's perspective, what we've done to help their communications with you as an investor, we've actually given them a flow chart, and we've templated everything at every stage. So they can literally click on something at each of these different stages, and it provides them with a template to send those communications. Because what we want to do is we want to help streamline the way in which they communicate with yourself as an investor. But also it stops their guesswork about, oh, what should I send? How do I do it? How long should it be? How much information should I attach? All those normal questions that go through a company's head, they don't need to ask that anymore, because we've standardized that process for them. And then some of the features that we'll have coming is that we can have investor relations going directly through the platform. We'll also be providing some professional service tools. So for you guys that are corporate advisors and that actually work with companies in the actual ecosystem, we want to make this as simplistic as possible for you to use, both with your companies and also with your own ecosystem of investors as well. And then the next part that obviously is the secondary sales, which we're obviously working towards. So these features will be coming over the next sort of 3 to 6 months. And the idea from our side is that we just want to streamline and make everything simple from the transaction process. So the summary from my side is what we believe the future of venture investment is, that it's subscription-based deal making. Analytics are used to help create relevancy and understand the relevance between an investor and also an opportunity. There's frictionless engagement between the company and also the investor. And also there's some sort of liquidity potential going forward. And what that does is that efficiency will help create more opportunities for both companies, investors, and also the deal makers of the ecosystem. And I said, what we feel is that the real skill that advisors make is in the way in which they do the deal structuring. But the role that technology can play is just removing all the different inefficiencies in the actual process. So I hope that's been helpful for you to understand what we see as the future of actual capital raising and deal making. I've added my details. Feel free to add me on LinkedIn. I said I always like to provide sort of tips and sort of guidance on companies that are going through the capital raising process, and obviously just sort of updates for investors as well. And then obviously feel free to register on the CRIISP site. Obviously, thank you for joining in for the Virtual Investment Summit, and I hope you got value from that presentation.
Welcome to the Angel Investors session. Our first speaker of this session is Kylie Frazer. Kylie is a founder and partner of Eleanor Venture, an early-stage venture syndicate. Eleanor Venture encourages new investors to build their own diverse portfolios with minimum check size of $5,000. Prior to investing, Kylie worked as a specialist capital raising, mergers and acquisitions lawyer and spent 15 years advising on transactions across a variety of sectors including technology, resources, agriculture and consumer products. Kylie has started and run technology businesses and has leveraged this experience to help other emerging companies secure funding and scale, including via her role as a StartMate mentor.
Hi, thanks for joining me today. I'm Kylie Frazer, the Managing Partner at Eleanor Venture. Eleanor Venture is an early-stage tech investment syndicate that makes it easy for angel investors to build diversified startup portfolios that fit within their own investment thesis. We've been going for about 9 months now, and we're already 9 deals in, so we like to move pretty quickly. We work with the big VC firms, so we can secure access to some of the most highly sought after seed and Series A investment opportunities. These are some of the investments that we've made to date. One isn't on there because it's not announced yet. And you'll see that in addition to there's 6 direct startups on there and 2 funds. We have really enjoyed bringing those syndicated fund products to our members as well, allowing investors to write small checks to access great fund opportunities like Tenacious Ventures and StartMate, which is the first time that StartMate has allowed syndication from non-mentors. I've been asked to talk about what's going on with seed investment and coronavirus. And the last 6 weeks have been pretty busy, certainly over here at Eleanor, and I'm sure for many of you too. Lots of work with the portfolio, working through various scenario plans and extending runways, to 2 years. Runway extension is, unfortunately synonymous with cutting costs, and in startups, cutting costs it's very hard to do that without losing talent, which is always tough. We've been really lucky at Eleanor, as we're only a 9-month-old syndicate. Our portfolio have all recently raised, so that was certainly easier for us than for many others. Sharing some tips on what I have learned from many conversations with founders, both within the Eleanor portfolio and my own personal portfolio over the last few weeks, being really clear on what their intentions are for future capital needs. If they want to raise capital from external sources in the future, they need to make sure they save some cash to accelerate growth at the end of any hibernation period. Investors will be very forgiving of hibernation periods given the current climate, but what they will want to see is that growth can be turned on before they write a check. So you need to make sure that your companies, if they do want to raise, not just survive through the hibernation period, but have enough capital to turn growth back on when they need it. Second point there, green hat thinking for the Edward de Bono enthusiasts amongst us. Don't forget the optimism. Angel investing is about believing in the impossible, and you've picked these founders because you believe in their vision for the future. Don't snuff that out. There's no need to kill the golden goose. A lot of us will be, as investors, will often be the most experienced, the most seasoned, the most cynical, some might say, people around the board table. And it almost feels like it's our duty to be the bearer of bad news, to make sure those runways go for 2 years, to cut the cost, to manage to that bottom line. And that's part of it. But don't overcorrect, don't kill the magic. You have to, if you still can't see that beautiful future, then, that's probably overcorrecting with the negativity isn't going to get you there. And finally, the importance of peer networks. It's all very good to spend time with your portfolio, and it's a great thing to do, obviously, but don't underestimate how important it is for them to spend time with each other. And this is where having a portfolio is so beneficial, because you can get them to speak to each other. There's always a power imbalance between investor and founder, and there's things that they just aren't as comfortable sharing with you, and lessons that we haven't been through, right? Like we're sitting at the other end of the spectrum. So one of the great things that I've had the privilege of being part of during lockdown has been seeing those bonds develop between my founders, which has been great. They've been fabulous for each other. So thanks, guys. So what's next? Are we open? What's going on with seed investing? We are very much open. My friend at StartMate, the CEO, Michael Batko, put it very eloquently recently when he said, don't try and time the market, plant seeds instead. I'm not sure it has to be instead. I'm sure there's room for both of those things, because timing the market can be fun in other parts of the portfolio, but it's really not relevant at seed. These are long-term investments. So if you're investing with a 7 to 10 year plus horizon, a bit of market volatility, a lot of market volatility in years 0 to 2, it's not really going to make that much difference towards the end. So we think it's still a great time to be investing in seed, which, we would say that because that's what we do. But we're in pretty good company. Some of the greatest angel investors of all time have come out saying now is the time to keep going forward. People like Jason Calacanis, Chris Sarker. And if you look at how they invested through the GFC, you'll see that they're not just preaching empty words. This is how they built their fortune. Some of the most valuable companies that we have today in Silicon Valley, companies like Slack, Pinterest, Uber, these were all founded in the years following the crash of Lehman's. And I don't doubt that we're going to see some more great companies coming out of these times as well. And I hope that Eleanor Venture and some of you are along the journey. A lot has been said about venture capital drying up in 12 months from now. And the data that's been pulled showing venture capital deployed after the Lehman's crash supports that, as you can see from this graph. But what we haven't really spoken a lot about today is how angel activity correlated during that time. And you can see from this graph, which is the black line is the number of angel deals in the time period after the GFC, and the light grey bar graph on the x-axis down the very bottom shows the volume of angel capital deployed. While it's true that venture definitely decreased and hit its lowest point 12 months after, angels not so much. In fact, angels showed a steady increase by number of deals. The volume of capital dropped off a little, but nowhere near the same extent of what it did with the funds. And I think what that shows is that sophisticated investors know that the rules don't change with market fluctuations, not when it comes to seed investing. The trick is to keep a diversified portfolio. Don't make big bets, make lots of little bets. Jason Calacanis built his reputation and most of his fortune off the back of a $25,000 investment into Uber that he made, just not long after the crash of Lehman's. However, there's always a however. That doesn't mean that things are completely the same. We've gone out to our network saying that we are now putting these additional screens on new portfolio investments. Can the company acquire customers in the current climate? We're not in the business of funding companies through hibernation. If companies are in hibernation mode, they can come back and get capital when they're out of hibernation mode. They don't need to sleep with my money. That's not fun. Is there 2 years runway or a shorter path to profitability? Because we do predict that follow-on funding for Series A and below will be harder to access in the next 12 to 24 months. And is this product still as relevant in a post-COVID-19 world? And what is a post-COVID-19 world? Isn't that a fun thing to think about? I'm going to decline from positing any views on that in this call. I think that could come back to haunt me. But what I did do is I went back to our 2020 investment themes, which we published in January. And I think they look pretty good. There's not a lot that I would change from our initial outlook for the year. Capital efficiency remains more important now than ever. And it's not just because times are tough and capital and equity investment is going to be harder and harder for founders to obtain. I like capital efficiency all the time because I like balanced cap tables. I don't want founders to raise $1 more than they need to because I like I always like the effort to be aligned with the incentives. And if you have an unbalanced cap table where investors have more and founders don't have enough, not only do you make it hard to raise further rounds, but your founders aren't going to be there in the trenches when you need them to be. No one wins. So we like to keep things very aligned, and capital efficiency is the easiest tool to do that. Sustainability in supply chains. When we wrote this, we were more thinking about the importance of visibility into supply chains, driven by things like the Modern Slavery Act and a trend towards environmental sustainability and more generally. Now you've got the additional lens of supply chain security, which is going to make supply chain an even sexier area to invest in, which delights me. And the last one, privacy and consumer data rights. Again, it's going to be huge. We've all seen the enormous download? What's the uptake in downloads of the COVID Safe app that the Australian government has put out? That is perhaps indicative that consumers are willing to trade short-term privacy concerns for long-term public health interests. You've had the bizarre situation when Europe, normally one of the great defenders of privacy rights and the architects of the GDPR system, are lobbying the tech giants to enable tracing apps. That's just, who would have thought that would have happened? So all these developments means that the tech that underlines privacy concerns is going to be so much more valuable and super important in the period to come. So I'm happy with my investment themes. If you're a startup who's listening to this, come and see me if you're working in those areas. The only thing that I would add to that in thinking things forward is I think it's going to be tough for consumer for the next 12 to 24 months. So we would probably keep the focus on enterprise until we see what's happening in the macro trends. Alrighty, I think that's it for us today. I think I'm going to Q&A shortly, but if I don't answer your question, feel free to hit me up in the email directly. Thanks very much.
Thank you, Kylie. Our next speaker is Jordan Green, a founder and leader of the Melbourne Angels. He's an internationally sought-after thought leader, author and speaker for early-stage ecosystems. Jordan is an advisor to governments developing angel ecosystems. He's a founder and chairman of Emeritus of the Organised Australian Angel Investor Community. He is a chair of the Asian Business Angel Forum, a trustee of the Angel Resource Institute in the United States, chair of an industry advisory group to the University of Melbourne, where he is an honorary fellow, Victorian chairman of the Piercy Foundation, an avid serial founder, successful venture capitalist, and always an electronics engineer and an eternal optimist.
Hi, I'm Jordan Green from the Melbourne Angels. So what's going on in this crisis today? Well, I'm a bit of a contrarian, but I'm also an optimist. So the world is rushing down, standing away, going backwards, and I'm still forging ahead. Look, I'm never really overly concerned about how to lose money when I make an investment. I know all the ways that I can lose. I've experienced most of them more than once. The real skill is seeing how to succeed. I don't want to delay to follow others into an investment. I like being in the first round of investment. I do want company. I want other minds focused on this opportunity to bring their experience, expertise, and networks to assess and assist the opportunity. That's why I started the organised angel community in Australia and continue to lead Melbourne Angels. I never invest because of fear of missing out. That is just foolishness. Fear is a very poor basis for judgment. My focus is on finding exciting new ventures and ideas, sustainable disruption that creates new, sustainable and scalable benefits. Be wary. Disruption that destroys value is not a good investment. And of course, right now in the crisis, I'm busy virtualizing and automating the operations of Melbourne Angels and all the other organizations that I work with. Now, there are some opportunities that have been born out of the crisis. We see a broad need for increased self-reliance in pretty much every country, every region, every continent. And we're starting to see some of the excesses of globalization that have taken us too far and put us in difficult circumstances. And then at every level, we're seeing that the shaping of the just-in-time supply line right down to the finest, most efficient economic performance has actually left us with very little resilience. All of these represent interesting opportunities. Now, investing in startups is changing as the nature of startups and company growth is changing. More and more people are starting companies with the hope of winning the lottery of success, and more investors are entering the fray with exactly the same motivation. Many of the new investors are building revenue-based business models around their investment ambitions by providing a range of paid services to founders and to established companies. Positioned as champions of innovation and creativity, these service providers are commoditizing startups and pursuing a somewhat simplistic numbers game investment thesis. For the most part, they are just peddling the same models, methods, and practices as everyone else. In a world with way more people than jobs and a rapidly growing divide between the wealthy and the rest, we need to re-examine the path to success. What is success? One thing I think we can all agree on is that jobs matter a little bit less than teams. What are we doing to support our portfolio? Well, for angels, it's mostly business as usual in that regard. We have to provide the moral support for our founders who have the need to struggle in this environment, who are challenged by the overwhelming changes that we're going through. And we have to provide the morale support as the founders have to figure out how to make the really big decisions. We are always offering a safe haven for our founders, a place where it is vital that they can come to seek and explore, to get coaching and help them find the right changes to make to their strategy and execution. And by sharing our experience of having weathered economic shocks in the past, we can help them even in this particular crisis. It's important to remember the startup journey is always Darwinian. There are many businesses, not just startups, with business models that were never going to work. But they were buoyed up by the optimism and inexpert investors that exist in the bubble times that we've only just left. No one should be propping up those businesses. They had already failed. They hadn't confronted that reality. But we do have to make additional investments in our portfolio companies. But as always, those must be dependent on the actual offering for each round. There must be a compelling reason to invest. Life support for its own sake is not a smart investment for anyone. Now, the word is out. Now is a great time to be making investments in startup companies. My best Australian startup success was invested in the dot-com bust and delivered a 34 times return. My best ever was invested in the Asian financial crisis in the 90s and delivered 100 times return. Back in March, I wrote to our members and to other angel investors around the world about the counter-cyclical nature of startup investing and the great opportunity presented by this crisis. I published a version of that in April on Medium and LinkedIn if you want to have a look. The timeliness of this opportunity is better known this time around. That and the quintessential optimism of founders means that there are still, we as investors are still facing the challenge of cutting through the noise to find the quality, to find the best opportunities that fit with us. At Melbourne Angels, we don't have a specific sectoral focus so much as an opportunity focus. We want companies with a compelling and novel solution that's satisfying an unmet need, for which there will be an abundance of customers willing and able to pay. What's the world going to look like post-crisis? Okay, well, how things will play out for you will depend very much on who are your customers, your target customers. Initially, consumers and businesses may not be all that different because the individuals making the decisions will be more strongly influenced as people than as managers. When we believe the pandemic is over, there will be a brief blush of experimentation, a time when our resistance to change is very low and our search for a path forward is unfettered. It may only last days or weeks, so your business can take it. If your business can take advantage of that, get ready now. Right now, most people and organizations do have very low barriers to trying something new, especially something digital and low risk. So again, if your business can actually gain customers during this pandemic, act now. Longer term, there are likely to be persistent policies that foster a greater degree of self-reliance, as I referred to earlier. And that self-reliance will sort of be on each continent. So for Australia, it's quite unique. We have the whole place to ourselves. Origination and distribution of products will be balanced against the disruption of supply chains. We may avoid having another world war, but we will almost certainly have more pandemics in our lifetimes. Similarly, when we restrict our movements or lose critical skilled personnel, our vital infrastructure becomes unreliable and possibly unsustainable. More effective and agile automation protects us from those outcomes, and that automation will demand greater security. These are trends already in evidence, but they will accelerate. That acceleration will drive another existing trend, the changing nature of work. The 19th century model of a job will persist, but fewer of us will be able to enjoy that kind of job security. The 21st century model of work will require very different forms of remuneration, banking, insurance, childcare, aged care, transport, hours of operation, mode of communication, incentives, leadership, social structures, and so much more. In the future, our skills will get us work, but they may well not get us jobs. Now, if you're currently investing, I'd like to caution you not to fall prey to this idea that you have an obligation to pour more money into failing companies. Your only obligation is to make investments you genuinely believe will be successful. So the key question, as always, is what do you need to believe to invest in this company? If you've already been investing in startups, then you have formulated an investment thesis. It may be a very formal and analytical thesis, or it may be more a seats of the pants type approach. Now is not the time to doubt your considered position. You must be open to adapting, but don't break your own model. While the power in the deal is squarely back in the investor's hands, don't take advantage. Don't be greedy. Remember what your thesis says about the best terms of investment and stick to that. Remember, your perspective was formulated for the life of your investment, and this crisis is only temporary. Don't cripple your own strategy. For those choosing deferred instruments like connotes and SAFE, consider your actual expectations. What do you expect the value inflection points that trigger the next round to be worth? Do you expect your companies to only appreciate in value by 20% between now and their next round? Or perhaps you expect them to double in value. For the latter, you're going to need a 50% discount to the next round, or a combination of discount and cap that gets you there. Don't miss out on your risk premium. This isn't greed. It's what you are buying with your money. just as the founders must consider when buying your money with their equity. So what do the successful opportunities really look like? Well, here I'm just going to speak for myself. My preference is for companies that are developing truly distinctive technology, an enabler that empowers other companies to do better or faster or cheaper or all of the above. These are the companies most likely to be able to achieve a strategic value exit based on genuine, defensible, and sustainable value creation. I'm less interested in ventures focused on capturing millions and millions of customers at tiny little margins. These are mostly headed for financial value exits at best. That means investing a lot of time and a lot of money in growing very substantial revenues and profits. That is usually a long journey, and the longer it is, the more it will cost and the higher the risk that it fails along the way. Founders who want to restructure an industry, supply chain, or distribution chain may only be a business model innovation. To succeed, they will need to have both a deep, insightful understanding of the status quo and privileged, advantaged access to dominant players who can drive adoption of the new version of the industry. So what does this look like? People I like and want to help who are trying to do something that's really worthwhile. So that does mean they need to be ethical, they need to be passionate, they need to be insightful in how they're going about things, and they must have the personal and leadership capabilities to get the job done and the relentlessness to see it through. So I'd like to introduce a simple view. The only failure is failing to learn and do better next time. Don't be afraid of failing, because everything you learn is the next step towards success. Thank you very much for your time. And if you'd like to reach me, these are my contact details.
We are now going to move to the healthcare session. Please welcome our first speaker, Dr. Joseph Mocanu. Joseph is the managing partner of Verge HealthTech Fund, focusing on early-stage healthcare technology companies relevant to emerging markets. Prior to this, Joseph was a scientist researching new cancer therapies, a medical device entrepreneur, and a management consultant for Oliver Wyman, where he led life sciences and digital health across Asia. He has 19 scientific publications, 3 patents, and has made investments in 17 healthcare technology companies to date.
Thanks so much for the opportunity to present today. I'm Dr. Joseph Mocanu, Managing Partner of Verge HealthTech Fund. And before we start talking about the implications of in healthcare investing in COVID times, I want to quickly provide a little bit of context in who we are and how we look at healthcare investing. Briefly, we are the world's very first seed stage only venture capital fund that invests globally in health tech solutions relevant to emerging Asia. We've been around for about 1.5 years. We're Singapore-based and licensed, and we are ex-founders, angel investors, scientists, and industry insiders. This gives us a tremendous network of multinationals that help partner with our startups from the very start to the very exit. We have 8 portfolio companies to date out of 15 to 20 target. 6 are directly relevant to COVID, and 2 are actively helping today. Despite being quite early in our investments, 3 are already revenue positive. We've had 1 up round and 4 are raising their next rounds. Before this fund, we were doing this with our own money for about 5 years, where we nearly tripled our capital and touched over 3 million lives in the process. Actually, sorry, I wanna restart. I forgot to do something. And my sinusitis is getting
Not a problem. Actually, I've just noticed that your camera is a little bit too far right on your side. Can you position it? Oh yeah, perfect. Yeah, if you can do that, that's slightly more to your left.
Oh, so you want me to be in the center, because I saw the kind of like the wholesale investor guide says that you should kind of like stay to the side and look here. But
no, it's fine. Like yeah, this is perfect. Like this.
Okay, one sec. Let me move this chair behind me so it's hiding as well. Although I kind of like the computer monitor. There we go. That's a good mix. Yeah, okay. That's great, because I always thought it was kind of weird that, you know, you're staying off to one side.
Yeah, okay. Yeah, exactly. Perfect. So whenever you're ready.
Yeah. Sorry, I'm just, for some reason, I'm just like really congested today, which kind of sucks.
Oh, no, but you sound really good. So you sound well.
Okay, cool. Thank you. I don't want to restart again, so I'm going to go through it regardless what happens. I just really forgot about, you know, an important point.
No, that's fine. That's fine. If any time you want to start over, there's no rush.
Okay, cool. This is the only sell slide. Everything else I'm talking about industry.
Okay, cool. No worries. Okay, I'm muting myself. Good luck.
Okay, thank you again. Okay. 3, 2, 1. Thanks so much for the opportunity to present today. I'm Dr. Joseph Mocanu, Managing Partner of Verge HealthTech Fund. And before we talk about the implications of healthcare investing during COVID-19, I want to really quickly provide you some context on who we are and how we look at healthcare investing. Briefly, we're the world's very first seed stage only venture capital fund investing globally in health tech solutions relevant to emerging Asia. This allows us to take advantage of a triple growth strategy: growth in Asia, which is the largest transfer of wealth in recent history; growth in healthcare, a robust industry that is growing with our lifespans; and then growth in startups themselves by getting in early at low valuations. We are Singapore-based and licensed. We've been around for about 1.5 years. We're ex-founders, angel investors, scientists, and industry insiders. This has given us a fantastic network with global multinationals to help partner with our startups from the very beginnings to the exit. We have 8 portfolio companies so far. 6 are directly relevant to COVID, and 2 are actively helping today. Despite being early, 3 of these companies are already revenue positive. We've had 1 up round, and 4 are raising their next rounds right now. Before the fund, we were doing this with our own money for 5 years, where we nearly tripled our capital and touched over 3 million lives in the process. We see Asia as having both the greatest opportunity and need. There are almost 4 billion of us here who are getting older and sicker, but also richer and more informed. This is driving demand incredibly high. And we are missing almost 7 million doctors and lack a lot of the physical infrastructure in order to meet this demand today, let alone tomorrow. We think that technology is at the core of closing that gap in demand and supply, and we'll look for technological solutions all around the world as long as they are relevant to Asia. We invest across 3 primary areas: prevention and healthy living, disease monitoring and management, and health system efficiency. And here are some of the specific applications that we look at. When we do look at a new startup, team is the most important thing. We look at technical, clinical, commercial experience and expertise, but not only that, a healthcare startup is really difficult, more difficult than most startups. So we have to make sure that they're really mission driven, resilient, and pragmatic as well. We also want to make sure that it is a real unmet problem, being one that is systemic, that can affect potentially tens or hundreds of millions of lives. A really serious one, be it life or death, or seriously debilitating, or tremendous gains in cost, quality, and efficiency. And it has to be relevant to the health systems to which we serve. Lastly, there needs to be a competitive edge, be it intellectual property, proprietary network and relationships, or a novel and defendable business model. Lastly, we have to make sure that we get along with the founders and work well with them, because we're going to work with them hand in hand, trying to make sure that we can value add as much as we can. said we're early, and the reason for this is that most health tech deals are Series A or later versus other industries. This means that you have a lot of capital piling into relatively fewer deals, driving up price. Our first rule is to get a good, attractive valuation, which we have by investing early and really, guiding them hand in hand, already adding value. And these are some of the things that we've already done for our companies. And then this happened. We have a global pandemic, which lets everyone in the world understand what a supply-demand imbalance in healthcare looks like. On a more positive note, after decades of waiting, we are finally entering this age of digital healthcare, beginning with telemedicine, which is really around remote consultations and e-prescription/e-pharmacy. Now, being a proud Canadian, I need to quote one of our great philosophers. So where's the puck gonna be? What's next? If you aren't already invested in some way in telemedicine, are you too late? Are you already priced in? So then the question is, what does telemedicine need to be better? How do you improve accuracy? Because right now you're really on glorified Skype calls with your doctor, but they're still asking you questions. So how do you improve that accuracy? Could it be inexpensive medical devices in your home that measure your lung sounds or measure your blood glucose or measure your temperature continuously? Could it be that? How are you going to pay for all of this? You've got new financing and reimbursement models. How are the incumbents going to deal with this? And you're still fundamentally doing the same thing that you were doing in the real world, but now digital. You have a problem, you consult your doctor, and hopefully the doctor fixes that problem. But in this day of 5G and IoT everywhere, why aren't we continuously monitoring our vitals, looking for the slightest perturbation or thing out of the ordinary that you can then intervene with before it becomes a big problem? And then with all of this data flying around, how do you make sure that it is secure from hackers, that it is actually truthful and not altered, as well as with all these different pieces in the supply chain, that they're all communicating in the same language? The part that gets me really excited is that you now have the opportunity to bring healthcare to places where it wasn't before, be it rural communities or remote islands. You can now, because you've separated data collection from decision making, have the ability to really provide care in these frontier places. And it's unsurprising as a healthcare fund that invests quite early that a lot of our portfolio is really relevant to this new normal. So what does it mean for the healthcare industry in a broader sense? In the past, in our lifetimes, we've really only dealt with economic depressions, but this is something that's completely new. We're dealing with a biological, psychological, and economic depression all happening at the same time. And maybe I'm a little bit melodramatic here or extreme, but I think we're actually closer to World War III, where everything is disrupted, rather than a great financial crisis, which saw healthcare and life sciences emerge relatively unscathed. So what does this mean in the near term? It means we can obviously have a rise in telemedicine. Being cooped up in lockdown with uncertain professional and personal futures, there's going to be a great demand for mental health as well. Given we are dealing with a pandemic, of course, critical demand goes up. And then anything related to coronavirus R&D, be it a vaccine, a therapeutic, or a diagnostic, is also going to get a lot of attention. Now, that knee implant or cosmetic procedure that you had planned, that's not going to happen. That's being deferred or delayed until this crisis blows over. And similarly, private practice physicians are getting crushed for the first time. Their revenues are down. Some of my personal friends are seeing revenue collapses between 75 and 90%, which is just a disaster. And because you're dealing with a pandemic and some of those frontline workers are getting sick, you are seeing an overall reduction in healthcare capacity. And then lastly, if you're running clinical trials or doing R&D and it's not related to coronavirus, that's gone on ice. So what does this mean for startups in the near term? It means that investment has gone down by and large, especially at the angel stage, because your angel investors are largely these private practice wealthy physicians who've seen their revenue collapse. Investors want optionality and choice, so they're holding on to their cash, which overall results in round sizes shrinking. And because it is now a buyer's market, valuations are going down. And of course, there are delays everywhere, be it R&D, manufacturing, business development, or next funding rounds, because of the friction involved with having to do everything remotely and some things being even shut down. on a more optimistic note, if you are relevant, this is an unprecedented time of rapid adoption, experimentation, and innovation. And you still see some investors quite active. Large funds like Optum are still investing, and of course, small funds like ourselves are still investing as well. The challenge happens if you've got all these great opportunities for growth, but if you have difficulty scaling because you can't get your factories to go online or you can't do your BD efforts, that might mean you have missed opportunities. And so what does it mean for investors more broadly? In the near term, chaos and uncertainty, optionality is key. And that means holding on to cash or investing across a portfolio instead of making a couple of sharp bets. You're going to have a lot of people promising the world to you, so be sure that you have the clinical facts and evidence in play before you make a big decision. A lot of snake oil will be out there. And if you've already invested in the space, because of potential delays, you need to have a lot of patience, as well as suss out your current co-investors to see whether they're willing to come in on an internal round potentially if the startup isn't at a place where it needs to go external. And then lastly, you're going to see a lot of cheap deals out there, but that doesn't necessarily mean they're good. And then the other thing is, when you're about to make an investment, is that enough of an investment to take them to the next level? Because if you're counting on another investor to pick up the slack, to pass the torch to, they may not exist in this climate. In the midterm, we're going to probably see a surge in demand because of those deferred procedures that couldn't happen during COVID are still going to need to happen. That knee's still going to hurt, and maybe you still want to look better. So those things will still come back. The question is, will they be sustained versus the level they were at before? You will see a Cambrian explosion in health tech because this will be the hottest sector because it's going to be on everyone's mind. So everyone and their uncle is going to do a health tech startup. And then the systems themselves may start shifting to efficiency and capacity, shocked by what just happened rather than new discoveries. Then in the long term, you might see a reversion to the mean. So healthcare demand is still massive and growing across all sectors, and we don't expect that to change, especially in emerging markets. You'll see a Cambrian extinction. All of these crazy ideas that came up in the near to midterm, you'll see consolidations, and some of them unfortunately will not make it. And then lastly, healthcare systems may ask themselves, geez, should we have invested more in prevention and population health management as opposed to big infrastructure and acute care? So this is what I predict might happen. Happy to take any questions over the YouTube chat, and thank you again for your time and attention. Have a great day ahead.
Thank you, Joseph. The next speaker in our agenda is Sarah Meibusch, a principal at One Ventures. Sarah is responsible for sourcing life sciences companies and actively shaping their future. She applies her global executional experience and entrepreneurial passion to nurture their success. Her enterprise-level leadership experience has been forged over 20 years in a wide spectrum of organizations, including startups, private companies, ASX and Nasdaq listed companies, a multinational pharmaceutical company, and university research organizations. Sarah identified technologies and developed collaborations across Japan, Korea, Australia, New Zealand, Singapore, and Taiwan, including playing a key role in sourcing the $300 million Fibrotech deal announced in 2015.
Okay, thank you very much for the opportunity to talk to you today. I come from One Ventures, as I was just introduced, and I'd like to talk about three things today. First of all, give you some background on our firm, One Ventures. Secondly, talk to you a little bit about the healthcare part of our firm and how we invest in biotech and medical devices in our sector. And then lastly, I'm going to touch on some of the impacts that COVID-19 has had on our business, and then try to extrapolate those to have a look at what's happening in biotech venture capital investment worldwide, and what might be the future. Bearing in mind that I don't have a crystal ball and none of us do, so some of that future-looking aspects are really, we're very early in the process, so it's too early to tell. So let's just go through One Ventures in the first instance. So we are an Australian-based venture capital firm, and we invest in technology and healthcare investments. We have about 400 million in funds under management. We were founded, and what sets us apart from many VC firms is we were founded by founders. So the three managing partners who I'll talk about in a moment, each of those had their own companies and have built and exited them, and that separates us from many of our peers. We're also, the other separation from many of our peers is our LPs are all high net worth individuals, and they all have a passion for investment in innovation, whether that be in tech or in healthcare, and are really supportive of our investments. These are our funds that we have under management, and one that we're actually raising at the moment. So the first fund was Fund 1, launched in 2010. That was a small $40 million fund. Fund 2 launched in 2014, $75 million fund, another closed-end, both of those closed-end 10-year funds. The healthcare fund, which I'm going to talk to you a little bit more about as we go through this presentation, is all focused on healthcare. That's $170 million Fund 3. We've made 6 investments to date. We probably have room for about 8 to 10 investments, and that's in year 4 of a 10-year fund. Last year, we launched a venture credit fund. I'm not going to talk about that today, but certainly at another time, happy to have our venture credit team come back and talk to you about that fund. It's quite different and unique in this environment, and is doing really well, especially at the moment in these times of coronavirus. And then we're also launching Fund 5, and it's got its first close probably Q3 of this year. And they're looking at investing up to 200 million in probably only 6 to 8 companies. So it's really a growth stage venture fund, that one. And that'll have mostly a technology focus to it, because they're looking at companies that have probably greater than 5 million in revenue. And then, as I said earlier, our high net worth investors that invested as LPs in One Ventures are very supportive of our program, and we have about 65 million of additional co-investment funds under management, where we've done rounds into some of our portfolio companies, and they've decided to double down. These are some of the names of the companies that we've invested in, and some of them may seem familiar to you, and they go across all of our funds. This slide here shows our team at One Ventures, and as I mentioned before, the 3 managing partners that formed One Ventures were Michelle Deeker, Paul Kelly, and Anne-Marie Burkle. Michelle may be known to some of you, but she's really well known in the technology entrepreneurial sector. She formed several technology companies before she founded One Ventures. Most well known of these was a company called giftvouchers.com or Ecom Industries, which she exited in 2005 and had about a 70% IRR for the investors that invested in that fund, in that company, sorry. Paul Kelly, the head of our healthcare for part of the business, he's an endocrinologist by training, and started his first biotech foray was in the mid-90s in the UK, and then later in the US. And probably his most well-known company that he founded was a company that started in the UK and then IPO'd and then was bought by Sequinome in the early 2000s. And then we have Anne-Marie Burkle, who's founded many companies, particularly in the Queensland ecosystem. She's very well known as having sat on many boards of those startup companies, and sits and is well known in that ecosystem for also being the founding CEO of one of the first incubators, probably in Australia, but definitely in Queensland, called iLab. And the fourth partner just recently has been promoted to partner is Grant Chamberlain, and he's heading up Fund 5 that's just going out to raise money at the moment, and was formerly the head of M&A at Merrill Lynch in Australia. So I'm going to talk now. I won't go through the rest of the people in our team, but I guess to say that really we have a very hands-on approach. And so many of the people in our team have got hands-on experience managing companies, and that's really where we try to lend our hand. We're in the companies that are really growing fast, and they need resources around the boardroom table, and at times we step in and take management roles or bring in management to help those companies succeed. In our healthcare team, you can see I'm sitting there. We've got Paul Kelly heading the team. John Westwater's just recently joined our team. He was previously CFO for a company called Elastogen that was sold to Allergan a couple of years ago. We've got Gabriel Duvel, who assists us, comes from a commercial pharmaceutical background, and then two venture partners based in the US that we lean on a lot. The first is a guy called Dr. Dan Baker. He was the head of immunology at Janssen, which is Johnson & Johnson's research arm, and helped bring 3 monoclonal antibodies to market, led those Remicade, Stelara, and Simponi that together are worth about $13 billion in annual sales. And then the second person we lean on quite a lot is a guy called Jim Scoper, and he's a venture partner at One Ventures, but brings about 20 years of venture capital investment at a firm called MPM Capital, one of the largest biotech VCs in the US. Fund 3, I said I'd talk about our biotech fund and what we look for. We've got about 170 million under management. It's a closed-end fund. We're in partway through year 4. We look to invest 10 to 25 million per company and look for companies that really are at or near clinical development. They need to be therapeutics, medical devices, or diagnostics, and that's as measured by as if they were to be approved by the FDA under those categories. And so we don't typically invest in areas around allied health or areas that, like e-health. We're really more focused on therapeutics, devices, and diagnostics. We look for technologies that have got a really strong market pool. They need to have an unmet medical need that we're solving here, and it needs to be competitive. Ultimately, we need to be able to exit these companies within our fund horizon. So they've got to have a really clear development path. They've got to be able to be approved in a straightforward way, that clinical trials have got to have endpoints that can be measured and easily understood. And the products also need to have a reimbursement strategy in place. And this is even more critical for companies that sit in the device and diagnostic space, where reimbursement can sometimes be really, really important to getting market traction. And those companies are typically sold with market traction. We like always to invest with people we can work with, and those are some of the very first early criteria that we look for in investing in a company. And lastly, I wanted to talk to you about what the impact COVID's having on our business, and then more broadly what it's having on the biotech VC as a whole. So I think it would be fair to say that the first 4 to 6 weeks of this, and it's just sort of starting to settle down now, we spent our time, as I think virtually everybody in our biotech VC space worldwide spent their time looking at their own companies, shoring up the balance sheets of any of those companies that needed either to have extend their runway through maybe a bridge financing, looking at their liabilities and ensuring that they have at least 12 to 18 months cash in each one of our businesses. And that's been a big process. Some of our companies were right in the middle of going out to raise a Series B or a Series C. And so we need to do some internal rounds. We need to extend and see how those companies can survive this economic challenge. The other aspects that are important in our portfolio, as are important in most biotech portfolios, are companies that have got delays in most of the R&D that's going into this space. The delays are around things like clinical trials. I saw a report earlier this week that 41% of clinical trials that were ongoing on the major database, clinicaltrials.gov, have either moved to suspended or abandoned in the last month. That's a huge number of clinical programs in diseases outside of COVID that are no longer recruiting into clinical trials. And that's because patients can't come into hospitals. There's all sorts of risks around doing those sorts of clinical trials at the moment. So we're seeing delays across the board in clinical trials. We're also seeing some delays in terms of lab activities and manufacturing processes. In some instances where resources are being diverted to the COVID pandemic, and in other instances where actually the lockdowns have reduced the capacity of people to go into work and actually deliver the experiments they need to deliver. And that's dependent on where our companies are being based and whether they've been deemed as essential services in those areas, and of course the risk profile of the employees in those companies. So the first 4 to 6 weeks was really assessing what are the risks for each of our companies and how are we helping them manage them. And I think in large part it was focused on shoring up the balance sheets of our current portfolio. And I think if we talk to our peers and our syndicate investors, that's really what they've been focused on over the last 4 to 6 weeks. We've just now started moving into screening new opportunities. We still need to fill out our fund, as do many VCs worldwide. And in fact, there's more venture capital available in the biotech space than there's ever been before, both in Australia, but more importantly, internationally. In the last 3 years, more capital was raised than raised in the previous 7 years combined. So there's a lot of dry powder out there, and there's going to be a need to invest in biotech. So deals will continue to happen. We think in the medium term, as I said, investments will continue, but biotech investors are going to be very cautious about investing in programs that immediately need to recruit into clinical trials that will struggle. So we'll be looking for programs where we can continue to advance those programs and areas where clinical trials can continue, such as healthy volunteer studies here in Australia and aspects like that. As we look to the long term, if I had a crystal ball, I'd love to be able to tell you where we think it's going to go, but we do think that biotech should fare better than other sectors. We certainly have had a lot of focus on our sector during this crisis as people look to science as being a way to solve problems like this. I think that also, biotech people still have unmet medical needs. We're pre-revenue generating in large part, so we're not driven by consumer demands and retail spend. Our supply chains will be impacted and will probably be impacted in the long term, but we do believe biotech will fare better than most other sectors in the long term. And then lastly, we all look to what are the biotech exits going to look like. There are still some IPOs, amazingly, that have got away in the US in the last few weeks. We suspect those were definitely well into the pipeline prior to coronavirus. We do anticipate those IPOs will slow over the summer. And I think, if I looked at a Silicon Valley bank series of blogs over the last couple of weeks and looking at Endpoints, one of our key industry newsletters, a collator of media, I think that it's pretty clear to say that we'll move from IPOs probably into more deals being transacted where pharma companies are buying smaller companies, and that will represent our exits over the next probably 12 to 18 months, more so than IPOs. But if I had a crystal ball, I'd love to be able to explore that and know exactly where we'll be. But really, we feel strongly that the biotech investments are an area that will continue to grow. We know that clinical trials will come back on. We know that other areas of business like lab function in many places are seen as essential services or moving into that place, and they'll continue. And so we really are pretty upbeat, both about our portfolio and about the world biotech VC industry as a whole. So thank you very much.
The first speaker in our property and fund session is Eric Gao. Eric is the founder and CEO of BMYG. Eric founded BMYG in 2010, a wealth and investment management for Australia and China, specialized in alternative assets, especially in fintech and digital economy. BMYG's subsidiary, Alfin.com, is the leading Chinese financial portal in Australia. Eric is highly regarded as an opinion leader and expert in Australia-Chinese investment relationship.
Good morning, everyone. It's my absolute pleasure here today to discuss some of the opportunities we see in the market and how do we think about China, especially after the pandemic world. So today, I think in the next 10 minutes, I wanted to introduce BMYG to all of you, discuss what we do, and some of my advice to investors and also companies after this whole pandemic thing. BMYG, I'm the founder and CEO of BMYG. We started back in 2010 with a mission to help Australian business with Asian capitals and also the market opportunities. Our vision is to help investors with borderless wealth and also to unlock unlimited opportunities. Along those years, we have set up the business mainly focused on wealth and funds management. We currently manage over $300 million. Our clients are typically high net worth individuals and their families, especially with Asian backgrounds. We currently have a team of 35 with offices in Melbourne and Sydney. And we have a fantastic financial media business in Chinese language with over 77,000 social media followers. And currently we have over partners and clients over 20 Chinese cities in China. Just in a nutshell, there are 4 business units we have. We do funds management, we do wealth management, we do a bit of advisories, and also we have a trustee service for funds managers. Those are some of the funds we have run in the past. I think the funds pretty much have 3 different categories. We have a credit funds. The credit funds make investment into property credit and also some fixed incomes. We have equity funds. Currently, there are investments in IPO and pre-IPO deals. Technologies, which is something we do for a very long time, which is something we like. A lot of my personal investment goes into technologies as well. We also have a venture capital and private equity fund of funds. We make a direct investment into other Australian funds managers. We also have 2 US dollar funds we set up. The first one was a direct investment into Airbnb. And the second one was a direct investment into a drone technology company based in China called DJI. This company has 70% of the consumer drone markets globally. Those are some of the deals we invested in the past, from listed companies like Medibank to unlisted company like Wholesale Investor, which is still happen to be one of my favorites. I'm pleased enough to be on the board with Steve Torso and his team for the last nearly 3 years. Just a very quick one on the other brands we have, Allfin. Allfin is like a financial review, but in Chinese language. As I mentioned, there are 77,000 social media followers, and we cover nearly 2 million visitors on the site and the social medias. Today, I think what I'm wanting to really talk about is some strategies we think after pandemic. There was a lot of articles, I think, talk about what's the world is going to be look like, and also the world pretty much got into a new order after this whole pandemic time. But I think there's one thing we believe strongly, and also we share a lot of the beliefs by Square Capital, Blackstone's, Goldman Sachs, and etc. That is long China. I think China has become a different country in the last 10 years. I'm going to share with you some of the numbers, but you can clearly tell that China is surely in a different shape of economy, political status, and also we strongly believe that in the next 10 years, China will continue to grow and also become the world's largest economy very soon. According to a lot of research, according to Bloomberg, Thomson Reuters, and a lot of investment banks in the world, everyone's suggesting the same thing. In the next 10 years, in the next decades, from 2020 to 2030, China will become the largest economy in the world. It's a matter of when. It's a matter of 2022 or a matter of 2028. But according to some of the research, I think this is one of the research I want to share with you today. According to Standard Chartered, that by 2030, China will be double the size of United States. USA will be even, the economy in USA will be even smaller compared to the economy in India. So if you keep that in mind, and also think about what happens today, that if we wanted to have, I mean, talking about investments, talking about business growth, we have always been taking the rides on the trend. So surely the trend in front of us is China will keep growing and China will be stronger. And also China has been becoming a different country. Honestly, I mean, the economy has been changing a lot in the last 10 years. I think when we talk about China back in GFC or even before GFC, everybody was like, okay, China is heavily rely on export. China is heavily rely on the European countries to buy their products and services. But if you're looking at the chart in front of you right now, China has become a totally different economy comparing to 10 or 15 years ago. Firstly, on the left-hand side, you can tell that USA nor European nations are no longer the largest trading partner with China anymore. It's actually the Asian countries is now the largest trading partners with China already. They are the largest buyers of Chinese products, and also Chinese investors are heavily investing into those countries. This all the way go from Vietnam to Indonesia, to India, and everything. You're gonna see a lot of infrastructure deals backed by Chinese capitals in those countries, and also Chinese VCs are buying a lot of investment opportunities, all the way from healthcare to fintechs, e-commerce, etc. China is becoming more influential in this region when they're becoming a large trading partners with China already. And the second thing on the right-hand side, on the other charts, this is something I also want to show you, is export is also no longer the biggest component of Chinese economy. If you talk about 2006-07 before GFC, exports counted nearly 35% of Chinese GDPs, but now it's only less than 20%. There's another number I want you to know as well, is domestic consumption is still accounting for nearly 30% of Chinese economy, and this has been like that in the last decades, nearly last decades. Domestic domestic consumptions is now becoming far more important to the Chinese economic growth comparing to the export. So when we think about global trade, etc., China surely still heavily rely on global trade, but the Chinese market itself, with 1.4 billion people, is actually a pretty interesting market by itself. And even in China, we always know that there has been upgrades in the Chinese consumptions. We always talk about the middle class there in China. They wanted to buy luxury products and also healthcare products globally. But also at the same time, if you think about the third tier and fourth tier cities, those are the massive populations there. Those are the people, they just start to pick up e-commerce. They're still buying a lot of low-cost products as well. So in China, China is not just one single market. It's actually have multiple tier of markets. So it doesn't matter what sort of product and services world is offering to China. There's always a market for that. So China itself is basically, I think, sufficient enough to navigate through this kind of pandemic situation. This is something I found on the internet. I want to share with you that this is pretty much the middle of April in Beijing. As you can tell, after nearly 4 months fighting with pandemic in China, China is gradually back to normal. I think we should be fair to say China is really the first in and first out situations right now. You start to see traffic jam is getting back on Beijing's road on the right hand side, and also you see the subway is pretty much getting crowded as well. And this last weekend is the Chinese labor markets, labor holidays. Actually, labor holidays for 3 or 4 days, labor holidays in China, and people are already going out to see their families, etc. So China is surely back on track, back to the growth trajectory. Surely this potential threat of the second wave of infection. But with what the Chinese government has demonstrated, they can have some really harsh controls with their citizens. So I think controlling pandemic is basically won't be that big as a threat right now for the Chinese government. So what we should be, to watch, what should we getting prepared with China back on track? I think there are three things. The first one will be infrastructure spending. This is what Chinese governments always did after some sort of economic downturn back in, I think 2011, 12, 2015, 2008, they did the same thing. So there could be another wave of massive infrastructure spending. This is actually really good for Australia, for our mining or export, etc. So this could be a really good opportunity helping Australia to get out of the economic downturn very quickly. There are two other sectors which also be really important, which is healthcare investments, technologies will also be quite interesting to watch. So taking that in mind, there are a few things we wanted to target in the next few months. I think the one thing is healthcare. In terms of healthcare, I think we can look at medical devices, medical devices ready for export, or well-being products. Chinese buyers has always been a fan of Australian well-being products, for example, Blackmore, Swiss, etc. I think this will also be the case going forward. And also technologies. Technology is an interesting thing. I think we have seen a strong trend of massive investment in online education in China and massive investment in fintech. Last week, Tencent, which is one of the largest fintech business and social media business in China, purchased 5% of Afterpay, drive up the price, share price for Afterpay by nearly 25%. And also remote services. I think everybody talk about Zoom. I think today we're using Zoom as well. Everybody talk about Zoom, but in China, people using something different. People use services offered by Alibaba and also offered by Tencent and Huawei, etc. And let's also do not forget that the infrastructures for cloud services is also booming as well. And everybody knows about Amazon's, but in China, a lot of people use Ali Cloud, which is also a subsidiary of Alibaba. So I think in terms of technologies, all those things will be under Chinese investors' radar going forward. So to finish up, I want to give some advice to investors and founders, and according to our experience in the past, I think, again, China will be the strongest economy and largest economy in the next decade. So do not bet all short on China. I think that is one simple advice to everyone. A lot of economies on the world, a lot of companies on the world, all the way from, I think, Apple, BHP, they all on, I think they're all on the trend to long China. I think so as investors, we should do something similar. Advice to founders, I think, with a lot of successful Australian companies to be successful in Australia, I mean, but we need to be successful globally to become a bigger business, stronger brands, etc. So I think about a global expansion, but also surely think about China. That will be part of your growth for the next decades. So hopefully my presentation today will give you some thought about China after the whole pandemic time. If you have any inquiries regarding to Chinese economy, Chinese investments, and the Chinese interest in Australia, feel free to ask questions. I'm happy to take some Q&As. And if you got any other questions after this, feel free to send me an email or give me a call. Thank you.
Thank you, Eric. Our next speaker is Shaun Holland from Investec Emerging Companies. Shaun has over 13 years of experience in investments, lending and consulting across the early stage, corporate, public and infrastructure sectors. Prior to his 8 years at Investec, Shaun worked with multiple consultancies as well as co-founding a forensic science automation startup. Investec Emerging Companies invests and partners with high-growth entrepreneurs as a trusted advisor to support growth.
Hello everyone, I'm Shaun Holland from the Investec Emerging Companies Fund. It's great to talk to you today about the approach we take as a fund and how we're looking at the current market situation. But before we get started, I hope this finds you and your families all safe and well. It's a tough period for everyone and we're really looking forward to hopefully doing this face-to-face at some stage soon. So at a high level, the Investec Emerging Companies Fund has a focus on high growth, scalable businesses and who need capital to scale up their business models. We're looking to invest between 3 and 5 million in each investment and backing the founders and then working with them closely over the investment period to maximize growth in the business. Because of this, we aim to hold a significant minority in each of our portfolio businesses and work alongside the founders who retain still a material part of their business, so they're incentivized to drive growth as well. And we've built a team of 7, all of us from a diverse background, as well as 4 senior investment committee members from both technology, private equity, listed corporate, and banking backgrounds. Over the past month or 2, we're really excited to announce 2 new investments, if you haven't seen them in the media. One was Longtail UX, which is a search engine optimization platform for long tail searches, and VAMP, which is an influencer marketing and content creation platform. So our investment mandate is focused on investing in and partnering with high growth businesses who have found product market fit, they've established their revenue model, and they are looking for capital and assistance to scale up to the next phase of business growth and typically into profitability in the near term. Because of our active partnership approach, we're also closely focused on why we're the right investment partner to be investing in each business. So it might be because the company benefits from our expertise, either within our team or the wider Investec organisation. It might be because the company can leverage the significant network that we have as an organisation and connections that we can provide. But in both instances, we really look for that strong rationale for us being involved and how we can influence the outcomes and drive value and growth in the business for our fund investors. So what do we look for in the businesses we invest in? At the core, each business should be solving a really important problem for their customers. They should be able to do that in a scalable and unique way and be doing this for a price which makes sense to their customers as well. If they are doing this, we can then get a better understanding of how big the potential is, as well as the ability the company has to deliver into that potential. And that wider evaluation would include a much more granular look into the market size, the market trends, the strength of the founding team, and competition in the market. But in reality, every business is going to have strengths and weaknesses across those other criteria. But if they don't have that core value proposition for their customers, these other factors probably don't matter as much. And from a founder perspective, we spend a lot of time with the founders and constantly evaluating them as part of our discussions and ensuring that we're comfortable with them. And the reason for this is twofold. The first is to judge their honesty, their transparency, their approach to collaboration. And the second is to understand their thinking processes and capabilities to lead the business. The first of these, the transparency and honesty, is critical. You know, we work with these founders very closely over a period of years, and we have to work with founders who we can trust and have a good working relationship with. Because the reality is, growth businesses almost never go to plan. If a founder's transparent and if something is going wrong, the first thing they do is jump on the phone to us. We've got the opportunity to work it through together and find the best way forward for the business, rather than if we're not the first call they make, the problem maybe has gotten much larger and more difficult to solve before we can get involved and help find a solution. And secondly, obviously, because we do take a partnership approach, we're backing the existing team to grow the business. We're not looking at putting other people in and help them lead the business. So as a result, we need the founding team to have a functional understanding across the whole business, you know, across the numbers, the sales, the marketing, product design, HR, and hopefully different members of the founding team will have deep expertise in different parts of that and different deep knowledge over their business and the divisions it has. So as an active investor, you know, we do partner closely with founders and work with each portfolio company to assist them through a bunch of things, all of the key strategic challenges you have in a journey. It might include key growth investment decisions with the capital that we've put in, their future capital strategy, providing them with some key contacts or key contacts into potential customers, or even just providing a different perspective based on the experience that we see throughout a bunch of businesses and bringing that experience to help the founders in each of our portfolio companies. And actually, the last one's actually probably one of the most important. Providing that different perspective and challenging management and their thinking process is really critical to promote really good quality and high quality decision making on an ongoing basis throughout the growth journey. And also, as I said, us being part of a larger organization, we've got over 7,000 people globally, and so we're able to access a really large network of potential partners, potential customers for each portfolio business as well. So if I think about how some of you as individual investors might approach some early stage investment, generally, I'd definitely bear in mind this is a risky asset class and you'd want to ensure that it is right for you. If you're looking at early stage companies, I'd really recommend looking around your own network and trying to get as many different opinions, a diverse set of opinions as possible from as many different people as you can, because others might see something you miss, others might bring a different perspective to an investment decision than you might. And finally, where you can, I'd look to try and find, and we do this a lot in our investment making decisions, find a sector expert, whether it's retail or industrial or consumer. Find someone that has deep and long understanding of that particular business and see if you can get a particular insight that they can provide that maybe you don't have. And regarding how might you support your businesses once you're in, the reality is the best way to find out is ask your founders. Depending on the business, depending on the size of your investment, depending on what your background is, the way that you help your companies is likely to be very different. But if a founder knows your door's always open and they have a really clear understanding of your expertise and the type of assistance you can provide, it empowers them to reach out at the right time rather than you constantly calling and trying to help and using up their time unnecessarily. It's always going to be a balance. Advice from an investor can be really helpful at the right time. But if there's a large cap table and all of the shareholders are wanting discussions continually, it could actually be counterproductive and damage the business in the long run. If on the other hand, a founder has a large cap table of responsive shareholders that are able to help when they're reached out to, that's a fantastic support network for a founder and a fantastic source of advice for a business as it grows as well. So as we think about the current situation, I mean, it certainly has felt overwhelming at times over the last month or two. I'm sure you'll agree. And it's been difficult to see a path back to normality. But in reality, we will return to normality at some stage. And given the potential scarcity of capital, there are likely to be some outstanding investment opportunities as we emerge from this and start the process of returning back to normal. For us, the Emerging Companies Fund, we typically do look at 500 companies a year, and we probably invest in maybe 2 or 3. So we've always been really selective in our approach. As we investigate opportunities in the current environment, this continues. Nothing's changed in that respect. We're still meeting with a large number of founders, whether it's an opportunity now or sometimes they're a little bit too early for us and we're meeting them to build our understanding of their business, and then we can continue that discussion as we grow into that mandate. But it is fair to say our focus has been on businesses which have either experienced a lift in growth over the last couple of months as lockdown has been part of our lives, or at the very least are unaffected by the lockdown process. We've also had a really strong focus, on the long-term prospects, not just how does this perform over the next 2 months, but with any investment decision, how does it perform next year and the year after once the world is back to normal. Some companies, may experience a boost through this period because they benefit particularly from the lockdown process. But unless they achieve that behavioral change in their customer base, it might be that come the start of 2021, that boost starts to fade because their customers return to normal. So we're looking at the businesses and making sure that where they are seeing a step change at the moment, that step change is sustainable and long term. And some of the sectors, they'll all make sense to you, I'm sure, listening to the call. Companies facilitating e-commerce, companies facilitating e-commerce delivery. We've looked at some workplace efficiency software or workplace automation software that people can work remotely. We've looked at companies associated with critical industries or software in healthcare or education as well. We've seen a couple of companies as well, which would be really interesting in infratech and agtech. Perhaps they haven't seen the immediate boost over the last month, but as we do look forward maybe 6 months and the world starts returning to normal, those businesses are probably in a position where their customers are less affected than maybe some of the other industries, and maybe those companies are in a really strong position to accelerate out of the recovery rather than slowly building back up. One thing we are very focused on at the moment with all of the businesses that we look at is both their cash runway and their operational excellence. Both of those, the way a business is managing and the founders are managing their operations are critical at the current point in time. So when might we return to normal? I'm not sure anyone can really confidently answer that question at the moment. And because of that, over the past month, we've had a really strong focus and will continue to have a strong focus on supporting our portfolio through the crisis to ensure they are in a position to make the most of the recovery when it does come, rather than trying to predict the exact month that it does actually eventuate. Once the pathway does become clearer to the way out, it might be that there are opportunities to start looking and start supporting businesses that maybe have had a difficult time over the last couple of months. But the recovery prospects are really strong, and the way forward and the way that recovery is looking is becoming more clear. At the end of the day, look, I certainly hope that all of you and your families stay safe over the coming months, and hopefully we're starting to see this first small steps towards opening back up over the next couple of weeks. And as I said before, hopefully next time we do this, we're face to face, and we really look forward to that. Thank you everyone for taking the time to listen. I hope it's been useful for some of you, and I hope we get the chance to meet person soon. If you do have any questions about the Investec Emerging Companies Fund or our approach to investing in emerging companies, very happy to take your questions following this. Thank you.
Our next speaker is Shaun Fox from RAIC. Shaun is an entrepreneurial influencer and mentor with 2 decades of experience in startups, working both for himself and assisting others. Shaun has been involved in the creation and management of financial companies for several years and delivers a simplified approach to the education of financial concepts and investment strategies. Shaun has drawn on his deep understanding of the startup and business community to build the RAIC joint venture program. It creates a value loop between borrower, lender, and client by sharing the rewards. This partnership greatly increases the growth of the enterprise.
Hi everybody, my name is Shaun Fox, and Wholesale Investors asked me to have a bit of a chat with you guys today, answer a few questions coming from an investor's point of view. I am an entrepreneurial influencer, I guess you could say. You can have a look at my websites and have a look at some of the things that I do. I own a few investing and finance companies, and we get involved in quite a lot of different joint ventures, a lot of businesses. We have an uncountable amount of businesses that we're working with at the moment. So it's an interesting question. To narrow it down in the fields of things that we'd be looking at the moment and what really has my interest, it's understanding the current situation. Like we're in a recession. Yes, we've got Corona and pandemic going on. I'll go into more detail about that shortly. But the real crux of where we're at the moment is a recession. So the easy part is look at what things make money in a recession. Historically, you can just go back and look at the data. So the construction industry is one of the best places to focus and look at. Now, anything in and around the construction industry, I'm fortunate enough to own a mine, the sandstone quarry, so that'll do quite well. So if you're looking at investing or you're looking at businesses that you want to purchase, have a look at anything around the construction industry to do with supplying materials or any services around it. We're going to see a huge boom because the government will be spending a lot of money on infrastructure, and infrastructure, is building. The other sector, which I highlighted just a moment ago, is mining as well. Now, I've got a particular interest in mining. Obviously, it's a great return on investment, but what you'll see now is a lot of money being made by these mines, especially in precious metals. The price of these things have gone up, so these mines are making quite a lot more money than they would have forecasted on, say, 18 months ago. So it means they've got a surplus of money. So I'll be looking at investing in companies to do with anything around mines, not just the mines themselves, but new technologies. A lot of mines are under pressure to modernise their equipment or get up to current new sort of technologies, green technologies, etc. So that's an industry that I'll be looking at quite keenly as well. So I'm working with quite a lot of companies at the moment. The sort of companies that I'll sort of focus on, and it's probably what a lot of you sort of want to hear about, are companies that are going through their cap raise at the moment, because obviously this environment's put a lot of fear into the market space. Now, with some of our businesses, we actually do fundraising as well. We spend a lot of time in building funding mechanisms. So look, what we actually saw is right at sort of the outset a couple of months ago was a lot of people who were looking to invest pulled out of the market pretty quickly. There's a lot of interest, you're getting a couple of hundred leads and interest in, all of a sudden that dries up. But what we saw about sort of 6 weeks after was the entering into the market, the real investors. So a lot of those people who pulled out don't understand the current environment. In a recession type environment, and I will speak more about this shortly, there's quite a lot of opportunity and a rebalancing of wealth. So what you're seeing is an exit of the ill-educated investor and the entrance of what we're going to call sort of smart investors, or what you would have heard called as smart money. Now these guys are seeing opportunity, and it's like waking the sleeping dragon. You've got some really big players in the market at the moment. If you can land some of these guys, what you're going to be bringing into business is that smart money. So they're either going to be bringing other ideas, innovative technologies, networks that will then help your business and help it grow. So look, our advice has been, and my advice to you guys are, push through. Don't hold back your capital raise. I'm seeing so many people that are holding back their capital raise at the moment, wait for the environment to settle down. It's the most ridiculous thing you could possibly do. Right now is opportunity, and right now, all of those investors who you might not have got access to before are getting into the market. So that's my advice, is push through and get in there. Seize the opportunity while it's there. Absolutely. I'm a professional investor, so an environment like this, I'm definitely looking. I'm looking anyway, if anybody out there already sort of knows me. But if I had a finite amount of money to invest, the industries that I'd be focused on the most, as I mentioned before, would be in that construction and mining sector. I can't stress enough how much opportunity there will be. And look, to elaborate on that a little bit more, as I mentioned before, governments will be spending a lot of money on infrastructure. That infrastructure is, sort of construction, mining is making a lot of money right now, and it will be generating money back into the economy. So you really want to look at what a government's going to be doing and spending to pull their countries out of where the position that they're in at the moment. So work backwards, always work backwards when investing or looking to start a business or whatever you're doing. Start at the end and come backwards. Where's the opportunity right now? And who's being involved? Governments are going to have to be spending money. Start at the back and then come forward. So, as I've mentioned, I see opportunity everywhere, particularly in a recession, but I think it's really important to understand the difference between the pandemic with Corona that we're facing right now and a recession, and what a recession is. So look, recessions, you've been guaranteed of those ever since the invention of money. I write quite extensively on my blogs about recessions. You can have a look there for a bit more sort of detail. But what we're seeing now with this pandemic that's happening globally is something really interesting. Now, recessions are so commonplace, and there's a lot of opportunity that's created within there. But with this current pandemic, and it's the first time in modern history we've ever had anything like this. Not that we haven't had pandemics before, and we've had some that are far worse than what we're dealing with now, but we've never dealt with one in a modern age with modern technology. What we've seen, there's a huge amount of opportunity here. What we've seen is the entire world globally coming up to date with technology. It's been a sort of a slow bleed within there, but all of us and all of you would be experiencing Zoom meetings. Everybody's getting involved in that, whereas before they were quite shunned. I know myself, I'm probably never going to do another in-person meeting again because I'm so productive right now. So what we're seeing is technology being taken up globally across the board. So my advice to everybody is make sure that your business now fits the new dynamic within the world. Business is going to be conducted a lot faster. We're finally at a level of technology across the board being accepted in every aspect of business and in industry. So my advice is do not get left behind. Make sure that your company is structured and set up, ready to actually deal with the speed of business. We're going to start seeing now a lot of really quick sort of growth in industry and growth in business. And anybody who's young and agile enough, and I don't mean young as in age, I mean young as in sort of company-wise and getting being able to adopt these sort of technologies, is just going to be lightning ahead. We're going to see almost sci-fi level sort of technology from here. Because as you know, as technology gets created, new technology comes out even faster than that. I think we're going to see, looking back on this, a real pivotal point in our technology history sort of moving forward. So there's a lot of opportunity there. My suggestion is also start looking around those different industries, like, and what's going to be changing in this environment. We saw the revolution of the co-working space away from sort of normal sort of business buildings and office block spaces. What is this now going to do in that virtual world? What opportunities there, or what does your company need to be to get up to date with that? Other things to look at is the death of cash. Has it gone? Like I haven't used cash in so long anyway, but right now every store that you do walk into says we're not accepting cash. And it's not been an issue for anyone. We've seen nothing in the media, no one's speaking negatively about it. What does that actually say about where we're up to in history at the moment? So my advice to everybody is make sure you're taking this time to explore every avenue of technology that you can and make sure that your business is up to date with it. Be doing things like this, be getting into the media as well and talking, dealing with, especially the wholesale investor guys, they are so across what is happening at the moment and putting these types of sort of interactions out there. But I think this is the new normal within that space. I like to see a multi-dimensional business model. I like to invest in companies or be involved in companies that have taken into account each sort of aspect and segment of their industry and are able to sort of modularize. By that, I mean, are they able to fractionalize out a piece of their business to generate additional income somewhere else? Or are they able to actually modularize in and bring in different aspects to be able to sort of grow and pivot that company into different directions? I think the era of companies that are one-dimensional or with a solid product base are kind of gone. We're in the era now of the entrepreneur. So businesses are also now entrepreneurial by nature. So I think that's really important for me when I'm going into a business to be able to look at it, particularly in an environment like this. How many businesses actually survived and stagnated through here? How many of them actually were able to sort of turn left and start capitalizing within there? So that's the key components for me. Now, importantly, you need to understand there's a difference between, for me, a founder and a manager. In a founder, I like to see someone who's a bit of a dreamer, somebody who's looking at every aspect of their industry, who is able to pivot from one idea to another, who's able to jump industry, take their company and jump into a different industry as an opportunity presents itself. I find with founders like that, they're looking the next 5 steps down the road. So not only are they looking at the next 5 positive things, but also the negative things, but then how do they turn that into a positive thing? So I like my founders to be very entrepreneurial and think outside the box. Now, that being said, there's a danger in investing with someone who's just like that. So it's the team they build around them. And I think that's really what shows the sort of founders and entrepreneurs who really can make a difference. It's the people they build and have around them. So a general manager is absolutely key to someone like that, or a business partner who's a bit more grounded, who'll be able to steer the ship in the right direction. Who'll be able to sort of bring that founder back down to earth when they need to be. But you need to have that dynamic. particularly in this sort of world. And right now, I've got so many people that I'm dealing with who are just like that, who are just flourishing through what's happening right now. So that's kind of a key part for me. Now, the last sort of piece of advice that I want to give out there to everybody is, look, mentorship. Make sure that you have people that you're speaking to. They don't necessarily need to be paid mentorship. It doesn't necessarily need to be a professional mentor either, but someone who's a bit of a sounding board, particularly in times like now. I've mentioned it so many times. I don't know how many times I've said the word opportunity through this sort of talk, but there is a lot of opportunity out there and a lot of dangers. So you need someone who can do a bit of a sanity check for you. Check in with them once a week, have a bit of a chat, and sort of get some different ideas. I'd also like to say now, a huge thank you to Wholesale Investor guys. Just absolutely love everything that's going on over there, and that should really be your first stop if you're watching this, to sort of see what they're doing there. Reach out and contact them. They can put you in contact with anybody that you sort of need for your business, for investing, whatever that sort of space is. It's a really good pivotal center point to sort of push out. So guys, thank you all so much for listening today. I hope you enjoyed this sort of conversation. Feel free to go onto my website. That'll be here somebody, I dare say. Have a look at what we've got going on there, and you can reach out anytime you like. So thank you all again, and good luck.
I would like to introduce our first speaker for blockchain and crypto session. Leeor Groen from Blockchain Valley Ventures, a Swiss venture firm investing into and supporting blockchain-enabled businesses. Passionate about the role of emerging technology on society and the global financial system, he is a recognized thought leader on topics related to the future of venture capital, finance and capital markets. A World Economic Forum Global Shaper and founding member of the World Innovations Forum Foundation, Leeor draws on a wealth of international experience, having lived and worked professionally in Zurich, London, Melbourne, Oslo, Brisbane and Singapore.
Okay, so good afternoon and welcome everyone. My name is Leeor Groen and it's a pleasure to be here with you today at the CRIISP Venture Investment Summit. By way of background, I'm working with the company Blockchain Valley Ventures. We're an early stage venture capital firm fully dedicated to the opportunities and emerging trends around blockchain and emerging financial technology. So it's really a great pleasure to be able to talk through some of the things that we are seeing in this industry evolve, especially since we've been here for several years, actively deploying capital into it, and certainly then also considering how this is, let's say, developing in light of the recent, let's say, macro considerations and implications of COVID and so forth. So I really try to give you a nice insider overview of how we see the world and the universe, and certainly look forward to discussing some of the questions that you have around this as well. But first things first, I think it's important for me to really understand and just make clear why we do what we do. And, we're a company of 15 people fully dedicated to blockchain and the thematic around this. And if we were doing that just to look for incremental changes and small developments and efficiency improvements, we wouldn't be able to justify, first of all, the ability to raise funds ourselves, and then two, some of the perspectives and horizons that we look at for realizing potential returns here. So in order to understand the opportunities in blockchain, I always like to sort of start and set the scene with this quote, which I think is really indicative of the times where people were continuously looking for improvements and way to make things more efficient. And certainly that's been a function of new technology today. The way that we really consider blockchain and our perspective on this is we're really creating something bigger and new. So we like to come out with and support companies and founders who are dedicated to building motor vehicles as opposed to the next generation of horse or iPhone, for example. And I think this is just the mindset that we at Blockchain Valley Ventures really approach this industry with. And certainly I think really formulates our investment strategy and how we approach the industry. So this is just the way to set the scene, I think. And I think contextualizing that is really a good opportunity to just see how, when we consider blockchain, of course, it is more than just financial services in terms of applications. But really, I mean, of the blockchain companies that we track, which is a pool of some 13,000 companies that we have been tracking since inception, we see that, you know, more than 50% are directly servicing financial technology opportunities. And then the vast majority are also indirectly somehow connected to this. So it is a central thesis with these areas. And the evolution of that space is one that in itself is interesting, and moving away from the underpinning of financial software and enabling, you know, digital capital markets to form and capital to flow in that sense, to more recently also exploring how marketplaces have formed and functioned, and, you know, digital challenger banks and peer-to-peer opportunities have emerged over the past years. And you know, we live in very exciting times, and I think blockchain is just one of the key pieces that allows for the structural and paradigm shift that we're seeing in this space. And, you know, that's really where we feel most comfortable and where we see the opportunities, is really doubling down on not just blockchain, but what blockchain enables as a result of the adoption and let's say maturity of other technologies, such as machine learning, and how that affiliates and then links to the management of data privacy and consumer protection in that sense. So it's really the intersection of all of those things. And by focusing and being a thematic in the blockchain and crypto space, so to speak, we really are doubling down on this opportunity and are fully dedicated to seeing those through, which, you know, independent of the current macro climate and in COVID, let's say the new COVID world, I think these are things which are long-term trends. We're building new infrastructure, new paradigm shifts, which fundamentally, independent of the booms and troughs of both the macro economy, as well as no doubt the crypto market with its own peaks and hype cycles. These are things which we're making long-term predictions and bets around. And that's really what's guided us to where we are today. And I suppose in terms of where we are today, I think the reality around blockchain, and this is again independent of Bitcoin and type of market capitalizations that you see on cryptocurrency market and how these are listed. If we look at purely from a company's perspective, where are these companies? What stage of maturity are they? I mean, we observe quite literally that most companies are still very early on. So only some 15% of the 13,000 that we track have actually received any formal funding. And, you know, certainly beyond a Series A round, it starts to get very few and far between. So when we talk about blockchain, it is inevitably early stage. And by that implication, when you have such macroeconomic conditions as you have today, where capital raising becomes difficult, you know, runways become more and more crucial, and founders start to run out of cash. I think these are important considerations which are also influencing how we approach the market and also how we are managing the relationships with our existing portfolio companies to support them and make sure that they have the like, let's say, the resources that they need to continue through and move beyond, let's say, the funding gap that currently exists. But, you know, it's worth also considering that in the bigger context, so to speak. So, you know, heading into 2020, even independent of all of the things that have evolved since with COVID and the world essentially shutting down, we look at this and we were already expecting there to be a very difficult period this year for blockchain companies. And the reality is that, I mean, funding by default, let's say equity, so professionally managed equity funding in blockchain is, you know, hugely volatile and has been influenced by a lot of the token frenzy that we saw in the earlier years. And as a result of this, people have had their fingers burnt or have stayed away. They've not understood where the opportunities are. And certainly we draw that distinction between cryptocurrency trading and transacting on ICOs, and then, you know, backing and supporting companies who are leading that paradigm shift in the industry itself. And this is where we see that basically this large decline. And you know, this graph, I think, scares a lot of people. And when we show this to our portfolio companies, certainly there's concern. I mean, where does the growth equity financing come from and how can they scale their business? At the same time, I mean, this is basically the opportunity that we see and the reason why, I mean, we go out and are actively raising our new fund to be able to bridge this gap, because we, you know, have the conviction around the market opportunity here on a macro scale. And we see that there is this funding gap. So the competition as well amongst investors is certainly low. And that's really a great opportunity for investable companies to get investment then longer term. And also then, I mean, if we think of the 10,000 companies that are, you know, potentially half of which have very interesting technology and solutions and potentially market access to small customer bases, we see that evolving into the next stage and iteration of this industry, where that can then become basically the basis for consolidation and M&A activity starting to pick up as this industry matures. And I think, most recently, Binance's acquisition of CoinMarketCap, I think one of the flagship deals in the industry, which is a triple-digit million deal. I mean, this is really just the beginning of where we see consolidation and those types of investment opportunities as well, to finance acquisitions, to finance leveraged acquisitions, and being involved in those processes. So while it is early stage and difficult times overall, we certainly think that is an opportunity both for investors, as well as I will come to entrepreneurs as well, who are building these businesses for the future and for the long term. And how we basically work around that. I mean, I think I like to say that we're a pretty plain vanilla VC working at a non-conventional industry. So, we are non-differentiated in that sense for basically the key structure, and we are equity investors. So we haven't invested in tokens. And I think for us, that's a key distinction to draw, because what that essentially means is that our limited partners and our investors, I mean, they demand and expect of us the same kind of fundamentals that all of the other allocations to venture capital portfolio managers that they're making. And as a result, I think our reporting and our standards have to obviously be comparable for them as well. And if I look at the list of things that we look for in companies and the criteria that we report on and present to our investment committee, reality is that the vast majority of these are not affected by COVID. And I think that really fits into the fundamental topic here, which is, yes, these are difficult and testing times. But again, if we're building motor vehicles, if you have the motor vehicle conceptualized, the money will come and people will follow you into that space. And it's really coming with that idea that it's a paradigm shift, which is not happening overnight, but certainly long term. And the cyclical nature of economic conditions along the way are, of course, significant, but do not shape the industry itself. So the vision is driven by the entrepreneurs who are shaping the industry. And then everything that happens along the way is sort of up to us to navigate in a smart way. So that being said, of course, I mean, how we respond to this and where we see, important distinctions or additional measures that need to be taken is really around the conviction of a management team that we're looking to support. And again, our portfolio companies as an example, as well as potentially new ones. I mean, there has to be this clear alignment of what it is they're trying to achieve, how that looks like over not just the coming 24 months, but really the 5 to 10 year period that we want to be supporting them. And then really trying to measure and mitigate the risk of operations. Now, I mean, anyone who's been involved in B2B sales before, especially in financial services, can understand and appreciate the complexity of trying to sell technology to banks and financial institutions. And those sales cycles and lead times, I mean, that is a process in and of itself, let alone adding the complication of blockchain, which raises additional, potentially risk factors or, barriers in some organizations and instances. And then on top of that, of course, an economic downturn where a lot of projects and technology developments are being placed on hold. I mean, these are things which add complexity, and revising those business cases, managing those expectations are very important, and certainly things that we are stress testing and making sure still fit into what can become an investable company, of course. But again, let's say 5 of the 8 main criteria here, especially around the business model, the value potential, and also valuation and exit opportunities. I mean, those are fundamentals which, independent of what's happening in the macro world, are certainly relevant and remain relevant in our industry today. So I think, bringing it down to practice, I mean, what is the actual opportunity there? And I really break it into 2 buckets. So the first is, of course, everyone will talk about the number of fantastic companies that emerged from the previous financial crises and let's say tough climates. And I would argue that this is non-differentiated in blockchain. Now, of course, you have many opportunities that are evolving around the maturity of decentralized finance, maturity of credit lending and peer-to-peer models of a lot of the crypto projects and initiatives and protocols there. And this is one piece which we're very excited about as well. But really, I mean, agnostic to this is the idea that strong management team, as I really put that as point number 1 intentionally, because strong management teams will see this and treat it as an opportunity to signal to the market, how they were able to deliver growth through this period, how they will manage to, let's say, optimize their resources in a smart way. And some of the examples here that we really see around the strong company culture is, of course, the need to, potentially defer salaries or reduce salaries for a fixed period of time. and the willingness and motivation for team members to follow management in this is a key indicator and signal that businesses come to investors with and say, we've managed to reduce our cost base without having any turnover of key resources, and we're ready to continue going and delivering on this opportunity, even with the smaller or reduced pool of human capital that they have on board. And I think these are the stories and the discussions with investors that, for me personally, I think has legs and really where we see the most opportunities to signal to the market that you're ready to go. But then also long-term, as I mentioned, really the opportunities around ecosystem strategies. And I think, if we just break down the numbers, right, factually speaking, there's over 10,000 blockchain companies in the world. I'm sure many of them and the vast majority of them are in their own way unique and doing very innovative and different things. But that being said, I mean, you can count as well, the types of different areas in which they're innovating in, and that opportunity to really consolidate and combine services and opportunities is certainly one that we think is attractive. And the implication of that is really, companies who are going into fundraising today, rather than trying to fundraise to survive and continue business as usual and fund their operations for the next 6 months, it's really about coming with a smart way to actually package and combine different services, potentially from peers, from competitors, or from other companies from outside the blockchain industry, to try to build that level of credibility and basically enhance the service offering and come out with a story that not just fundraising to survive, but we're really fundraising to thrive and bring together many different services and offerings through an ecosystem strategy, which I think is becoming more and more understood. I mean, I mentioned Binance, but I think the other great example here is Coinbase with, last year, who have come in and acquired Xapo, the Swiss custodian, and as a result formed the whole Coinbase custody service offering. And on top of this, have also launched and created their own products around the USDC and these stablecoin initiatives. And combined with the fact that they're becoming a bank and have applied for a full banking license. I mean, these are the kinds of opportunities that exist for blockchain companies for what has started as a traditional marketplace to move into the custody space, to move into new products and essentially start printing their own money and have their own currency. I mean, this is the envy of any capital market, traditional capital market in that sense, infrastructure player, because they are so much more flexible and dynamic than any of the NASDAQs and London stock exchanges of the world. And they are able to do these things in this space for a variety of reasons, which we think are very interesting. And Coinbase is arguably a challenger bank of the future with that new model of not only storing and safekeeping assets in custody, offering credit and interest on those assets, also creating its new products and currency, and also then being the marketplace for transacting value. And I think these kinds of things, which, I mean, even 5 years ago, if anyone had tried to conceptualize, would have said is impossible. And yet today we have in the market several players who are working towards building that level of integration throughout the ecosystem. And I think this is really the types of plays that we see are interesting. And that's on one hand in financial services, but then of course also in many ancillary and periphery industries, including pharmaceutical industry when it comes to healthcare and healthcare records and data management, and certainly privacy and information security, which basically is applicable to not just financial services, but any highly regulated market and industry. And essentially that's really our focus at the moment is how we can combine and work together with not only our portfolio company, but giving that guidance and support to future companies and looking at M&A opportunities in this industry, which I think make fantastic investment cases if you can bring the right parties to the table and finance in a smart way. And that's really, I think, the context and background that we have and are looking for in the blockchain space at the moment.
Thank you, Leeor. Next speaker is Charlie Faulkner, a founding partner of Northblock Capital. Charlie is a global digital technology veteran, an angel investor with extensive experience in Europe and Silicon Valley. Prior to co-founding Northblock Capital, Charlie led global business development for Manage.com, growing revenue from $0 to $100 million. Charlie is currently a board advisor for several tech startups and investment funds in Europe and the United States.
Well, good morning or good afternoon or good evening. It really depends where you are in the world. It's 9 a.m. here in London, so good morning. This is Charlie Faulkner. I'm the co-founder of Northblock Capital. Steve and the team at Wholesale Investor have kindly invited me to do this presentation this morning. So I'm going to tell you a little bit about us. I'm going to tell you more about our thoughts and feelings around investment strategies during this interesting period that we're all in right now around COVID. And actually provide some practical and hopefully insightful advice and opportunities which illustrate some of what we're talking about, because we do feel that, you know, for the right investor, there are some excellent opportunities. You know, we as a business are taking the stance that we would like to be proactive and you know, actually do something during this period which is aligned with the opportunities, as opposed to sort of sit on our hands and wait to see how this pans out. One of the reasons is because whilst we didn't anticipate, and nobody anticipated, you know, exactly what's occurring, we do feel it's accelerated some mega trends and opportunities that we saw some time ago and we've been, you know, thinking about. So I'll come into that later. A little bit about us. We're a global investment business. We provide asset management, corporate advisory services, and technology solutions to clients. We've been in existence for several years now. My personal background is a mixture, really. I spent 15 years in technology, working in sort of startup and scale-up technologies in Europe and in the US, mainly in Silicon Valley, where I was a part of a business that was acquired, a business called Manage.com, advertising technology company that subsequently was acquired. And then I spent some time as a board advisor to an AI company in Silicon Valley. So I've really spent time in each camp, both in the startup, scale-up technology world, Europe and US, and now in the investor corporate finance world. So I hope those experiences have helped me better understand, you know, what's happening today and where the opportunities exist. What do we do? Well, we invest in a relatively broad remit. We classify this as deep tech. That's, you know, open to different interpretations, but we look at things like blockchain. We've been very active in blockchain and cryptocurrency. And I think that's how we first connected with the guys at Wholesale Investor. But in recent times, we've broadened our remit to include other things like AI, biotech, clean energy, quantum computing, and we've become really more focused on what we feel are the bigger opportunities that affect societal change, as well as you know, just pure capital profit. So that becomes even more evident and profound during times like today. In addition to that, we work with clients who are looking to raise capital. We've built a pretty impressive co-investment network over the last few years of different funds, institutional investors that share deal flow, investments. All of our investments that we've made really have been originated from that network. And we do the same. We share deal flow within that network, and we evaluate opportunities and provide kind of collaborative diligence. So, you know, if there are businesses that are looking to raise capital, both, you know, in the UK, Europe, or in the US, where we have a huge network, then, you know, we're always interested in talking to them and understanding more about what they're looking to achieve and how we might be able to help. Okay, here's a quick slide I'm just going to skip through. It's just a snapshot of some of the recent, you know, some examples of investment success and exits that have occurred. I won't dwell on this too much. You'll probably recognize some of these names, Ripple Labs being one of them. But we have a portfolio of 30 plus investments, and we've also participated in syndicate investing, SPVs, etc. So where are we today? Well, you probably hear this quite a lot, but you know, things have changed. There's no doubt that they will continue to change, I think, in the next months and even years to come. You know, my belief is that we're really entering probably a sustained period of recession, and maybe a very severe recession that could be with us for 2 years or more. The current sort of status quo today really looks like healthcare and companies and researchers around the world are trying to mobilize to create a vaccine. We're interested in technology that has helped to shift and emphasize those solutions to achieve that, but also to work from home. And we feel that clean energy has become more in focus as companies and individuals think about that impact on the environment. interestingly enough, this is all still centered around our thesis of blockchain and specifically Bitcoin, and how we believe it's an undervalued asset. So, we'll talk more about that. So, where do the opportunities lie, and why, and where do we feel the progress or the changes happened? Well, interestingly enough, I mentioned this at the beginning of this presentation. We really don't actually feel that these mega trends and subsequent investment strategies and opportunities have been created by the pandemic per se. We actually feel like they were long-term structural changes that were forecasted to happen. We do feel like they've been accelerated, and they're likely to pass a lot quicker now. But they're certainly not a knee-jerk reaction or a correction. They've been in our thinking for some time now. And really, if you look at our activities today as consumers and folks in business, we're exemplifying that change. 6 months ago, I was probably traveling around, certainly around the UK, but really around the world, having meetings, traveling to the US once a month, which feels like a distant thing in the past now. In the last 6 weeks, like everyone, we've become heavy Zoom users. Many of us were before and realized it was an effective way of networking. And doing events like this have been able to really done very effectively virtually. So our view is that virtual working was evident, and the progression of that was very evident. You just have to be in London to see the excess amount of commercial real estate that has been quite evident in the last 2 years, but even more so now. And in a matter of weeks, virtually all of employees around the globe are starting to work from home. More interesting, non-essential medical visits become visible. And I think an area that is really transformational and probably a generational change that we're about to see is that all learning for hundreds of millions of students, is now virtual. Our belief was that these things were happening already. They've been simply accelerated. We also believe that there's a huge requirement for a transition. Now, to feed that transition, one requires data and high performance compute. So that's going to be something we're going to mention in the next slide. Other changes that we see due or accelerated by the pandemic is we expect to see a pretty large growth in infrastructure projects, and therefore an increased investment in urban areas as governments all around the world continue to seek and stimulate the growth via funding. To be more specific, we think there's going to be a lot more funding focus that will be placed in clean tech, and that's something that we're very interested in. And we feel that there's a link here with blockchain and cryptocurrency. Many of you will know already through your partnership with Northblock Capital and maybe attendance at previous wholesale events, and indeed this presentation, that we are very bullish about our belief in Bitcoin. We believe it's a cruelly undervalued asset, and it's certainly got the potential to not only grow in value exponentially and become maybe even a safe haven for investors right now and for the next 2 or 3 years that don't feel as confident about placing cash in a bank, but really also see it as an alternative to gold, as a currency of last resort. There's going to be massive government intervention in the next couple of years. I think we all agree about that. So, traditionally gold would have been the asset of choice to really go to in times like that. We believe it still is, but we also believe there's an alternative with higher capital growth potential, and that's Bitcoin. Okay, so with all those things in mind, what do you need? What are the ingredients for change and investment? What are the key areas that one should be looking at to harness these opportunities? We've really pulled it into 3 different areas, but they all relate to high performance compute, or HPC. So it's a term which is becoming well used. It's also known as edge compute in some areas, but one should really understand it as a term which is used in the industry to improve products and reduce production costs and decrease time it takes to develop new products. So think about running faster times for computation, spending less energy in doing that, and so on. So you can understand with COVID has produced a bit of a tailwind, pushing demand for efficiency and innovation forward. We are very aware of all these applications that rely on high performance compute. You can look at artificial intelligence as a great example. It's being used today to track the virus and help provide research to cure and create a vaccine. There's lots of micro examples as well. As we all begin to work from home, and there'll be greater reliance on big data and cybersecurity, and data hosting provision will grow exponentially. The truth really is that there's higher demand and building demand than there is supply, and the requirement for computing power for both businesses and consumers is really, really significant and growing. To take one area that we're particularly interested in is research. If you look at every university or place of academia right now, which is doing really valuable research, it's reliant on high performance computing infrastructure to do that. So we're excited about that area of growth, and we feel that, again, it's been accelerated by the demand of data provision, use of applications like AI, Internet of Things, and what we perceive to be a future investment into urban areas. So as the government, as we said before, look to regenerate our economy, we perceive there to be a lot of investment going into urban areas, greater reliance on building robust infrastructure for those cities and smarter cities. And again, there'll be a huge reliance really on a robust infrastructure and data provision. We think that the likelihood of green energy becoming more prevalent and funded by the government will also create a huge employment opportunity, and that'll be instigated by the stimulus funding that we'll see. Indeed, $2 trillion have been forecast to be put into clean tech or green energy. Bitcoin is something we spoke about. So we really want, as a business, Northblock Capital really wants to place a lot of investment into Bitcoin and technologies that utilize Bitcoin and more importantly, create the value in Bitcoin and stored value. Last week, Tim Draper of Draper Ventures doubled down on his forecast that before 2023, the price of Bitcoin would be $250,000. I don't know if I'm that optimistic, but we certainly see today's price and indeed the price that it's risen from. So I believe it's around 8,600 today, and it's gone up from 6,800 or numbers like that in the last 30 days, as evidence that people are reassured and using it as a safe haven and indeed store of wealth for during these uncertain times. We think that will continue. Okay, so what does all that mean? What's high performance compute? Increase the infrastructure, but also increase requirement and investment in green energy, both from private and public sector, and the growing emergence and indeed prominence of Bitcoin. What does that mean in terms of investment opportunities? Well, we've knitted that together. There's a project that we as an investor were interested in back in November actually, and committed to, but it's become certainly more important to us as a business, and we believe to other potential investors. And it's called Edge Mode. Edge Mode is an example of a high growth opportunity that's been accelerated by today's crisis. Edge Mode really sits at the middle of intersection between data asset mining, so Bitcoin mining, and high performance compute data centers. To power this, it uses low cost green energy or renewable energy. Edge Mode actually partners with those energy providers, places sites, data centers and infrastructure for mining on that energy site, and leverages very low cost electricity, which is really the most important OPEX variable in the success of both Bitcoin mining and indeed financing and powering a data center. So they're tapping into government policy, investment and grants, and more importantly, huge demand, which currently exists and is actually growing. And that demand comes from artificial intelligence, blockchain, research, gaming, video on demand. I think we're all watching a lot of Netflix right now. And indeed, they have opportunities to work with huge enterprise businesses that are looking for really to become tenants and place their infrastructure in robust data center environments. So there's a lot to like about that project. There was before. They've secured MOUs and LOIs with clients already, and they also have an immediate demand for Bitcoin mining, because the beautiful thing about mining Bitcoin is you don't need to create sales demand. You simply need to create a robust infrastructure with a low but reliable capex and opex to make very good returns. And we expect there's a huge long-term rise in the value of Bitcoin. This slide here probably illustrates the business a little bit better. You'll see that it's a simple model. It involves leveraging low-cost energy, so sub-3 cent kilowatt hour energy, and then using that as electricity in phase one for Bitcoin mining. I can tell you that they've partnered with what could be described as a titan of the industry, a $1 billion business, enterprise value in blockchain. It's one of the biggest mining businesses in the world today, and they also provide immersion cooling technology, which is very unique and certainly very powerful type of technology to maintain the return of investment and longevity of the infrastructure that's used in Bitcoin mining. So they've made some impressive partnerships on that front, added to their board as well. I think rather than talk about that specifically on this call, if there are folks on this call that will be interested in learning more about Edge Mode and some of those partnerships and personnel involved, I'll be happy to tell them after the phone call. What's also a lot to like about this project is it's is revenue and profit generating in year one, and it's highly scalable. I think the times we're at right now, with the uncertainty that exists, many investors like us will be looking for cash generative investments. I'm not sure Northblock Capital will be focused for a little while on more speculative investments with a longer term outlook. We are looking at cash opportunities with high capital growth as well, and this generates it. The diversification of having both Bitcoin mining and high performance compute data is attractive to us, as are the partnerships, which we mentioned before, and the existing confirmed demand that they've agreed. In addition to that, there's some nice dividends and capital growth opportunities for investors. So it ticks kind of a couple of boxes that we wanted to see: dividend opportunity, but also high scale, established demand, and therefore a high growth opportunity. Partnerships already in place with a potential acquisition, and it's been accelerated by the crisis. So they seek a 2 million seed round. As I say, we are participating and are advising in this round. They've already raised a significant amount of that, and they'll be also matching that equity investment with debt finance to invest into the infrastructure to help them scale. It's a 100,000 USD minimum investment, and it closes towards the end of June, if not before. So, I hope you've enjoyed that and got some practical advice and insights into, what we perceive to be high value opportunities now, namely in the high performance compute areas stimulated by virtual working and the greater reliance on applications such as AI, IoT, and blockchain and gaming. And then we've sought out an investment which really matches that, and that's called Edge Mode. I've been told that there will be questions and answers on YouTube later today. Unfortunately, myself being in the UK would mean that it's a 3 a.m. Call. I've not said I won't do it, but I'm also not sure I will. So I'd like you to instead contact me on cf@northblock.io if you have any questions or you simply wish to connect. You can also find me on LinkedIn. That's Charlie Faulkner, Faulkner. Thank you for listening. I look forward to speaking with you in the future, and all the best and good luck in these times. And I expect you will profit from these opportunities. Thank you.
Please welcome Hui Jie Lim, founder and CEO of Into the Future Corporation. At the age of 26, Hui Jie became one of the youngest executive directors of a London-listed company. Hui Jie has sat on the board of 3 listed companies and has successfully founded and listed his company onto the Australia Stock Exchange in 2015, achieving a market valuation over $230 million on opening day. Today, Hui Jie envisions to build the world's first fintech bank with the key goal of bringing financial freedom to the masses by providing better financial accessibility, financial opportunities, and financial literacy.
Hi, this is Lim from Vision Group, and I'm based out of Singapore. So, greetings to everyone. Good morning, good evening, good afternoon. And today I'll be covering on 3 key topics, primarily the areas on trends, a bit about vision, and what we see upcoming in the future. So, many a time, let's step back a little to really find out what we think will happen in the future. We sometimes need to look into the past. And one of the key things that we look at is that technology has always been a key driver in major revolutions and disruptions in our past. And whether it's it from the telephone to the TV, the personal computer, and what we have today, we realize that every time there's a new technological invention, there's a lot of opportunity and a lot of people do make money. One of the key things that we also see as a key trend is that technology inventions are becoming much and more prevalent and coming out faster and faster. One of the things, however, to really look at is not really just about how technologies are evolving rapidly, but how are people actually adopting these key technologies and embedding them into their lifestyle. If we look back very much into the invention of electricity, and we take the adoption of 25% of the US population. It took them almost 46 years, 35 years for telephone, 26 years for the television. And moving forward to the personal computer, it took about 16 years, 13 years for the cell phone, and 7 years for bringing us to today. And if we all know, Pokemon Go just took 19 days to be adopted by 25% of the US population, comparing 46 years to what we now today have of 19 days. This also tells us there is huge amounts of opportunity, not only in creating new technology, but how the adoption of technology will be becoming more rapid and rapid in the years to come. One of the other studies that we really look at as well is that we did a study over the last 20 years, very much from 1998 all the way to 2018 on the 20 largest internet giants. And what we have here in 1998 is the top 20 internet giants. And taking a time frame every single 5 years, we mark out the ones that are still alive and valid and are in the top 20, and the rest of them that has dropped off from the top 20. Moving forward to year 2003, we realized that more than 30% of the companies has dropped off from the top 20 list, very much of course of the technology bubble. And in year 2008, in the year 2013, and in the year 2018. An interesting study is that if we look back over the course of the last 20 years, just 2 companies in 1998 is still around in 2018 that's in the top 20. What this also tells us is that probably and maybe in the next 20 years, there's a chance that some other companies that probably we can invest into or we can partner with are able to grow and become the top 20 internet giants in the 20 years to come. the next question then is to ask, what is going to be that's upcoming in the next 5 to 20 years? So looking back, today we are really in an era of data explosion. 90% of the world's data was really created just in the last 3 years. Imagine in the next 5 years, in the next 10 years, and more, how much more data would be created and how much more data will be embedded into the core parts of our business. With these key statistics, it's quite interesting because we know that there are going to be a lot of companies that are ill-equipped with this huge amount of data and this huge amount of information that is going to be created. And there will be 3 key things that we see it's going to be interesting. So going back to some statistics, $600 billion of loss was due to online frauds and scams in 2017. This leads us to an increasingly less trustful world. There's more scams and more frauds just because everyone's more interconnected and there's so much more data that's flowing out there. 1.7 megabytes of data is produced every single second by each person. This leads us to an increasingly noisier world. And we have more than $6 trillion lost annually in 2017, targeted with a huge increase in cyber attacks. This leads us to very much an increasingly insecure world. Which companies are then able to take on this challenge, this opportunity, to make sure that we are able to be having more trust, to have better clarity in a noisier world, and have better security in an insecure world? We believe that there are 3 major technologies that will contribute to these 3 key aspects that we believe are integral towards future-proofing companies for the future. Blockchain technology brings forth trust. AI, machine learning, analytics brings forth clarity. And cybersecurity brings forth peace of mind. And we believe that these 3 core technologies are very integral, not only to work separately, but together to ensure that companies are able to future-proof themselves in a future that might be more insecure, less trustful, and more noisier. So what if companies are not able to fully protect themselves or fully utilize this huge growth in data? Some key statistics on a failure to protect: a loss of business for every million data records that there's a breach for is estimated $40 million. And you'll be surprised, in order to gain back to normalcy, the loss in productivity, all the way from starting a data breach, detecting it, and containing the breach, takes almost close to a year from the initial breach, detection, towards resolving it. 1 full year. Imagine the amount of data that's already been lost. And the loss in value for listed companies, there's a huge drop in 7.27% of average share price. And from failure to utilize, there is huge loss in business, in productivity, as well as in value. So at Vision, we focus very much in being a data-first technology group that focuses on data productivity through data decisioning, automation, and trust, enabled by AI, blockchain, and cybersecurity. So if we take a typical journey for data productivity, starting very much with the first step of data discovery, management, optimization, followed by automation, protection, and integrity, and moving forward in areas of monetization, privacy, and recovery, we believe these are 9 core sectors that will lead towards companies that has huge opportunities to grow into in the future around the 3 core technologies of blockchain, AI, and cybersecurity. Firstly, to help companies with data decisioning, followed by companies to focus on data automation and trust, and eventually how to fully monetize the data that they actually hold and have. So what do we see in the future for 2020 and beyond? We believe that data will be a huge part. And of course, we are today in the current circumstances where we have the coronavirus. And one of the key things that we really should take note of is that opportunities as well. And there are companies that do well, there are companies that behave well, there are companies that do not behave that well, or treat their staff or their customers unethically. One of the key advice really to take note of is that, yes, circumstances and situations might come and go, but the people will still be around. Make sure how we behave in these circumstances will really show what kind of integrity we hold, and people will pay the price for it. So do take note that whether from an investee standpoint, an investor standpoint, do what's needed, behave well, because people remember. Opportunities that we feel that's important. Yes, opportunistically through the coronavirus, where today we not only look at how are we going to be recession-proof, but we want to ensure that we can be pandemic-proof as well. This will not be the last time that the world will face an issue that is so largely blown. In the future, there might be a circumstance that in the future, the viruses might become stronger, and maybe there'll be even more serious situation than we are facing today. So companies that look into the situation from opportunistic angle, great for you, but moving forward, it's important as well that eventually when this circumstance cross, what then are we going to do? And at Vision, we believe strongly in data, and companies that really fall into the full value chain in the areas not only of the three core technologies of blockchain, AI, and cybersecurity, but how to really look at data decisioning, automation, trust, and monetization are companies that we are interested in. So with that, I believe that we have pretty much covered what we believe strongly in Vision for 2020 and beyond, and very much up our alley in the next couple of months. There's huge movements very much in the blockchain era. We're able to see that there's huge movements in China where they're looking very much at their DCEP as well as their BSN network, and how the entire nation is going to be blockchain enabled, distributed ledger enabled over the course of the next couple of years. In US, we already see Libra very much changing and adopting, hopefully to be able to gain better adoption in the space. So it's exciting times. We're already looking forward towards what we're able to expect for the year 2020 and beyond. With that, this is Lim again from Great to interact with everyone. Looking forward towards an exciting future. Good evening, good afternoon, and good morning. Thank you.
We are now going to move to the FinTech session. Please welcome Madhu from Angaros Group. Madhu is a serial entrepreneur, experienced investor, and global advisor since 1995. He started his entrepreneurial journey at the young age of 23, soon after finishing his master's from Asian Institute of Technology in Bangkok. He has a stellar track record of assembling core global teams, leading people and creating extreme value for founding teams and investors with double-digit millions in dividends and enterprise value. He has an in-depth understanding of emerging technologies and their commercial applications. He has been consistently successful in analyzing market trends and capitalizing on the global market opportunities to create high-profit, high-visibility partnerships.
Good morning and welcome to the Venture Investment Summit. This is Madhu, founder and CEO of Angaros Group. Steve, Martha, and the whole Wholesale investor team. Thank you for having me for this summit. It looks like it was just yesterday that I was in Sydney for one of your conferences. It's not even 2 months, and we are in kind of a new world. Hopefully all of you are safe and healthy, and all the participants welcome. I'll give a brief about myself first, and then some of the topics what I'm trying to cover. I put it in a kind of question what the team has asked me to put, and then the answers are provided. I've been an entrepreneur from 1995. Fortunate I've been an entrepreneur straight out of college. Started my first company at age 25, 23, 24, and then ended up in the two early sectors, which was the prime drivers in 95, e-commerce and gaming. And then afterwards, I was based of Costa Rica for 3 years. Again, gaming, helping a company scale into the European markets. 2009 to 17, I was based in Singapore. And 2017 onwards, I'm based in Dubai. Currently, my focus is on two interesting segments, fintech and gaming as well. So this is a bit of a background about myself. And then the way I look at what we do is we bring all the three capitals for entrepreneurs to be successful: the human capital, financial capital, and social capital. What we talk about social capital is, think of like a level 5 network, where level 1 is acquaintance, you know someone. Level 2 is alumni. Level 3, with alumni, you have done some transaction. Level 4, you have been doing transactions for the last 10 to 20 years. Level 5, 20 to 30 years. Ultimately, like in the financial world, in the network also, trust is the coin, trust is the currency. If you have worked with them for such a long time, you know the what people will appreciate and people are looking at, and you are able to kind of look at the efficiencies much faster and much faster. This is our approach, and it has worked for us for the last 25 years. Even though I played the role of an investor, entrepreneur, advisor, and a board member, I cherish the role of an entrepreneur always more than the investor role. That's why I probably people talk to me as more as an entrepreneurial kind of investor. Now let's go back to the main questions. What we are looking at, given the scenarios is new, it's a new normal. People are talking about unprecedented times, but let's not forget unprecedented times also brings unprecedented opportunities. Yes, it's unfortunate that some of the people are finding it very difficult and lives are being lost, but we have to look at it from a pragmatic perspective and then say, how do we look at the opportunity? How do we assess the opportunity, and how do we leverage on what we have as human beings, whether it in terms of the opportunities or in terms of how to keep people safe. I also believe that when during these unprecedented times, some of the new age entrepreneurs, new age companies will be will rise out of these difficult and challenging times. If you are looking at in terms of as an investor, what are the areas I'm focused on? Sectors or financial services and fintech as a broad sector, and then gaming, entertainment, and media. And then as a key driving force, I'm looking at aggregation as a key driving force. We are talking about aggregation in terms of the effort, aggregation in terms of companies, aggregation in terms of the team members as well. And then we are also tapping into network, as we talked about a few minutes earlier. I always believe ultimately network plays a big important role and deciding role. If you're looking at in terms of what are we trying to do to support our existing companies, how do we look at in terms of helping them deal with the challenges? Typically, the role of investor is not more than just providing the financial capital, but act as a mentor, advisor, and help them face the challenges. And especially in these unprecedented times, no one has ever lived these kind of challenging times in the recent past, or for almost all the people who are living, they have never come across this level of unprecedented challenging times. So we are all in it together. How do we give the comfort to the entrepreneurial team, leadership team, and then help them manage or help them give tips and experience in managing their treasury and cash flow? Because as investors, we have seen time and again, cash flow trumps everything. Cash flow is the name of the game currently, right? How do you conserve the cash? How do you make sure that you are able to bring more cash to the table where you are able to ride this storm in a much more fitter fashion? And then the other part we try to look at is like, so how do we mentor the leadership teams across all the functions? If we are not specialists in a specific area, how do we bring our own network and then help them mentor the investee companies? And then how do we give access to the network, both in terms of mentors, both in terms of potential business opportunities, collaborations, and all those specific areas as the entrepreneurs are looking at. And in terms of, if someone is asking me, would I look at investing into new opportunities? Yes, we are still open for investment opportunities in both fintech and gaming. As a matter of fact, I'm advising a robo-advisory company, Scale, to global. They have had a marquee customers, including the biggest names in the financial world. They just confirmed. They look at robo-advisory from an employer perspective. So that's definitely we are still investing. Investment for the right companies, no matter what times we are going through, there will always be money available. And in terms of the thesis, what would the world look like post-COVID or post-coronavirus world? I see this as a kind of a universal reboot happening across sectors, across geographies, across demographics, right? No one can say that they are not affected by this pandemic. Everyone is affected, to some people more degree, to some people more than less, but everyone is affected. So the way we are seeing it is like, say, like survival of the fittest companies will survive. The question is like, say, what strategies or what tactics they are tapping into in terms of their network, in terms of their experiences, in terms of the structures what they already have, and what are the new structures they are trying to create to make sure that they are able to prepare themselves for the future. That's the way we are looking at. But my experience in the last 25 years as an investor, as an entrepreneur, as an advisor, and as a board member, companies which have the ability to kind of sequence and combine all the three capitals, human, financial, and social capital, will thrive and will succeed. If you're looking at in terms of, like, say, to fellow investors or co-investors, what would be the kind of my 2 cents I would add? Obviously, we always talk about not to throw good money at bad money. Similarly, the way I would look at, given these current scenarios and tough times, we will look at in terms of like not to invest good time or in terms of quality time on time, lost time. There will always be some winners and some, I would not like to use the word losers, but some companies which will not be able to make it given the tough scenarios we are going through. But how do we focus on the companies which have the ability to survive this in a better shape than they came into this unprecedented times? That's what I would look at. And then how do we kind of pool resources in terms of the network? And then how do we make sure that some of the companies are able to aggregate and then they come harder and faster and stronger as they come out of this unprecedented times? And the way it looks like, people have to be ready for at least a couple of years, if not more, right? And these are structural changes happening. And there is a flight to quality at every layer, whether in terms of money, whether in terms of quality of people, whether in terms of quality of opportunities. So I would say that buckle up and brace yourself for extended period of change and extended period of this reboot happening. What are the areas I'm looking at in terms of new winners and new star performers? I think AI will play a role. As we have seen, AI is coming to kind of a mature times now. People have been talking about artificial intelligence and machine learning for a long time now. You're already seeing some of the efficiencies, both in terms of the fintech, whether it's the robo-advisories, or in terms of allocation, stock allocation, all of these things which we are seeing, this will be a definite winner. And then multiplayer games as well, which will become, as more and more people are spending time in at home and then time with families, people will look at in terms of how the different kinds of multiplayer games, we will look at in terms of how the loyalty mechanisms, how the incentive mechanisms are going to be given. That will be a kind of a seen as a key area to focus on. In terms of the criteria I look at for companies to invest, everyone says that you look at, you will rather invest in a team rather than a idea, right? So without the starting point. And then we also look for what are the culture they are creating, the founding team is creating. Is it an inclusive, open culture? And then are they focused on a niche area where they are able to create that kind of a winning formula? And innovation definitely it has to be a way of life. And then the talent has to be there in terms of balance of experience and raw talent, because you need a combination of experience and then raw energy. And then the focus has to be on operational excellence. How do you make sure that the operational excellence is there? So those are the criteria, some of the criteria we look at for companies. And in terms of the founders itself, what qualities and skills I look for is passion. They should have a great networking ability, because what got you here won't get you there. You need to have the ability to bring in right people at right times, more people to make sure that your dream, you're able to articulate your dream and make sure that other people also participate and make your dream as their own dream and participate and help you. And then you should have the ability to experiment. With the experimentation comes the openness and ability to learn. And then without all the most successful founders and most successful entrepreneurs across the history, they have always been workaholics. And the last but not least, people should be great storytellers. If you're a great storyteller and you have all the other qualities, I'm sure that you will be successful. So currently from India, this is Madhu, wishing all the participants of Venture Investment Summit a great new future and a safe, secure, and a stable future. Thank you. I'm happy to chat with any of you if you have any questions. Stay safe, stay healthy. Thank you.
And now, please welcome Rohen Sood. Rohen joined RAIC just after launch in 2014 and is now a general partner. He has worked on almost all the 31 investments made to date across all three funds and sits on the board of Indebted, Basic, Sleep, Curious Thing, Flybits, and Codelingo. Prior to joining RAIC, Rohen spent 4 years as a management consultant with firms such as A.T. Kearney and PwC, working across financial services, FMCG, mining, and private equity sectors.
Hi, so I'm Rohen from Reinventure, and Reinventure is a venture capital fund based here in Sydney, where we focus primarily on fintech and adjacent sectors. And the reason for that is because our primary LP was Westpac. So we basically operate as their venture capital fund in the market, but we separate and independent from them to combine the best of CVC and VC. So what that means is that we have really strong alignment with our founders and a really long holding period, which is different to a lot of how other CVCs are set up. We deploy capital in Australia and New Zealand primarily, but in the last kind of year, we've also been doing things in India and Southeast Asia as well. So we've been going for about 6 years, majority of the time in ANZ. We have 3 funds under management, each one of them $50 million, so a total of $150 million of funds under management. And we write checks up to $6 million. So anything from seed up to Series C. And when we make an investment, we get pretty involved and, our hands-on investors, etc. So what does it mean to be focused on fintech and adjacencies? We think about it in 4 different areas. So first of all is pure core fintech, things like lending and payments, all that lovely stuff. Second is what we talk about as adjacencies. So these are things that are make up a financial services stack, things like cybersecurity, identity, data and analytics. So things that you'll need to do the function of financial services organization. So those are pretty interesting to us as well. Third is this idea of embedding of financial services. So we see software applications and marketplaces as the kind of frontier of where financial services will be delivered. So a consumer or a company might be using an accounting software or a HR software for its primary purpose, but it becomes a really powerful distribution mechanism to give them the financial services products at that point, because you're in the workflow or you have really important data as a result of it. And the fourth area that we've done work in is in, or made investments in, is in the blockchain space. So that's quite a tumultuous area, but we do see long-term potential there and have made investments there in the past as well. So how do we provide value beyond just the capital? So first of all is in lean in through the Westpac relationship, right? And this comes in different forms. It could be just access to subject matter experts that know a lot about a certain space that you're building a business in, or it could be distribution, or it could be a direct investment from the bank as well. It comes in different flavors. Second is within our team itself, we have apart from partners, we have people that are dedicated to help our companies grow and build really impressive organizations. So for example, we have a head of talent. Our only role is to help our companies and founders find the best talent for their organizations, right? And build a really world-class team. We have people in our team that have strategy and financial modeling experience. So helping our founders that don't have that capability to write pitch decks or build models or look at expansion or acquisition opportunities. And finally is the network and community support that we provide. So it comes in 2 layers. So on the community side, we've invested a lot of time and energy in building up, founder days and Slack groups and other events to bring founders together and the broader portfolio community together. So what that means is they have each other to rely on and draw on from their experiences. And the other side of the network is we have really deep relationships through Australia and New Zealand with different businesses, with different investors, but also globally as well. We've got good relationship with investors. So as our companies grow, we can provide them introductions to do the larger rounds. To support during COVID specifically, we've done a couple of things which I think other investors might be interested in as well. First of all, where it makes sense, providing capital. We've shored up some of our companies where the timing made sense and there was other right conditions to give them capital and longevity through this period. Second is providing our founders with clarity in time of uncertainty. Us as investors, we see a lot of things from multiple business models, multiple geographies, that sometimes can be really valuable in this time of great uncertainty for founders and CEOs that are maybe focused on just one industry. So it can really help them make key decisions. Number 3 and 4 are things that we would be doing normally anyway as investors, but I think now more than ever, it really makes sense to do. So rolling up our sleeves and helping our founders where we can, from everything from helping them close deals, through helping them raise capital with other investors, to even helping them with cost-cutting exercise when they have had to go through that. Which also relates to number 4, which is being an empathetic ear, being a support system for our founders, because it's always hard being a founder, but now more than ever, it's quite a difficult period. So being there and helping them and being a sounding board, I think is really valuable. And then finally, what we've also done is actually run some special sessions for our founders. So think from a monthly call for founders to share kind of the experiences they're going through in these times, to bring in outside speakers to talk about, what previous crashes in 2008 were like and how people weather those storms. Speakers on, managing energy and mental health. And also like helping our companies negotiate group discounts at a portfolio level to help them reduce cost where it makes sense. So we are still looking for new opportunities, but I would say the bar is pretty high because most of our focus is going on current portfolio. We've made a partnership with our founders, and this is the time where we really want to kind of support them as much as we can. So this would be probably similar to most venture fund firms in the market, where there is still, we are also looking for deals, but a lot of energy is going in supporting current companies. So what does the world look like post-COVID? I don't know. I don't think anybody does. I think it's an impossible task. And this is kind of a once in a lifetime experience we're all kind of going through. But having said that, there are some themes that are starting to emerge that we're seeing that probably will endure through this time. So on the consumer side, we're seeing an increased digitization, right? So people are forced to work from home from their laptops. So they are getting used to doing more stuff online than they were ever before. There's been an increase in e-commerce, right? So people have more time and some disposable income that they're not spending, in restaurants and bars, etc. That is going on online purchases. So Afterpay and Zip, for example, and fintech are seeing an expansion as a result of this. Third, I think there will be an increased focus on financial fitness. So it's probably something that hasn't been very, interesting for a lot of people, but I think coming out of this crisis, there'll be a whole generation that'll remember this the same way the previous generation remembered, the .com or the 08 crisis. And I think fitness will be something that'll come into focus. And finally, a thing that, I think could happen for consumers is a flight to safety, right? Like if things really do get pretty dire, I think it's interesting in human behavior where we all go to what we know and where we feel secure. So I think that'll be an interesting trade-off for the impact that'll have for incumbents versus startups. And on the enterprise side, we're seeing an increase in efficiency and process automation. Large companies are finding that this is a catalyst for them to actually reduce costs where it makes sense, but also that they weren't very nimble when this crisis hit. So they're looking for ways to address both those issues. The other thing also happening for them is that they're going to be focused more around their core, right? Increasingly, I think in the last few years when times were good, companies were actually expanding the horizon, doing new things because they had the license and ability to do that. I think increasingly people will do really what, the core of the business was. I mean, we saw an announcement of Airbnb recently around what they're cutting back and going to the core as well. And I think a lot of companies will do that. So what that means for founders and companies is that if you're not selling it at the core, then there is a risk there to think about. And finally, I think there'll be a renewed kind of focus in fintech around compliance and security because these things never go away. And having a company in this space will still, I think, will kind of weather the storm probably better than other sectors. So an example of a company that, I think is kind of in our portfolio, kind of using COVID as a tailwind, because I think there's certain companies that are, affected negatively, some were neutral, and some that this has actually been an actual tailwind for them is, for example, Indebted in our portfolio, where what they're doing is they're actually transforming the exciting world of debt collection, which I know probably gets everyone's hearts racing, but it's an industry that's had a lot of challenges in the past with bad actors, with regulatory hurdles. And what Indebted is doing is really coming at it from a very different angle. They are attacking that industry across three vectors. Firstly, they're looking at, they've built a platform that is very, very powerful in terms of the efficiency they can drive in how they collect from people. And also they can contact people on channels that they actually want to be contacted on through SMS, WhatsApp, these kind of things, rather than a harassing phone call at 10 a.m. in the morning when someone's at work. Second is the data that they collect, right? So they can based on if somebody is a 20-year-old surfer, with an overdue Afterpay account versus a 50-year-old with an overdue mortgage account, that communication looks and feels very different on who they're talking to. And finally, they're actually incentivizing their staff and agents not on what they collect, but actually the user experience and feedback. So they now have more than 400 5-star reviews on Google from people they've collected money from. because they're taking this very human approach to this collection, because what they recognize is a lot of people in these times in their lives, they just fallen on a difficult time and need some assistance and help to get through it. And that's what companies want as well. That's what large telcos and banks want as well. They want people to get back on their feet. So this is a company in the current environment that is getting a lot of, the right dynamics to help them grow, because more people are in a difficult space, but also that people deserve to get out of this space and they need the right kind of support to do that. So I guess what do we normally look for in a startup when we look at deals? So I think, I talked about focus on fintech and adjacencies. I talked about the fact that we look for seed to Series C deals, and I've talked about the geographic focus that's primarily in Australia and New Zealand, but increasingly in Southeast Asia and India as well. But beyond that, we look at, from a business perspective, the business dynamics. So we look at how large can the company get? Why is now the right time? I think that's a very critical question, because you can have a great idea and a great team, but sometimes timing can be off. Is it a crowded space? Is it disruptive, sustaining? And, what are the moats for this business for long-term success? And then we look at the metrics, how quickly is the company growing? What's the revenue? What is its lifetime value and unit economics? Things like that. And finally, the deal terms, right? Like, does it make sense for us as an investor to participate in this company at the right holding and valuation? But that's on the business side. On the founder side as well, which is incredibly important, it's probably the most important thing. We'll look for founders that are ambitious, because we want to back big businesses, and the venture capital model is built to back big businesses. That's the truth. We look for people that have a lot of hustle, that want to get stuff done. We look for a spike in the team. And what I mean by that is, like, what is it in this team that is truly unique or different from everybody else, right? Like, why they're better than somebody else going after this space. So that could be a founder that's incredible at pitching, could be a founder that's incredible at product, or somebody that has really keen strategic insight into the domain that allows them a wedge into execution, right? We look for founders that have a healthy co-founder dynamic, because that's really important for a longevity of a co-founding dynamic team and the team going forward. And finally, we look for alignment of values, right? Like, this is a long relationship, and I think we all should be spending our time with people that want to build a world similar to what we want to build. And finally, as a bonus, if someone's a repeat founder or a team is a repeat founder, that's really compelling as well, because they've gone through that journey before. So look, that's probably all the time I have. And if you want to get in touch, reach out to our info account or to me personally on Twitter. So yeah, thank you very much. Cheers.
And now, please welcome Catherine Lyle from SeedSpace Venture Capital. Catherine is focused on developing the Australian fintech ecosystem through various channels, including as an angel investor, as an advisor to the SeedSpace Venture Capital Fund, as a co-founder of non-for-profit Seed Money, as well as taking on a number of non-executive director roles on startup boards. She looks to leverage her 31-year career in capital markets as a derivatives trader, exchange executive, non-executive director on a bank board, strategic advisor and markets infrastructure specialist to accelerate the adoption of fintech in financial services across all the key silos. Additionally, Catherine is a co-founder of Seismic Foundry, a discretionary fund investing in the UK capital markets fintech. She has been listed in Financial News 100 Most Influential Women, Innovate Finance 100 Women in Fintech, Bramall Most Influential Women in the City, and Qantas Australian of the Year in the UK.
Good afternoon. My name's Catherine Lyle and I'm an advisor with SeedSpace Venture Capital, an early stage venture capital company founded here in Australia. And it's great to be involved with the CRIISP Venture Investment Summit. So Seed Space, as an early stage VC, has been very focused on financial services. We saw early on that financial services, particularly markets, are very highly disruptable. And we also saw that technology was really shifting towards financial services across the value chain, from execution to clearing to settlement, for B2B to B2C to B2B2C. The size of the market in financial services, the growth of fintech in those markets, and of course the profitability of our very large financial institutions here really propelled us to set up this early stage fund last year. And we invest in fintech companies across all the major fintech cycles, and we'll talk about some of that later on. We've really been positioning ourselves at the centre of the startup ecosystem here in Australia, and the partners and advisors in the fund have global experience in US, Europe, APAC, and here in Australia. We've partnered with some really highly regarded companies that are very experienced, and they provide us a range of services, from really strong operational support, deal flow, which is really important, and obviously overall industry support. And we're really pleased to be not just a partner, but a sponsor with all the major fintech institutions in Australia. A lot of people ask us what our criteria is for investing in companies, and especially now with all the COVID-19 challenges. And I'd have to say that our kind of criteria for looking at investments hasn't really changed much in these times, because the fundamental tenets that underpin all our investment decisions remain in challenging times and in good times. So the three things we focus on the most, and then many things flow out from this, are: one, the team. Who are the founders? What's their experience like? Are they a strong team? The second thing is, what's the problem that's being solved? And is it a problem that actually wants to be solved? And the third thing is the technology. Is it truly groundbreaking technology? Is this a defensible business play? And then while we're talking about founders, some of the key criteria we look for in those founding teams is certainly experience and that subject matter expertise. But we also really look for things like resilience. Coachability is really important. If you're going to take outside capital and you get a lot of expertise that comes with that, it's really important to be able to accept that expertise and take advice, take challenge even. So coachability is a really important part with the founding team. And the fourth one, which is, you could argue, is almost the most important with founders, is that whole vision and values. And that brings into it culture, it brings into it ethics, and it also plays straight into the governance model going forward. And as an early stage investor, seeing a really strong governance model, a really strong culture, a really strong vision and set of values being deployed out across the organisation right from the start gives us great confidence that the company will grow and expand from Series A to Series B to Series C in a much smoother fashion. Having to tackle those problems at a later date is often very expensive for everybody concerned. Obviously, right now, supporting our existing companies is really critical, and there's a number of things we're doing right now as a fund to do that. So first of all, capital. So those of our existing invested companies are benefiting from follow-on rounds, and where necessary, we're bringing in co-funding partners with us in seed rounds, in the follow-on seed rounds that are happening right now. We also do a lot of mentoring with our companies, and we are an open door for any advice at any time when needed. And as you can imagine, in the last month or two for some of those companies, it's been really challenging. Capital preservation has been a real focus, at the same time as trying to push forward with growth, and having trusted people to talk through that is really important. We also provide introductions and referrals to the companies in our portfolios, and they have the benefit of our much bigger and broader networks. It's a pretty strong team if you have a look at our website. So any companies coming into financial services can really benefit from that group. We're often asked, are we still looking for new opportunities right now? Because a lot of people are sitting on their hands and a lot of people haven't got as much capital to deploy. The short answer is yes, we are. And it's at times of great change and disruption that interesting and agile companies are created, so to solve for immediate problems and for future needs. So we are always on the lookout for new companies coming down the pipeline. There is a caveat, of course, that we are prioritising our existing investee companies because we really want to ensure that they survive and thrive. And that includes following on investments where appropriate, as I mentioned before. We get asked about our investment philosophy quite a lot and what guidance we give to others who are investing and looking to invest right now. And I would say diversity within your portfolio, if you're looking at early stage companies, is really critical. Having a really good portfolio distribution across your early stage companies, especially in fintech, is really, really important because you really don't want to miss out on any outlier investments that generate major returns at that early stage with your capital. And that's why we believe an early stage VC fund like Seed Space, and there are a few small companies like ours in Australia starting to flourish. It's a really good way to ensure diversity across a broad range of fintech silos in your portfolio. So definitely worth looking at the early stage VC funds like ourselves. We have a pretty strong due diligence and investment committee process, and we are often asked what we think are going to be the star performers over the next year or so in the areas that we operate in. As I mentioned, that's in fintech across the broad range of silos. And our view right now is the sort of the 4 key areas will see some significant performance enhancement. Going forward is the wealth tech space, prop tech, property market, payments, and actual marketplaces, whether that be platforms or SaaS, etc. So lots of opportunities going forward and very much worth investigating as an investor, the opportunities out there. I mentioned before we've got a strong team and we've all been working very hard to understand the implications of things like the COVID-19 crisis right now on current markets, what the future of those markets look like, and how we may help markets evolve and develop and thrive as we go forward. We've been asked, what is our thesis post-COVID-19 and how do we see things changing at all? And I guess we would see an even stronger and more enhanced adoption of technology across the board in all areas of our lives, but specifically to enable more efficient use of financial services, both at the retail end and right through to the corporate end. This crisis has really highlighted to all of us the importance of technology in enabling new ways to do business and to work, whether it be remote working from home, doing digital sales engagement to tech ops. And we believe it's going to really accelerate the acceptance and adoption of technology across a broad range of financial service. And that really underpins what Seed Space's primary fintech thesis is all about, actually. So as a fund, we've spent the last 9 months when we started proving our own proof of concept. The founders of the fund and advisors have put their own money in, and initial investments have been made across 7+ companies, which are all, we've seen some really significant upticks on second rounds for some of those as well. And so we're now just opening ourselves to external investors for the first time. And we would welcome a conversation with anyone who's interested in understanding the alternative space and having a real conversation about diversification of your portfolio in that space. I'll remain around after this on the YouTube chat, and I'm very happy to answer any questions. Thank you very much for your time. Bye.
Welcome to our last session, Advanced Tech. Welcome the first speaker, Stephen Zhu, co-founder of Uni-Innovation Group and the founding partner of INP Capital, which focus on global investments in high technology, relevant industries and cannabis industry. He is currently the chairman of THC Global Group Limited, an SAX-listed medical cannabis company. Stephen specializes in financing IPO and mergers and acquisitions activities in a broad range of sectors, including technology, smart manufacturing, and healthcare. He has strong international connections, especially in North America and China, and supports portfolio companies expanded in China successfully.
Hi everyone, my name is Stephen Xu. Thanks for this opportunity to talk about our company and also share experience during this COVID-19 was a challenge for the investors and the founders, and how we grow together with our investee companies as well. First of all, I will spend time to talk about the three parts. So first, talk about who we are and our focus and approach, and the last one will be, the challenges and the opportunity during this period of time. Uni-Innovation Group, we have three main business streams. One is investment, which venture capital investment focus on technology and healthcare sectors. We're based in Vancouver, Canada, our venture capital technology fund, and also we have a Cayman Island private equity fund, which focus on more later stage companies. I will talk about more in the next few slides. The second business is incubation, which we have a net plus startup community for helping startups to soft landing in China and Canada, and also help them to expand the business with our connection expertise. The last one, advisory, is more about to help company M&A transactions, provide advice on raising capital and market expansion into China, Australia, and Canada and US. So our office in Canada, US, Australia, and China, and we have a network partner in Israel and London. So all these networks provide global access to our deal flows. Our core team, Jackie is the group CEO and the founding partner of IMP Capital. IMP Capital is our investment arm, and myself, based in Sydney, and the group CEO and the founding partner of IMP Capital. Jessica Wang, the group CMO, and also the partner of IMP Capital. Jessica is based in Vancouver, Canada. So Jackie and I cover China and Canada, US. We'll cover those three regions. The next one, I would like to talk about more about our focus and approach. So this all around investment under our venture capital fund. So our focus on a big two industry of technology and healthcare. Drill down into the specific sector, as I just listed 4 sectors, we have a significant interest and invest in those areas as well. First one is fintech, and the second one the healthcare, and the third one is a cross-sector technology application. The last one is eco innovation. So regarding the fintech, I've just listed a few area we really focus on the opportunities globally. So digital banking, and also the unbanked, underbanked solutions, which this part, I think during this COVID-19 have a significant booming in Africa and also Southeast Asia and the South America area. The last one is the insurance technology. Regarding the healthcare, we look for opportunity in the drug discovery and development, telehealth sector, medical devices, and medical cannabis. Cross-sector technology, because a lot of technology application can use in different industries. So we classify those technologies under this area, which is the blockchain, robotics, AI, and drone. So regarding the blockchain, we have portfolio companies using the blockchain in banking industry, in the music right industry, and using in the logistic supply chain industry as well. For the eco-innovation, this is about environmental friendly technology or green technology innovations, like waste management, how to deal with the waste, manage the waste, and also the clean energy. So currently we have two series of funds. One is IMP Technology Fund, which is focused on early stage companies. We invest globally. Currently, we have 7 portfolio companies across Australia, Canada, US. And the size of the IMP Technology Fund is 20 million Canadian dollar. And the other series fund is Green Gold Fund, which focus on medical cannabis globally. But that one is basically centric of medical cannabis or cannabinoid application regarding or related to biotechnology or pharmaceutical industry. So that fund is Cayman Island Offshore Fund. The size of the fund is 100 million US. Currently, we're in the capital raising for this fund. And we have 2 or 3 company investing in Australia as well. One is in that fintech area. The other one is in 3D big data solution. And the last one is the medical cannabis. So these are our portfolios. Our approach, so we position ourselves as boutique venture capital company. So we really are not financial investors. We position ourselves as strategic investors. We would like to, invest not just with the capital, but with our, ecosystem and our connections in different countries, and also our resources or access to the capital markets as a whole package to grow with the founders with, very smart innovation or the technology of the future, and then basically return the investor significantly above the average returns compared to other investments. So that's our approach. We for the early stage company, we really manage them quite actively, and for the later stage company, we bring more market access or the growth opportunity to them. So our investment criteria is basically this 6 area. And team is the first, I think, key criteria. We're looking for the founder teams or the founding team have, clear vision, passion, and a huge delivery in what they are doing, and the strong execution capability, and also with, open mind to adapt to the environment change or the situation change. So that because we invest quite a few early stage companies, so the team actually is very, very important, and we have experience identifying the good quality team, good quality founders. The second one is the target market. So regarding to the market, we focus on advanced technology applications in that market segment with significant potential in growth, and also have like disruption opportunities. Competitive advantage. This is talk about the core technology or IP or the product that the company has or develop or innovate would have the advantage compared to the peers. Cash flow. This is more about the later stage companies. We focus on they should have clear visibility of positive free cash flow near term. But for the early stage companies, this cash flow is not that a critical compared with the other three area, but still we look at down the runway 3 to 5 years was your pathway for generating the positive free cash flow. Valuation. So valuation is more about the valuation of the business has to be reasonable and justifiable. Scalability. This is very important. All stage of the companies would like to invest or be interested in those companies who can be quickly create scale in the business and gain the market share. So those are the criteria for reinvestment. And next, I would like to talk about the challenge and opportunities during and post COVID-19. At the very beginning of the year, we have a lot of conversation with our portfolio company to understand what exactly this COVID-19 situation would impact their business, their team, and their capital or cash flow runway. So the challenge here is, I think most of the company, especially for the startups, will have faced significant challenges. I think in the past 4 or 5 months. But I think from the founders and the investor, we definitely can, help to smooth or to mitigate some risk and to keep the company going, keep the business going, and then after this tough period, the next growth wave will really help or really pick up those quality companies and become as star performers. So I just list a few area I, based on our experience, would like to really benefit for the company and the investors. So from the founder point of view, I believe that the open and the regular communication with the team, with the shareholders are very important, and also with the customers. Because you have to be, realistic and have to be cautious and on what the trend will be, what is the worst situation will look like, and to ensure everyone on the same page and to work together. The second one is to tighten the cash flow. I think that's very important for all the companies. For that part, not just reduce the cost, reduce the spending, but more looking for any other cash generating activities that might be your main business, might be your side business, and also might be the government subsidies. So this part need to really the team and also some investor can bring some like a connection to the investee company to help them to look for more opportunity to get some cash during this tough period. And the third one is keep capital raising. I think under this circumstances, the capital markets is really challenging. But it's still have opportunity, the investor looking for a good quality deal with reasonable or would like to, pick up some bargains at the time. So we really encourage, founders to keep talking to the potential investor or the investors or existing investors about their capital raising plan. And but I think that importantly, the founder has to be really prepared for more unsuccessful capital raising conversations. I think for this one, we have 2 portfolio companies actually complete 2 big round capital raising just finished in March and April this year. That's really encouraging, and also that's demonstrate the founder's capability to manage cash flow to promote their company. But of course, this COVID-19 provides some opportunity for them as well. They identified. So that's something really glad to see. And also we have participated this round for those 2 companies as well to show our confidence and support for the company. And I think the last 2 is more like you have to embrace yourself or the whole team in this new normal. We'll talk about a lot of different ways doing business, like online or video conference, teleconference, any way you can reach the people, reach a customer or investor. And I think be brave to raise hands to shareholders or existing investors to talk about your challenges, your difficulties, and to see if they have connections or resources can help you to expand the options you can have. I think from the investor point of view, if you are a financial investor, I think now time you may be proactive to communicate with your investee companies. I think that's important to understand their situation, the current status, the cash flow runway, and also use our networks to help them to access to the different market or different capital market. And also if such like us, we have experience developed funding solutions or to design the cash flow management plan, we can help or we can work with the investee companies to do that. And the most important, promote your investee company whenever you can. I think this is the time you really stand out and to talk to the people about some like the company you think it have a great potential, but it's just because this unprecedented timing. The last one will be for the capital injection. I think that is more about if the company has a lot more potential, and this time will be a good bargain, and also you have for the capital can invest to pick up more shareholdings. I think that's a good opportunity as well. And the next one, I'll talk about some opportunity. I just highlight some of the opportunities, but there are a lot more we can do or we can invest. I think from the investor, what we're looking for is the potentials during and after the COVID-19. But at this time, it's good for high risk appetite investors to pick up some really quality deal with attractive valuations. So the first one I will highlight the healthcare sector. I think healthcare sector is always anti-cycle industry, which they always have their own pathway to grow. But here I would like to highlight the telehealth sector, which the Australian government invests a lot on this area, and I think the more and more people during this period of time, used to or adapt to this telehealth tools, maybe through a phone call or video conference or app. You can get some advice from the doctor and prescription. I think this is basically, it creates more opportunity for doctor to take care of the patient, and the patient can access to different doctor as well. For the online communication, I think obviously, we a lot of people now is work from home. We use either Zoom or other Microsoft Team software. A lot of different these online communication tools to help us to do business and then continue our life. So I think that's very important. I think after this post COVID-19 period, we kind of move into a new form a new habit. Is the video conference is kind of part of our work life or a life. So I think the adoption for that online communication tools or different company who run that platform will have a significant opportunity during and post the COVID-19. The next one is the robotics application. This part is more talk about, we just reduce the cost and bring more manufacturing opportunity locally, because we experience, the border shutdown, the logistics supply chain has changed significantly. But the robotics actual application into warehouse management, into the manufacturing, smart manufacturing, and also logistics are very, I think, high potential in the next 3 to 5 years. Social influencer marketing, this will be a very interesting area. Because now it's just we more and more used to online shopping, or watch people introduce different products through different platform like TikTok or other short film platform. I think that create a batch or the group of, we call the influencer, or we call internet celebrity. So their power for selling the goods, for the marketing has grown significantly in different regions. In China, that's pretty much a big industry now, and one person can sell millions of goods, and they have hundreds of factory or company behind that to form a complete supply chain to promote their product through that influencer. I think this will extend into all different countries, and I think that growth will significantly in the next 12 to 24 months. The last one is digital banking. A highlight here is, we see a lot of ads now in Australia. The banks, the traditional banks, actually promote their online banking app or online banking service. I think this will significantly change the people habit to do banking. So, digital banking, you use mobile phone ads, medium, and using different app to do daily banking service. That will significantly change the traditional banking and also reduce the cost. And also, the digital bank will be the second wave of, people can not just rely on, traditional banks, which provide, relatively high cost, and the big ship carry a large fixed cost. But we will use that opportunity as a consumer, can benefit, the low cost banking service and, faster wire or transaction as well. So I think that's great opportunities we will see in that area in the next 12 to 24 months. So yeah, that's all I would like to share with everyone about our company and our investment criteria and area of focus. Thank you for having me here.
Thank you, Stephen. Our next speaker is Andrea Gardiner from Gelix Ventures. Andrea has been an investor, entrepreneur, investment banker, lawyer, company director, and a world-class climber and skier. She is the founder and CEO of Gelix Ventures, which she started to provide investors with access to carefully curated investment opportunities in world-class Australian technology startups. Gelix invests its own funds in daring startups working for a better future and invites investors to co-invest on the same terms. Gelix is currently raising an early-stage venture capital fund, offering investors the benefits of a diverse technology startup portfolio. Andrea is a board member of Synorbis, Taxspace, and Old 100, and previously was a board member of Stone & Chalk and VioStream.
Hi, I'm Andrea Gardiner, the CEO and founder of Gelix Ventures. We will skip the legal stuff. We're experienced early stage investors. We're very proud of our track record. We've invested almost 6 million across 21 investments into 4 startups. We were pretty delighted to return 10x to our investors after 3.5 years in one of those. And we've had 8 valuation uplifts, so the portfolio is performing really well. We also have pretty extraordinary deal flow. We have about 1,600 applications a year together with Innovation Bay. So there's 2 ways to invest with Gelix. You can pick and choose the deals that you would like to co-invest with us on, and you can invest in the Gelix Ventures Innovation Fund. So the COVID-19 crisis has produced pretty substantial global economic fallout, as we're all aware. And the impact on startup investing and venture capital has been fairly substantial. There's I think it's generated a lot of anxiety, and I think what's happened is that venture capitalists have moved away from focusing on growth to focusing on survival. And there are some VCs that have recently raised dry powder, recently raised funds, so they've got plenty of dry powder, but they're VCs are generally increasing their reservation funds to support their portfolio companies. And I think there's been a slowing and in some cases even a cessation of investments. There's been some pretty significant downward pressure on valuations that we've seen, and there's been a real exacerbation of the seed funding gap that I'll talk about shortly. So this slide shows the massive increase in venture capital funding that you can see in the graph on the left side, and on the right side you can see the fact that there's been a reduction all the way down from sort of 61% in 2014 down to 45% of seed funding, professional seed funding. So there's a real market gap, and I think that it's been exacerbated by the crisis, and that creates a real opportunity for us. So what have we been focusing on during the crisis? So firstly, we've been focusing on supporting our portfolio founders. We've been helping them think through the challenges to identify and mitigate their risks. A lot of that has been focused on cutting costs to extend runway, and we've been aiming for at least 24 months runway. I think we've got 72% of our portfolio companies have more than 12 months runway, and 55% have more than two years runway. So we're doing okay on that. But it's been really important to ensure that that cost cutting hasn't eroded the core competencies that they'll need in place to, you know, on the other side of the economic fallout. And we've also been working with them to identify and leverage opportunities. We've made a real effort to increase the level of information flow and transparency with Dulux investors. So in addition to regular email updates that are pretty comprehensive, we've been hosting Zoom webinars with our portfolio leadership teams and those of our investors that have invested in those companies. And, you know, quite a bit of that has been focusing on Q&A. The other thing that we've been looking at is supporting the Dulux team itself, as we've encouraged all our portfolio companies to do. Look after your team, increase your communications. We now have a Zoom call twice a week, as you know, on top of all the other communications. And you know, we try and be sensitive to the challenges of working at home. We've got someone, you know, one of our key members, Alan, has very young kids, and it makes it really difficult for him to work at home. And we're also looking at new investment opportunities. We actually think that the crisis actually has generated some really significant investment opportunities that I'll talk about soon. But, you know, we're looking at those companies that have a well-timed solution to, you know, an acute problem, you know, with a really global market and a very, very strong team. So this is just a list of some of the ways that our portfolio companies have been leveraging opportunities in the crisis. Let's think of one here. So Snapper is now offering, it's a photography marketplace. It's offering contactless shoots. I think Whooshka, which is I don't think I've even got that on there. But anyway, Whooshka it's a pretty comprehensive audio solution. It started out as a podcasting platform, and it's released a private podcasting solution for schools globally, and it's free for schools globally, and it's also released that to as an internal communication solution for enterprises, and that's doing well. And there's quite a few others in there too. The post-pandemic world, we see the economic cut through has been pretty deep and is likely to deepen, and I think people being forced to work from home and conduct businesses from home it's going to change the future of the way we work. People that might not otherwise have learned to work productively at home are now doing that. Increasingly, we're using telehealth and online education, and I think that those technologies that enable these changes to the way that we live and work provide, you know, pretty strong investment opportunities. So, for example, one of our portfolio companies, Inquisitive, provides pretty extraordinary online learning content for primary schools, students and teachers, and technology, generally technology that's enabling these shifts and adapting to the changed new world we see as being real investment opportunities. We're also seeing decreased costs. So, you know, I think there's, you know, there'll be less competition as less agile and robust competitors fail. And as they do, then there's pretty awesome talent that can be snapped up, and that can be really game changing. And there's also going to be decreased costs, I think, because there'll be less demand for physical office space. and things like bank branches and insurance branches. We actually think that now is a great time to invest. Innovation that enables adaptation to the new world order I think these sort of businesses are going to, they're in a strong position, I think, to make great returns for investors. And billionaire investor Ray Dalio, he's done some historical research which demonstrated pretty clearly that innovative technology that enables adaptation to a new world order following deep recessions and depression have performed better than any other investments made during those times. And I don't think it'll be any different now with the current crisis. So, as I was saying earlier before, that it's those sort of tech that enables the adaptation to the changing world that I think will be is where the real investment opportunities lie. Oops, sorry. I think I've covered most of that. So some of the unicorns that came out of the GFC, you can see the big logos up there. They're big names. Zoom and Instagram, Slack, our very own Canva. I think they attest to the veracity of the judgment that there's lots of opportunity out there in these particular turbulent economic times. And we recognise that, venture capitalists, they make money when they're right and others are wrong, really. And that requires strong independent thinking. And we really believe that there are lots of opportunities out there being generated by the crisis. And a lot of those are the deep tech opportunities with game-changing technology that provides a really strong competitive edge. And that's what we're interested in investing in, combined with really strong teams. So what we look for in terms of our investment criteria is, firstly, we don't want to invest in anything that causes obvious harm, like gambling or pornography, tobacco, things like that. And we do have a bias for positive impact. We invest in A-caliber teams. So what I mean by that are people with significant intellectual firepower and a genuine appetite for learning. And that enables people to shift and change with the changing economic environment. And that's really important that startups are agile, because you can't get it absolutely right from the get-go. And people that are really passionate about what they're doing and are so able to attract A-caliber team, attract A-caliber strategic partners, advisors, customers, all that sort of stuff. And as I said earlier, a distinct competitive advantage in a huge global market. And they're really the things that we're looking for. The other way of investing with us is in the GLX Innovation Fund. So we're currently raising an early stage venture capital fund. It's a good way to spread your risk over a minimum of 25 investments, although we're aiming for a lot more than that. And we have a structured strategic approach. Our strategy is to invest small checks early and gain an opportunity to build that relationship advantage and that informational advantage, which is probably the best due diligence, is watching how they operate and how and when they hit their milestones. And importantly, that relationship advantage that will allow us to win the opportunity to write much, much bigger checks in follow-on rounds, and that way focus the bulk of the fund on the best performing portfolio companies. So this is our team, and if you'd like to invest with us and be notified of some opportunities, please do register at gelix.vc, or and if you want to find more about the fund, just email me at andrea@gelix.vc or call me there. So over to you guys for Q&A.
The last speaker of this session is Martin Dersma, partner at Main Sequence Ventures. Martin has over 25 years experience as a senior executive, technologist, business founder, angel investor and mentor, both in Australia and the United States. As a vice president and head of the Global Technology Office, Martin led due diligence in over 60 transactions totaling at $2.5 billion in value. Main Sequence Venture is a deep tech venture capital fund that invests in companies translating research into global scale businesses.
Hello everyone, my name is Martin Dersma. I'm one of the partners at Main Sequence Ventures. Over the next 10 minutes or so, I'd like to give an overview of Main Sequence Ventures, our portfolio, and how we think the world has changed or will change post-COVID. Well, the last 5 months have seen a dramatic impact on both Australian and global society. In the Australian context, we've seen crippling drought affect many states and then followed by bushfires. And we've seen scenes like this. Ordinary people sheltering on beaches to stay away from the flames. And after the fires, literally within weeks, floods. These floods have caused further devastation in regions that had just been hit by the fires. And now on top of all the natural disasters, we have a global pandemic that's impacting us from a health, society, and economic angles. I don't think it's been since the Second World War that we've had such a singular impact on global society. We've had economic shocks and small skirmishes and even minor wars, but nothing has affected so many people globally all at once. So this is our new world, a world that is undergoing change and a world that would accelerate change in many areas as people look for solutions. So this brings me to Main Sequence Ventures, and it's the role of venture capital to invest in some of these new solutions, especially while they are still risky and unknown. And indeed, the type of fund that we are is exactly the type of fund that invests to drive some of the changes needed and help early stage business develop solutions for the new world state. Our objective is for our team to be regarded as the go-to venture fund in Australia, the go-to deep tech fund. We want to be the #1 choice for the Australian entrepreneurs and researchers who aspire to build a globally significant company with foundations in deep tech and deep science and technology. This is because we believe that when you get a deep technology business right, it offers the best opportunity for long-term outperformance. So our investment focus is research-led startups from CSIRO, Australian publicly funded research agencies and universities. And we also invest in SMEs who collaborate with these research organizations. So that said, we're also mission-led to the extent that the members of our team aspire ultimately to do good things on the planet. We genuinely believe that many of the world's greatest challenges right now are also its greatest commercial opportunities. Finally, we believe that there are awesome pockets of world-class research in Australia and that we can continue to build companies here that will be globally significant. Our genesis is from the National Innovation and Science Agenda, or NISA. The NISA program acknowledged that we have world-class research in Australia, but we've not always been world-class at the commercialisation of that research. So the government asked the CSIRO to set up a venture fund that specifically funds companies that have spun out or are connected to research. We fundamentally believe that access to research will provide a competitive edge to the companies we support. So we're a $240 million fund, so one of the larger VC funds in Australia. And we have investors that we call lean in. These investors are either strategics or have networks that can materially help our portfolio companies. Our connection with the CSIRO also provides a key source of differentiated deal flow, from spinning out teams of scientists wanting to commercialize to actual company formation around a piece of science. As well, we have brokered research collaborations for over half of our portfolio where these previously did not exist, giving our companies access to world-class research. Also, our connection to CSIRO provides access to a deep well of over 3,500 data scientists, physicists, synthetic biologists, chemists, astronomers, and specialists in many other disciplines. This access to subject matter experts and their own global networks is central to our due diligence process. Our relationship with CSIRO has been structured to ensure that we are independent in our investment making decision. And that said, our investors and LPs also have the comfort of knowing that our operational framework is in keeping with the broad governance principles of a significant government agency. And we invest early from seed onwards, and in over 70% of the time, we are the first venture investor in the companies that we support. Now, we've been operating for just under 3 years, and in that time, we've made 25 investments. These investments broadly fall under the themes you can see on the screen, and I'd like to highlight a couple from each area. Our first theme, exponential machines, is augmenting humans with mass scale automation and computation so that we can do more with less. So accompanying this theme is Q-Control. Q-Control is building quantum control software. This software is critical to all the companies around the world that are building quantum hardware, as the Q-Control solution controls errors and stabilizes the qubits, allowing the hardware companies to extract more performance out of their products. A second company in this theme I'd like to highlight is Emerson, who are building autonomous drones for use in GPS-denied environments, say like mines. These drones autonomously map the mine and take the human out of the loop. This is an example of human-saving tech that will get even more traction post-COVID. Our next theme is humanity-scale healthcare, increasing the standard of care for everyone while driving down costs. CoView is a company that delivers a telehealth solution, allowing a doctor or specialist to deliver a remote consult. As you can imagine, this solution has gone exponential in the last few months as an example of a solution for the post-COVID world. Our next thematic is around feeding 10 billion people. Now, as the world population has just recently hit 7.5 billion, we need to find even more efficient and more sustainable ways to feed the planet. The company V2 Food is an example of a new organization delivering plant-based meat. It's also an example where we formed the company. So in this instance, we had seen market pull for plant-based meat. So we dug into the CSIRO, found some awesome technology in this area, and with a commercial partner formed V2 Food, and the products are now shipping and available. You can go out today and buy a Rebel Burger at Hungry Jack's and V2 Mince Meat from Marley Spoon. Our next theme is New Society. Here we are looking at companies that help make society safe, as well as help retool society. Practera is a company that delivers an experiential learning platform for university. This allows students to get their education both online and in the field in a monitored and mentored way. This uplifts the education experience and results for universities that use the Practera platform. Lastly, our space-powered planet theme. Well, space is a rapidly expanding area, starting to grow with commercial endeavors, where previously it was solely the domain of government players. Companies like SpaceX have shown the way. So Myriota is a company that uses low Earth orbit satellites to deliver a global Internet of Things solution. Think of a radio transmitter the size of your fingernail, connected to some form of sensor that talks directly to a satellite. Just amazing. Now, to deliver on our themes and find great companies, we also have a great team. The 5 partners in the fund have deep experience in starting companies, running companies, corporate backgrounds, and venture experience. This, coupled with the 3,000 scientists and the CSIRO, is a very unique combination. And when we invest, we look to see if companies can also leverage the facilities and labs that are managed by the CSIRO. This often saves a startup from spending money on expensive equipment when they are still working on their prototypes and pre-production. As mentioned in my V2 Food example earlier, we also do company creation. This is very unique. If we see the right opportunity around a new industry and some great research, we'll look to form a company and catalyze that opportunity. This is quite a different approach to many VCs. We're also very engaged with grassroots science teams. We work with a number of universities as mentors, and in their incubators, we help early stage teams to get that light bulb moment for their tech, and when their science can be applied to a large customer problem or challenge. And of course, industry connections is the final piece in the puzzle, collaborating with our strategic and industry investors to find the opportunities and market validation for early stage products. Often the hardest thing for a startup is to get a foot in the door at a large enterprise, and our deep industry connections can often facilitate that door opening. So that was a bit on main sequence and how we operate. But as mentioned earlier, our world has changed. We're now in a COVID or post-COVID world. So there are lots of questions we need to think about. Now, travel has dramatically changed. Healthcare is being delivered online. Financial markets are just not predictable anymore. And what about if we need to get all of our food delivered? These are just some of the questions that we are now thinking about with the types of companies that will be needed to solve these urgent problems. So if we think across the 5 themes that I've mentioned before, let me give you a couple of examples of things that might have changed. So in our exponential machines area, we need to dramatically improve computing so that we can simulate nature for faster discovery of drugs. In our humanity scale healthcare area, you can see a trend to virtual hospitals and clinics. And in feeding 10 billion people, improving food security and supply chain has now become super important. So how can we localize food production so we don't need to rely on these long supply chains? And in new society, immersive working experiences from home now need to be the norm. And what about universities? As students can no longer travel to university or physically get to universities, how can we deliver a 1 million student university as education goes massively and totally online? And finally, in our space-powered planet theme, getting real-time data for some of the catastrophes and disasters that we've recently experienced, such as wildfire and floods, is even more important as we need to make our society much more resilient. So these are just some of the things that we have to do. And together, I think we can achieve this. So if you're an investor, we would love to hear from you, as in the second half of this year, we're starting our next fund. And if you're a startup or a science team tackling one of these huge global issues, we'd love to chat and see how we can work together. Thank you.
We are going to finish the summit off with the panel session about investment trends and themes during and post-COVID-19. Please welcome our panel of experts. Melissa Widner from NAB Ventures, Sean Holland from Investec, Anthony Millet from Antler, Australia, Stephen Zhu from Uni-Innovation Consulting Group, and Kylie Merritt from Ausbiz will be the moderator of the panel.
Well, thank you all so much for joining us. Melissa, I might start with you. Could you just cast your mind back to January? It wasn't that long ago. The world was a very different place. What's changed for you sort of fundamentally about the venture capital space, if anything, since then?
Well, I mean, a lot has changed. Obviously, the world has changed. But I started in venture in 2000 in a firm in the US. And that's when things were, you know, it was the tech bubble, which crashed, sort of started crashing in 2000 and finally crashed in 2001. So I've been comparing what's going on now with what went on then and seeing, you know, the changes that we had to make with our companies. And what the interesting thing about this time is it feels very compacted. You know, the crash there happened over a period of 17 months, sort of from March of 2000 until September of 2001. And here, where it was September 2001, September 11th, where people realized, okay, you know, the party's over. It's really going to be difficult. You know, there was sort of a slow burn in between that time when the stock market started to go down and September 11th happened. And this feels like that 17 months was compacted into 4 weeks. So everybody sort of very quickly got that, you know, we're in a new economy, and we're, you know, operating has changed. The probability of attracting future capital has changed. Everybody's, you know, we're having board meetings as opposed to once a quarter, sometimes twice a week. So a lot has changed.
And I guess, you know, in a sense, you know, the tech rec and the GFC maybe gave everybody, practice might not be the right word, but yeah, I mean, there's a lot of people around now who have been through, you know, really big events like this before. Does this feel, you said this feels more compacted. Do you feel like coming out the other side is going to take less time, or do you sense that, you know, the length of this is going to keep going for much longer?
Well, it is interesting, and you know, the economists' predictions are pretty dire in terms of we're definitely heading into a recession. It's going to be a longer recovery, but no one has really seen this in our lifetime. So if you look at the tech rec and the GFC, those were both caused by business problems, right? This was not a business problem. So there's an argument to say that once this problem is over, business can recover quickly, because this wasn't from, you know, this didn't have to do with a big tech bubble being in place. That's not what caused it. Or the real estate issues, the US real estate issues that started the GFC. So we don't know. Hopefully it will be short-lived. We are advising our companies to assume that they're going into a very difficult fundraising environment for potentially the next several years. I mean, if you look at the tech rec, it really, fundraising didn't increase to levels of 2000 until this decade.
Yeah, I want to talk about funding in a lot more detail a little bit later on. Shaun, can I ask you sort of, you know, right now and short term, the impact that you think COVID-19 will sort of have on the ecosystem in terms of, from a startup's perspective, does it change kind of, you know, what does success look like? Does that, is the old paradigm kind of gone, and startups have to pivot and be something completely different to be successful in this environment?
I mean, it's interesting. Certainly, looking at the ecosystem and looking at venture more generally, it's such a diverse group of companies. It's such a diverse group of people that certainly within the ecosystem, there's probably areas which accelerate, probably areas that do very, very well, and certainly large areas, large segments of the venture system that are struggling right now. And that's a reality of where we find ourselves. From a longer term perspective, and things that we've seen maybe change that might stick around for a while, is it seems like everybody's a lot more aware, certainly right now, of discipline around cash management and the operational excellence, the requirement for operational excellence to make sure you're still here in 6 to 12 months as we do start to hit a recovery. It did feel like perhaps last year, everyone got so used to having huge amounts of capital that as long as you're spending money, you're probably going to grow and raise another set of capital in 12 months' time. And that's probably not the reality now. And so that discipline is probably one of the only, or probably one of the silver linings that comes out of this, and will stick around for maybe a few years after.
Yeah, Anthony, is that kind of in your portfolio of companies, is that the key message that you're putting out there, that you're discussing with your startups, that, you know, first and foremost, the most important thing now is to just conserve cash?
Yeah, absolutely. We're quite fortunate that we're in the early stages of deploying our fund. Most of our companies are still very, very early stage. They're nimble. They're anything from kind of 2 to 12 people teams, and so they've been used to operating on the smell of an oily rag for a while, and also of those at this moment in time has probably worked a little bit of an advantage. I think the point that Shaun made is quite interesting. I think that the maturity that is going to be brought to the sector around cash management will really accelerate, and I think that really started at the end of last year with kind of the WeWork story, and actually the reality of the, you know, businesses just continually being funded till they get bigger and bigger and bigger, and then can be passed to the public markets is really something that we won't see for a while. But that really did feel like kind of a big end of town problem. And I think that discipline is going to come all the way through now. right to the earliest stages, which actually I think is a really, paves the way for a very interesting opportunity in terms of the types of businesses that we see are going to be built over the next few years.
Why? I mean, as an aside to that, and you hear a lot about this sort of the funding environment where people were just, swimming in cash. Why, from an actual funds perspective, was that happening? Why were, the VC funds continuing to put so much money into these companies? Were they not looking at them and being concerned about, whether they were being prudent with the way they were spending cash?
I think generally, others on here can probably add to this. I think they generally were, have been. I think the due diligence that goes into making most investments by pretty sophisticated investors is quite extensive. But I think it's also a sign of the times and the fact that there are lots of opportunities of great businesses to invest, that as long as they continue to grow, then we're likely to be successful. No one was really preparing for the current environment. I don't think anyone had a coronavirus business continuity plan. And I think a lot of people have caught unawares and by surprise with what's going on.
Yeah. Stephen, in this environment, are you actively looking for companies to invest in which have some kind of relationship with coronavirus? Whether that be companies which have already proved that they can sort of come through this relatively unscathed. I know a little bit earlier we were talking about some of those, including Canva. You've got some of the, say, the food home delivery services who are, this has been a blessing in a way. So either on that side or, companies which are sort of actively involved in trying to find ways to mitigate the impact of this virus in the future.
Yes, so basically our funds is focus on early stage tech companies. So we'll definitely see opportunities which COVID-19 created. I think this environment definitely have two-sided impact for traditional business or the business with online model or their business model is quite flexible and nimble. So we'll see a lot of challenges the traditional a business facing, but I see a lot of digital transformation happening now and acceleration. So we are active. We're still very active looking for opportunities in healthcare sector, in the technology sector, but we focus on those companies or startup. They have really a strong growth path while the online delivery model, such as online education application form or social influencer marketing, or they have basically they haven't really got significant impact due to the COVID-19, but they have opportunities through this, I think, unprecedented event. We have in our portfolio, we have two companies actually just complete the fundraising. One is Series C and one is Series B. It's quite successful, under this kind of really tough circumstances. I just got the confirmation today is the Series C1, which they raised 70 million US and create a 1.4 billion valuation for this round. So it's very a successful story. I think the startup or the company under this kind of environment can achieve that big funding. So I still see a lot of opportunities we are pursuing, but we are more cautious on how much we invest and what's really the timeline for the investment. So traditionally we were looking for 3 to 5 years. Now we will look or opportunity will see more longer term, say 7 years or 10 years, how they can perform or take opportunity from this time?
Yeah. Anthony, I'll just go back to you because I know you sort of specialize in that really early stage. Have you had any early stage or even new businesses who have got ideas that are specifically related to COVID-19 who've come to you looking for funding?
So we made 13 investments in April, which is really exciting. And through the programming that we run, there were a couple that we were looking to make that unfortunately COVID scuppered, and there were a couple that really became much more interesting with regards to COVID, and not really looking at the COVID solution itself, but the longer term impact and the changes that it may have. Antler globally actually put out a call to all businesses around the world that felt that they had businesses that would thrive in the COVID environment, with a focus on digital solutions and the health and well-being space components of that. And we were pretty blown away that within 10 days of putting that call out, we had 1,600 applications of businesses coming forward for funding from 90 countries. And we're currently working through that now. We'd originally planned to only invest in 5 of them, but the response and the quality has been really quite phenomenal. So we've actually now got this as an ongoing initiative out of Australia and around the world.
Wow, that's amazing. Let's talk about money. Let's talk about capital. Melissa, in your portfolio, just across the board in general, have nearly all of your companies kind of needed to try and get back into market to raise more capital and sort of bolster their balance sheets in the last, month, 6 weeks?
Well, I think this is the worst time to raise capital. So we wouldn't encourage any of our companies to do so that don't have to. A couple were in the process of raising. And those are the ones that, luckily one of them just got a term sheet, which was great, because they were in a scenario where, 2 or 3 months ago, it would be pretty easy to get a term sheet because they've had great growth and they've done really well in their sector. But you don't know when you get into a market like this, what's going to happen. So luckily they did get one. We wouldn't encourage companies to go out and raise. And in fact, a couple of our companies that were planning on raising in Q3, we've said at Q3, meaning calendar year Q3, we've said hold off. Probably not a good time to raise if they can hold off. And in terms of what we think will be available or how we see the market, especially the domestic market. So there's a lot of talk where, there's still a lot of capital because people are looking at funds that were raised in the last year or two. But I actually think there's less than people think. And if you look at how VC funds work, so over the last 5 years, if you look at 2015 through 2019, on average, Australian venture funds raised $560 million of capital on average. Last year it was 632. And when you think about just how that's allocated, most of that is committed in the first 3 years, not necessarily but invested, but it committed to their current portfolio. So we really are looking at, last year there was 630 million raised. Part of that's already been committed, but what's going to be raised this year? I don't think we're going to see lots of big funds. I know a couple funds that were out in the market that have decided not to raise this year. Blackbird will get a small fund off this year. But I think we're probably going to see around 100 to 150 to 200 of new venture funds raised. I'm not talking about venture money deployed, but I'm talking about funds raised. So I think we're going to see a decrease by at least 2/3 in our domestic market, versus what we've seen over the last 5 years for new funding. And when you couple that with the fact that if there's not investment available for your current portfolio, or companies that are performing well from outside investors, to do those series B, C, and D rounds, you're going to be using more of your assets, even in subsequent funds, to keep your good companies alive in previous funds. So there's even less money for new companies. And then also, I think overseas, we've seen more overseas funds in the last few years coming here to invest in later stage rounds. I think we're going to see less of that as they're focused on their domestic markets and their current portfolio. So I would say in 2021, we'll probably see a third of new funding going to companies than we saw in 2019 in Australia. Did we lose Kylie? No.
Yeah.
I'm back. Sorry, it just keeps cutting out. Keep going. We'll.
Oh no, I finished my point.
Melissa,
okay.
Can I ask you a quick question on that? Just with regards to the advice that I think a lot of people are giving their portfolio companies with this kind of recognition that there might be a drought of funding next year. How do you balance the dialogue of now's really not a great time to be going out to raise money compared with yeah, but there's also not going to be much money around next year?
Yeah. Well, I mean, do you think it's a good time to raise money right now? I mean, if you didn't have to, people are, I mean, we just did an investment and we just closed an investment last week and we're about to close another one in the next week or two. But those were companies we've been working, you know, we've been talking to in one case for years. So people have slowed down. No matter what you hear, people have slowed down. Funds have slowed down. So if you're going, and it's a big effort to fundraise, it's always a big effort to fundraise. So if you don't have to in this market, you know, why would you do that? We're, to the extent that's possible, we're advising our companies to try and get to a point where you have at least cash until the end of 2021, if that's possible. It's not possible for all of them, but you know, we're potentially heading into a very difficult fundraising environment that could go on for years. If it's like the tech wreck or the GFC, if this is a very sharp V, we could be back next year.
No, I think that's consistent, and we agree that end of 2021 feels like a really good target. And if you've got no chance of getting there, then we're actually telling our companies to go out looking for starting those conversations now, because it will be harder and it may take longer. But you don't want to, the worst thing that we can have is great companies fail because they run out of cash.
Hey, Shaun, can I get your perspective, you know, sitting at Investec, you know, obviously you do what you do, but the company sits across private and public markets. And there's this sort of one school of thought at the moment is that, you know, the markets, the public markets are holding up so well, almost, you know, in spite of everything that's going on health-wise. And that's just purely because of the weight of money. You know, you can't make any money in fixed income, so that's gone. People are sort of piling into equity markets, and it's maybe not, you know, maybe those valuations are completely unrealistic. So, you know, devil's advocate, is private capital a good space to be in at the moment, particularly if, you know, as an investor, if you can be getting in to some of these really great companies at a discount?
So I've heard two schools of thought in that regard. And one is that, you know, it is more attractive to be in some early stage companies, some private companies, than perhaps the public markets because of the volatility that you're experiencing there. And that's true. You know, some of our venture companies do have longer term profiles, and to the extent that they're not immediately affected or not immediately at risk, they don't have a 3 or 4 month time frame to either success or failure, and so that can be attractive. The alternative is that a lot of people with capital have been pretty burnt in the public markets right now, and perhaps there's a lot less spare capital floating around to flow into the private side as well. So I think it does cut both ways in that regard. From a general, maybe looking outside of venture, I think there's definitely a consensus that there's going to be a lot of opportunities potentially as we do start to emerge, and businesses that found it difficult for 3, 6, 12 months could be invested in or purchased at a good valuation compared to maybe at the back end of last year. And so maybe private equity gets quite busy. I feel like the venture investment community is a little bit segregated from that, because we're not looking for distressed assets. We're looking for really great companies that are on the growth profile. And so it is a little bit of a different approach, I think, in the venture space.
Yeah, sorry everyone. I'm not sure if this is my internet or everybody else is having trouble with it, but I'll go to Stephen. how about you at the moment? Are you sort of seeing some really big opportunities to get into some of these companies that perhaps, you know, you would have been looking at a couple of months ago, and now potentially they're raising and you're able to get in at a discount?
I think definitely the valuation, if you talk about, you know, valuation compared to a year ago or even 24 months. Hello, can you hear me?
Mm-hmm.
Yeah, okay. I think Kylie got some delay on my voice. So if you compare it to, you know, 12 months ago, 24 months ago, the current valuation of some really good quality companies, if they have to raise money, you definitely can pick up some very good deals. But so basically our message to, you know, our portfolio companies, similar like what Melissa and Anthony and Shaun, the similar message. If you don't need to raise the capital now, you don't need to really, you know, put a lot of effort to do it right now. You just focus on your cash management. But we'll still working with the companies we have been, you know, work with for like last 6 to 8 months, and we see basically rebuild the model, will financial model or the model for the valuation, and see if they still have a merit for the investment. I think this is definitely have like impact on our investment decision, and also about the amount we invest, and also the return. How long we can, you know, get back the return is the same. So we'll not like really back off from the investment side, but we'll continue, you know, looking for deals. But I think this opportunity is if we see those good company or those like with, you know, high growth but have some temporary cash crunch, I will definitely, you know, we are brave to, you know, dive into their capital requirement and fund them in the next stage. So yeah.
Melissa, you were talking about timing before, and you know how long you were sort of suggesting to your companies that they needed to be funded till, you know, trying to sort of keep that cash in the coffer, if you will. How has this impacted your fund in terms of sort of the timing that you had been thinking about in terms of exits?
Well, because we're a strategic fund for NAV, you know, timing of exits isn't a primary importance to us. We're almost every investment we've done, we're co-investors with, you know, traditional funds, which, you know, who are more focused on exits than we are. We're more focused on strategic fit, and there's not, you know, we don't have to be exited in 10 years. But even if you look at the Australian funds, you know, most of them are fairly new, and, you know, they're not reaching that 10-year point. So I would think there will be maybe fewer good exits in the next year, but that's not affecting how we look at things at all.
Okay, we're nearly running out of time, but what I thought I might do is just go around to each of you and just ask you, you know, are you positive or negative about the next 12 months for the private capital sector in general? Anthony?
I think for capital, I find it extremely challenging, but I think in terms of, is this a great time to build a new business? I think it's incredibly exciting in terms of the explosion that we've seen of available talent who have found themselves unexpectedly available, and the opportunity to really go and build a business into what is going to be a post-COVID-19 world, where you can really disrupt industries which will be licking their wounds for probably a few years inwards and insular. So I think I feel positive for the medium to long term, but definitely recognize there will be funding challenges in the short term.
Yeah, it's a really good take, Shaun. Maybe Stephen.
Maybe this time it wasn't registering the unmute. Sorry. From an investment perspective, I'd say I feel cautiously optimistic. You know, I think there's certainly going to be some businesses over the next 6 to 12 months that are great investment opportunities. And I think the key is to be selective enough to be making good decisions and investing in businesses that have good long-term prospects. Whether that is tied into a relatively short V turnaround or a slightly longer elongated recession, I think that's difficult to say at the moment. But I think people with capital, and certainly it seems like there'll be a scarcity of capital, there should be some strong opportunities for those that are selective.
Okay, Stephen, positive or negative?
I think it's two parts. For the new venture capitals or the new funds, I think I'm not that positive. You raise a new fund and a current environment, and definitely I think in the next 6 to 12 months is really challenging. But with those a fund, they already have capital and can be deployed in the next 12 months. I think I'm quite positive on those capitals, because I'm very positive on the new opportunities arising from this challenging time, and there are a lot of good deals and a lot new ways to doing business. I think that's definitely the capital we're looking for returns. This is the timing to make those investments. So yeah, it's kind of two part of the story.
Okay, Melissa?
I think I echo a lot of what Anthony says. I think short term, it's probably going to get a little bit worse, and hopefully that'll be for a short period. But one thing that happens in times like this where capital is scarce is that companies get very focused on what's important and where they can have the most impact. And most of our companies, one of their biggest challenges is talent. So Anthony said it, it's easier to get good talent in a market like this. So that's a positive as well. So I think we'll see some really good companies come out of this.
Yeah, okay. Well, look, thank you, all of you. That was really interesting. Really appreciate you taking the time.
Thank you very much, Kylie. Thank you, everyone.
Bye. Bye.
See you, everyone.
We hope you've enjoyed the CRIISP Venture Investment Summit. I'd like to say a big thank you to our team that has basically worked day and night to bring this to you. I'd like to say also a big thank you to the panelists and also to the speakers that participated, that contributed their time, and also more than that, they also contributed their IP as part of this event. It said we're very unique in that we have an ecosystem that contributes their ideas and contributes their knowledge, to help others, and also not just to do that, but also to build the ecosystem as well. As mentioned, if you enjoyed today's session, obviously we've gone through many different presentations, but if you've enjoyed today's sessions, please like the video, share it amongst your networks, but also provide this content to others. And said, as the way we grow is by people referring to us. So make sure you subscribe on our list. Make sure you introduce other people to our mailing list as well. And we'll keep you up to date with other activities as well that will be coming forward. Thank you again, and we're glad you enjoyed the sessions.
you.